wave narrative at the time that was never really supported by the polls and never panned out. So they're certainly not unerring. I think they're an important input. Again, it's sort of a good thing to watch, but not a unique claim on truth. And then from a polling error perspective, to your question about whether or not we should take the polls at face value or kind of tack on some adjustment for Trump being underestimated, my priors have always been that we should treat polling error as symmetrically distributed, take the polling largely at face value. Obviously, it is a possibility that we have a big polling error in Trump's favor, also a possibility that we have a polling error in the other direction. But historically, there's not been really any connection between polling error in one cycle and the next. I don't think we have enough of a statistical track record based on the relatively limited number of modern elections we've had to confidently say.
Do this for me. Run a simulation in front of us right now with Trump winning and with Biden winning and your clients calling you the next morning, assuming we know the outcome, by the way,
right.
And how you would therefore be advising them as it relates to investing on November
Trick question.
5th.
Yeah, so look, if Trump wins, I think it's probably coming with a red sweep. So anything that Republicans put their mind to, they can do. Sectorally, I think the clear winners there are first and foremost financials. Traditional energy, I think, probably wins in the early going, but not necessarily over the course of the entire Trump administration. Crypto, parts of managed care. And then from a macro perspective, I think we're probably looking at steeper yield curve, stronger dollar, and a lot of concerns about what his tariff agenda in particular looks like as we get into late 25 and early 26. If Harris wins, in all likelihood, we're looking at divided government with Republicans winning the Senate. So there, we'll need bipartisan fiscal deals next year. The sectoral winners really, I think, are kind of the mirror image of Trump, just because you won't get the positive Trump traits in those sectors. The clean energy looks a lot safer because you're taking off the risk of IRA rollback if you don't have unified Republican control, and more of a status quo outlook from a macro perspective.
Okay, let me throw something else into your simulation. Do you believe that in the month of November, or I don't know, you tell me the date, that you will know who the next president is?
Whoa.
And that there will be all calm on the Western Front?
Come on, man.
Well, I wouldn't say all calm, but I do think that we'll know the winner. Not necessarily on election night, but probably that week. The House will probably have, well, at least might have a longer timeline because it does look very close. And some of the key House races will take weeks potentially to count out west and in the Southwest. So we may not know the sort of full configuration of power in Washington for a while. But, presidentially, I think it'll probably take a couple days to count the votes in some of these states, to start tabulating early vote late or let mail ballots come in for a long time. And then, our thinking coming out of the past two cycles is courts have been, I think, pretty reliable at quashing frivolous election challenges. So I do think that the person who wins will be the actual winner. Certainly it'll be a contentious period. We'll see some litigation. We'll see some kind of claims about alleged election irregularities. I feel fairly confident, but I don't think they're going to actually change the outcome.
Tobin, we will see, and I'm sure we'll be talking to you a lot more between now and then and afterwards. Thank you very, very much. Joe?
Thanks for having me.
Right, thanks. Coming up, 3 Americans have won the Nobel Prize for economics. Details after the break. Then later, former Fed Vice Chair Roger Ferguson is going to give us his take on the latest inflation data we got last week. Squawk Box coming right back.
Very interesting, yeah? Oh, today's Columbus Day. It's a government holiday. Interesting. It means I don't have to work. Ding.
It's not just the bid end.
Knew this hour, I've been seeing the Nobel Prizes trickle in last week. Now we've got three
Blooper.
U.S.-based economists awarded the Nobel Prize in Economic Sciences. The winners, Darren Acemoglu, Simon Johnson, both from MIT, and James Robinson from the University of Chicago. The committee said their work helped show why societies with poor rule
We
of
saw
law
a
and
blooper.
institutions that exploit the population do not generate prosperity, growth, or change for the better.
It's really interesting.
Is kind of, I guess, you figure that. The prize money, about 11 million kroners, or crowns, I don't know. But it's $1 million. It's going to be split evenly between the three. And the award, we call it a Nobel Prize for Economics, but it's really not one of the original Nobel Prizes. Officially, it's known as the Sverigers Riksbank Prize in Economic Sciences in memory of Alfred Nobel. And I always point that out. Not a real Nobel Prize, because it's not a real science. It's not a real science. Can't be an actual Nobel Prize. It's not a real science. Kind of like the Nobel Peace Prize. I don't know what that is at this point. That's almost like the Time magazine thing where they had a little.
You know what? It's pretty cool.
You were the.
You're a person.
Yeah, you were the person.
It's pretty cool. If you got the Nobel Prize, I don't
It's
think
not a
we
Nobel
would.
Prize. It's an economics prize in memory.
It happens
of
to be
Alfred
called the
Nobel.
Nobel Prize. It's a Nobel
Not really.
Prize.
Okay.
If we gave you the prize, I hope we wouldn't,
I'm not worried about that.
Critique
happening.
the prize and the prize.
I took one economics course, and I think I'm better for that, for only having one.
For the course.
No, I did not.
All right, when we come back, NVIDIA's bull run, the stock having an incredible year. Demand for AI chips surging. So should investors keep riding with Jensen Huang? We're going to tackle that topic next. Squawk Box will be right back.
Rob.
Am I on TV?
You're on TV.
That's incredible. I'm with Becky.
With the greatest show, the greatest show in the world.
This is the greatest show on earth.
Wow, keep that tape. And by the way, with what is arguably the most successful company in America today.
Well,
Can we just say that?
Well, I was gonna
broadly
say
than that.
Just on the trajectory it's been.
of probably not quite market cap, but in terms of getting to this market
Yes,
cap,
unbelievable.
like
Unbelievable ride.
16 days or whatever the hell.
It wasn't
Anyway.
quite 16 days. 32 years and 16 days.
That was NVIDIA's CEO Jensen Huang making a surprise visit to the Squawk set last Friday. That stock has been on a powerful run over the last year. It's up nearly 200%. Market cap topping $3.3 trillion. Joining us right now with more on NVIDIA's bull run is Ben Reitzes. He is Melius Research, head of technology research. Ben, you say that when you reiterate your buy rating on this, you get a lot of eye rolls. What do you tell the skeptics who are doubters?
Well, this is like when Apple did the iPhone, and if you gave up on Apple in year 2 or 3 of the iPhone, you missed a lot. So this is really in the beginning, and what people, really are skeptical about is the size, and they're already a huge market cap here, but there's still room to go. And obviously, Jensen running around New York meeting investors all over the East Coast, he's got a lot of good things to say. I think that you should listen to him.
NVIDIA, you actually say, is your second cheapest stock in your group. How do you look at it on a PE basis?
Well, I look at PE to growth, and there's a ton of upside next year to our growth estimate, and revenues of 40%, but there's upside there, and there's probably not as much upside in any other stock. So I think it's trading at about 1 times PE to growth for next year. And that's really attractive for a name like this, as long as the numbers are there. And if obviously if the direction is upwards to the estimates, that's really attractive still. And I think that each day you got to walk in and say, what are our checks showing us? What is the research showing us from the bottoms up? And it's still there.
Demand for Blackwell, what are you seeing in your channel checks at that point?
It's pretty huge. What the big issue was whether they could get the production up and running and get through their mask issue, and they seem to have done that. And whether they can get through the negative mix shift of scaling a new product, and I think they're going to do that pretty well within a couple quarters. And the demand looks really insane, like you said. These big clouds, you got to understand, these are huge capitalized companies, and if they're going to beat their cloud numbers that they're going to show the street, meaning Microsoft, Google, Amazon, they got to buy Blackwell, and they got to get the customers up and running, or else they're not going to beat numbers. And that's it. That's how you get the sequential acceleration to their cloud business. The companies will say a lot of different things that, it's because of how great they are in cloud, but really it's because investors run to their platform to use the latest and greatest from NVIDIA. And that's how they're going to beat, and they're going to buy a ton. And pretty excited.
What about their gross margins? There has been some concern recently about whether they could keep up the gross margins or whether they're continue to drop a little. And this is, again, from very high levels.
Yeah, that was our main concern as well. And whenever you launch a new product, and make changes to it, you have to you even write off some older inventory or inventory that's no longer useful. They had a larger write-off than usual last quarter, but we think that's going to get less and less as we go through. And what we're seeing is them moving past that gross margin issue. So what should happen is gross margins go down a little bit for a quarter or two and then turn. We see gross margins in the mid-70s, which can power close to $5 in earnings power, that they can demonstrate over the next 4 to 6 quarters.
The stock was down about 2% in the calendar third quarter. What about the fourth quarter? What makes you think that this is going to be the time that things really turn around?
Well, I think that the street this time, so last year as well, third quarter is a tough time for semis anyway. And for NVIDIA, they tend to do the market tends to really hype things up in the first half and then digest it in the second half. And this year, a lot like last year, what happens around this time is folks start to say, yeah, I know next year is great, but what about the year after, meaning 26? And I think the street this year is going to discount a little quicker that things are okay. They have that huge show in March called GTC, and we think they'll unveil the Rubin chip for 2026 there. They've already talked about it, but we'll hear more about it. And then you realize, oh yeah, 2026 is a growth year, and it's a pretty big one. And the market probably discounts that a little sooner than they did last year because Jensen is obviously gaining more and more credibility, which is obvious.
Ben, thank you for joining us this morning. Ben Reitzes.
Great to see you, Becky. Thank you.
Thank you.
It is just now 7 a.m., 7:01 on the East Coast. You're watching Squawk Box right here on CNBC. I'm Andrew Sorkin along with Joe Kernan. Okay, quick, got a lot going on this morning. Stocks in China, they are higher overnight. The CSI 300 and Shanghai Composite were each up about 2%. Tech-focused Shenzhen Composite up 3%. Hong Kong stocks falling by 0.75% on Saturday. China's finance ministry delivered a much-anticipated press briefing that did not offer details on the size of the stimulus that Beijing plans to pump into the economy, but instead focused on measures to tackle local government debt problems after Friday's close. By the way, so curious what David Tepper might think of all that. We're going to get to that in a little bit. But after Friday's closing bell, meanwhile, Boeing announcing it's going to cut 10% of its workforce, or about 17,000 people. It's in its machinist union strike that has now idled factories. It's also pushing back the launch of its new wide-body airplane, the 777X, until 2026. We're going to talk more about Boeing later this hour, just a little bit. And then this one, SpaceX launching its 5th test flight of its Starship rocket. It happened yesterday, and boy, did it make a dramatic first catch of the super heavy booster. It marks a massive milestone in SpaceX's goal of making Starship a fully reusable rocket system. This after the Starship launched. Booster returned to land on the company's launch tower nearly 7 minutes after that launch. It was caught by 2 big arms known as chopsticks.
Yeah. A lot of great video, a lot of cheering, a lot of, people were on the microphone or just exclaiming in the kind of language we would probably exclaim in just watching it happen live. Pretty unbelievable. I was kidding around, people never really understand sarcasm, I guess. It makes me worry. It makes me worry about things. But someone wrote, breaking, SpaceX rocket falls down in flames, barely being bailed out by faulty mechanical arm. That's sort of the mainstream media take of how they, the people that hate Elon Musk now, that would be their headline of how that happened. And we won't mention any names, but, and then people said, oh yeah, you try it. And I go, did you hear the one about the ceiling? Anyway, checking the futures this morning. Check out, we are a little bit mixed, up 44 points on the Dow, or on the NASDAQ. Dow down about 83. Let's get to Dom Chu. We'll take a look at this morning's pre-market news. It's like landing a 20-story building that's coming out of the sky, Dom. I mean, I can't believe it can be even done, to be honest with you. Can you to pinpoint it like that? Remember how we used to do it? It's going to land somewhere in the Atlantic. We'll get to you eventually, like in 3 days. We'll find you where you are. I mean, it's unbelievable, engineering-wise.
I would just say this. I grew up in that generation in the early to kind of mid 80s, where we in elementary school would watch on TV space exploration, shuttle launches, and rocket launches and things, and do it with wonder. And I still think that even with today and all of the things that are going on right now, I still have that sense of optimism every time I see anything that has to do with space exploration. So
right.
for me, I think it's cool, and that's regardless of what the other editorial takes are on it. Anyway, let's start with a look at some of the movers on some key analyst notes this morning. Wells Fargo right now is downgrading 3 apparel names this morning: Canada Goose, Amer Sports, and VF Corporation. They're kind of down across the board, as you can see, in extended trading. The firm downgraded Canada Goose to an underweight from equal weight, citing macro concerns in China and margin headwinds. Vietcorp also downgraded to underweight from equal weight, and Amer Sports was downgraded to equal weight from overweight. So keep an eye on some of those apparel names, consumer ties, and everything else there. Let's move on to another downgrade now, which is getting attention, and that's Caterpillar. Those shares are lower by about 2.5%, due in large part to Morgan Stanley lowering the construction equipment giant and, of course, Dow component to an underweight rating. It was equal weight before. The target price goes down to $332. It was $349 prior. They're citing things like concerns over possible inventory reductions in construction equipment products, also the sharper outperformance already, as you can see, of those shares over the course of the past year. It's already up close to 50% in that 12-month period. And by the way, for more on those and other top calls of the day, CNBC Pro subscribers can head over to cnbc.com/pro, so keep an eye on cat shares. And we'll end with Netflix. Those shares did, by the way, hit a record high on Friday's session. The streaming video giant is reporting earnings after Thursday's closing bell. And after a doubling of the stock, you can see there over the past year, the options market is currently pricing in what could be a roughly 7.5% move in the stock up or down on the heels of that Thursday report. Now, that's slightly less volatile, believe it or not, than the stock has traded over the last 8 quarterly reports. So, Joe, Netflix, a key stock in focus this week with Thursday earnings. I'll send things back over to you guys.
All right, Tom. Good to do this on a Monday, talking about Fund Strat's Tom Lee. He's going to tell us what type of environment that the stock market finds itself in at this point, following the recent inflation data and jobs data. And the ongoing strike at Boeing now leading to thousands of layoffs, the stock down more than 40% this year. Can the company overcome its challenges? That and more when Squawk Box returns. markets following last week's inflation data. Tom Lee's here, managing partner and head of research at Fundstrat Global Advisors, as well as a CNBC contributor. Tom, in recent appearances, I would say that your conviction hasn't necessarily been quite as strong as it had been in some of your other calls, where there's been a time where you said the inflation data will be so good that the S&P will be up 200 points in the next week, and it panned out, and it played right into what you were saying. The last time you were on, I think your basic thesis was that market's still solid through the end of the year, but in the meantime, there could be some volatility and maybe even a pullback. Now I think you're saying it's been more stable than what you're expecting, and it has to do with liquidity and cash on the sidelines more than anything else.
Yes, that's right. You're right. We've kind of been sort of, I think, fooled by seasonality, because we thought markets would be hesitant before, the elections, and it's October, but we've seen this market be incredibly resilient. So I've underestimated how strong this market's been. I think it really shows macro data is becoming less important, and it's now the fact that a lot of cash has been on the sidelines. For the last 2 years, investors expected a recession, or many thought when the curve uninverts, we got a recession, but at the end of the day, there's $6 trillion of cash on the sidelines, and October has turned out to be a great month.
We've seen it, evidence of what you're saying, and I know how closely you watch it. We've seen it on a daily basis over the last, I'd say, maybe month or so, where many days we're even down triple digits in the futures, only to end up 250 or 300 points by the end of the session, and with no backdrop of positive news, nothing to account for it, other than it seems like there's money on the sidelines coming in.
I mean, it feels like investors are underinvested in stocks. I think there's people who've dreaded 2024, thinking this is the year we slip into a recession, and instead, and we're seeing it with earnings, companies have been really resilient.
Yeah, we waited to retest the lows a couple of times in 2022 and 2023, and people weren't bullish at all. We didn't get great advances, and now it's almost unstoppable, and nothing seems to be able to knock it off a track, whether it's, I think the PPI and CPI were both a little hotter than people thought. The prospects for a Fed continued easing cycle are now open to some conjecture, I think, although most people say it's still going to happen, even though things are pretty solid in both the economy and the stock market.
Yeah, I think it makes sense for the Fed to be dovish, just because inflation is still tracking, especially PCE, towards their 2% target, and now we have some concerns about the job market, so I think the Fed has to be supportive, and I think this election, which is becoming less of a coin toss, I think because it's been a coin toss, people have been sitting on their hands. I think these are reasons markets are starting to have conviction, even in front of an election event.
I think we've soft-pedaled it too. The swing states have even some of the swing states that looked like solidly in Harris's camp are now truly swing states where Trump's up, in Michigan and Wisconsin, and betting and everything else. And if NBC goes from Trump up, or from Harris up 5 to Trump and Harris tied, and then you do a full field and Trump's actually up in a full field thing. So I think you might be right. Bitcoin's at 65,000. You wouldn't say that the stock market's performing better because it's starting to look like it's less of a coin toss, would you?
I think markets like visibility. So if it looks like one candidate is now looking like to be the surprise winner, then markets can actually trade better before the election.
Wait, does it matter? You said markets like visibility. They have to like what they see on the other side of it, I would assume.
Yes. I'm probably just citing market history, but whether Trump or Harris wins, I think stocks do pretty well next year, sort of a post-election rally, but there are definitely differences in sectors and asset classes performance depending if Trump or Harris wins. But Bitcoin, for instance, is something to watch if Trump looks like he's strengthening, because Trump is running on a pro-Bitcoin platform.
All right, now, you said something, get off of that, the politics. You said that you agreed with almost the asymmetric risk now, and I still think it could go the other way. I mean, I think the labor market looks pretty solid, given that last report, and that we're still, if PCE is 3%, it's got to go down another 33% to hit 2, and they swore they're not moving the goalposts. It's 2, it's 2, it's 2. It's not 2.5, Tom, it's 2.
Yes.
And what makes you think that that's in the car? Who knows with the Middle East and everything else, but oil's back to, mid-70s and could go higher.
Yes.
I'm more worried about it. I don't know. They're more worried about the jobs picture than stubborn inflation.
Yeah, I mean, you're actually right. Oil spikes can cause an inflation spike, and that would be a surprise. But if we look at what's been keeping inflation stubbornly high, it's been shelter, which in the latest inflation report finally is rolling over, and it's auto insurance, which is now just beginning to sunset. So in the second half, auto insurance becomes a tailwind. And then the question would be, are core goods going to stay under pressure to kind of bring overall inflation down? And it looks like core inflation, on goods, looks like it's going to remain soft. So I think inflation doesn't have the upside drivers, except for what you're saying, a commodity shock.
And because of this crazy dual mandate, which the more I think about it, they're almost diametrically opposed. The two, I don't know how you try to satisfy both, but because of it, even if the stock market's at new highs, even if GDP is still chugging along, and even if we're at 4% unemployment, you still cut rates. You still go ahead and you don't save that ammo. You don't save the dry power. You still got to cut rates.
I mean, it depends on what the neutral rate is. But if the neutral rate is 3, then Fed funds here is actually super restrictive, because that's 200 basis points of real.
How come my whole life we've been super restrictive? We've been super restrictive almost. We have been typically in much higher interest rate environments with a strong economy and with a rising stock market all through the 80s and 90s and 2000s. We were never this low. It's almost like we got, after the financial crisis, zero became something we got used to, and now, oh my God, we get up to 500 basis points and we think we're, like in Volcker days or something, 21.5% prime rate. 500 basis points doesn't sound like it's necessarily restricted.
Yeah, actually, you're bringing up a good point, which is the economy is holding up really well in the face of a very restrictive Fed funds, and companies.
And maybe it's not restricted.
Yeah, but it's impressive, because now we know there's pent up demand. Companies, CEOs have been cautious. The ISMs have been weak because people have been expecting a recession. Now there's demand coming back, and you're right. Maybe the Fed cuts slower, but that's actually would be a good thing for stocks.
Okay.
But that doesn't spike inflation. The demand.
That's right. It might even hold back inflation.
Right, exactly. That way they could maybe satisfy the dual mandate, which is a tough, it's a tough job. It's tough to try to do it, and they almost have to favor one versus the other depending on the time frame. Oh yeah, we're going to put that on the back burner a little bit. I think there should just be $1 stability.
Yeah, the Fed has a tough job.
Yeah. All right, so do you. You do it well. So we, well, no, we don't know, I guess. Maybe.
I'm not going to ask you which of our mandates you're talking about.
Yeah, exactly.
When we come back, we're going to take a look at the latest developments in the Middle East conflict and what U.S. officials are saying about potential Israeli targets inside Iran. Right now, though, as we head to a break, let's take a look at this morning's market winners and losers in the S&P 500. Squawk Box will be right back. Make money.
Shot of New York skyline. Meantime, U.S. officials now urging the Israeli government to avoid targeting oil, gas, and nuclear facilities in the ongoing conflict in the Middle East. I want to bring in Brian Sullivan now, who joins us with the latest. What do you think, Brian?
Well, Andrew, thank you. Good morning. I was just in D.C. last week talking to some high-level officials about this very topic. NBC News publishing a report last night saying basically that Israel may have narrowed down its targets inside of Iran. We reported on this back on October 1st. It is worth certainly revisiting, and I want to be very delicate in my reporting here, guys, because it's not clear what, if anything, could happen. Nothing could occur. Israel could not strike inside of Iran. That said, let's take a look at what could be, at least on the oil and gas side, possible targets. I've laid out what I believe, based on research, talking to people, etc., would be the top 4 oil and gas potential targets. Abadan Refinery, the biggest refinery in Iran, Mashahar Export Port, Karg, which is also spelled Clark sometimes, and Kish Island. Karg is actually the main loading point for oil. It's an island. That's where most of the tankers fill up. I do not believe, guys, that would be a target. It would be an environmental catastrophe as well. It would knock out, not only knock out their ability to load ships, but the environmental aspect, and probably spike oil prices. That is something that the administration, it goes without saying, would be hoping to avoid. Inside of Iran, there are a number of refineries as well. The one that we just showed you, Abadan, is by far the largest. But there are some other potential targets. You've got Isfahan, you've got Iraq, you've got one named Tehran as well, that are a little bit smaller. And the reason why those domestic refineries, guys, could indeed become the targets, again, very carefully, if, big if, anything were to happen, is that that would primarily disrupt the domestic Iranian economy, could actually bring oil prices lower, because if you don't have a place to refine oil, but the oil is still flowing, then what happens? You have to sell it on the open market, which actually could be one reason why right now, at least, the price of oil is down. A lot of issues here, guys. Issue of Saudi Arabian airspace. What exactly? It's a long way from Israel to Iran. What could happen? But based on just kind of culminations of research and information, those are just some things to keep our collective eyes on.
Brian, is there any thought in your mind that they would actually wait? I mean, that the U.S., given this administration's push against some of this, would wait for the outcome of the U.S. election? I read an analyst report about that last week.
Yeah, that is an excellent question. I wish I had a more clear answer for you, and I hate to be hedging it, Andrew, but the reality is we just don't know. Israel is a sovereign nation. Again, last week in Washington, speaking to some sitting members of Congress, some of them, do a lot with defense, as well as some other administration officials, they are urging Israel, say, listen, Israel, we understand you have the right to defend yourself, and you have the right to punish Iran if you see fit, but consider the world, right? Basically, would you target your strike, again, if anything were to happen, in such a way that it would sort of cripple more of the domestic Iranian economy? They produce about 3.27 million barrels of oil a day. A little more than half of that, guys, is indeed exported. And I should also mention that it got no attention, but late Friday, Janet Yellen sent what I will describe to be a strongly worded letter, literally a letter, effectively to Iran, saying a reminder that the oil sanctions are still on. It was very legalese, is kind of very difficult to understand, but Janet Yellen, late Friday afternoon, reminding the world that we still have sanctions on Iranian oil. Their exports have tripled, but the sanctions still do exist.
Brian Sullivan, thank you for bringing us the latest, some provocative thoughts this morning about what may happen. So thank you.
Thank you.
Coming up, former SEC Chair Jay Clayton joins us to talk the possibility of a Google breakup and broader antitrust efforts. That's next. Later, we'll talk to former Fed Vice Chair Roger Ferguson for his take on the latest inflation data and where he sees the central bank taking rates next. Squawk Box coming right back.
Welcome back to Squawk Box this morning. The DOJ considering a potential breakup of Google. Joining us right now to discuss this and so much more, Jay Clayton, former SEC chairman, non-executive chair of Apollo, American Express board member, and CNBC contributor. Jay, you like the idea of breaking up Google? Do you think there's a problem there, and is that the right remedy?
Andrew, it's so interesting that the DOJ filed their brief and said, look, everything is on the table, including a significant breakup of what we all know is a ubiquitous company. As I look at it right now, no, I'm not in favor of a structural remedy like that. I think the history of those types of remedies in this country, particularly for cutting-edge technology companies, is dubious. But what I will say is the brief from the Justice Department, which is pretty short, does recognize a new level of network effects across the global economy. What do they say are the problems with Google? They say they have revenue sharing with distribution globally. They say they can order search results and therefore elevate some companies over others. They say they have great power over advertising. And at the end of the day, they have a tremendous ability to gather data sets that set them apart from all their competitors. On the one hand, you can say that's a ton of power that no company should have. On the other hand, you could say, wow, look at what we've put in the hands of consumers right on their phone, and they're able to deal with all of that in seconds in what would have taken days. So
Jay, here's the question.
I
As it relates
celebrate
to
technology.
Right. But as it relates, therefore, to a behavioral remedy, if you said, for example, look, Google, you guys are too ubiquitous. We need competition in there. We won't allow you anymore to pay Apple, for example, as a distribution partner to make your browser or your search engine the default search engine. Is that fair? Because then it's actually very interesting. Is that fair to Apple? Do you then have Microsoft come in with Bing and become the default search engine and pay a much lower fee for what may be a lesser product? I don't know.
Yeah, your questions show just how dangerous it is when you start to look at the effect on competitors as opposed to the effect on consumers. I'm a strong believer that at the end of the day, you look at what's better for the consumer, Andrew, than what's better for a particular competitor here or a particular competitor here. When they started this case, I don't think the DOJ had any idea that AI would be a potential replacement for search.
And therefore, you would do what? Nothing?
I would look at where there
might be the answer. I don't know. I'm just curious.
Yeah, well, that's the question. You know, in the government, I think first you should do no harm. I think that's a pretty good baseline to start with. But I would look at are there places where there's been an information advantage, or where there's been what I would say is true leverage and tying imposed in order to exclude competitors. I found some of the findings there, particularly speculative.
But how much of this is about, we talk about competition and innovation. How much of this is about being able to use capital today, and that is the competitive edge? When you look, we were just talking about NVIDIA, and we had Jensen Huang, who had had a cameo appearance on our set last week. There is a question about just how much capital, especially when it comes to AI, is needed to be competitive. It seems these days that if you have enough money and can get access to enough of Jensen's chips, for example, and you have a little bit of secret sauce when it comes to building algorithms, that you have a chance in the AI space. But not many have a chance in the AI space, not because of the algorithm piece, but because of the capital piece to buy the chips.
You bring up a great point that I think a lot of people are missing here, which is, let's just say AI is a global race, which I think we all believe, and that AI is important to national security, our economic health, and all of these things. We're actually in the most enviable position imaginable. We have at least 5 that I could count companies that are throwing what some people would say is an inordinate amount of capital at AI. I would not, if I were the government, I would monitor that very closely and see if that 5 is going to 3 or 2 or 1. But I love the position we're in right now, and I'm not sure I'd do a whole lot about it.
Jay, before we let you go, I have one final question. It actually has to do with this story that we were talking about in the last hour. Lighthizer, who's been going around and having meetings around tariffs, or at least discussing the idea of imposing tariffs almost immediately if former President Trump were to win this election. Is your sense that these tariffs would go on immediately? The reason I ask is there was also a view, which, by the way, I think I espoused at one point, which was that these tariffs would be used, if they were, as a negotiating tool, as a way of trying to push China and other countries to do things that may be in our interest. Now, maybe you have to impose them immediately to get that negotiating leverage, but I don't think that almost anybody expected they would be imposed on day one.
Andrew, let me tie your question together with what we were just talking about in terms of antitrust and competition policy. I do think that if you have a Trump victory, day one, I don't know about action, but day one there will be a review across the board. Because what we have had during the Biden-Harris presidency is a substantial shift in the regulatory state, a substantial shift in trade, and I think all of those things that shifted from 2020 to 2024 will be under review. And it makes sense. I think that the softening in trade policy with China, the softening in trade policy particularly with Iran, and the question of whether secondary sanctions are on the table, which Brian Sullivan was just talking about, all of that will be under review.
Okay, Jay Clayton, thank you for joining us this morning. Appreciate it as always.
When we come back, Boeing shares down more than 40% year to date. We will talk about the company's struggles after it announced a 10% cut in its workforce. And later, Walter Isaacson joins us to talk about Tesla's robo-taxi strategy, Elon Musk's focus on AI, much more. And we'll talk to him about that rocket as well. Squawk Box will be right back.
Force.
Welcome back to Squawk Box. It's a mixed picture for the futures this morning. Dow's down by about 70 points. S&P futures up by 8. The NASDAQ up by about 56. Remember, we did see the S&P and the Dow set a new high once again on Friday. In fact, the S&P has now set 45 record highs this year, and it closed above 5,800 for the first time on Friday.
And slasher film Terrifier 3 clawing its way to the top of the box office, raking in $18.3 million in its opening weekend. It's an independently made film dethroning the sequel to the Warner Brothers Joker franchise, which fell more than 80% in its second weekend, taking in just over $7 million. That fall marks the worst second week drop of any movie of the superhero genre. I didn't know it was even that you call it that. So this Terrifier, I guess, is a clown with an axe. Not an axe to grind, but an axe to use, which is beating the clown with Lady Gaga, because the Joker has sort of got a clown face. I saw I think it's called Piece by Piece, Pharrell. I saw that out in Telluride. It's kind of cool. It's an interesting way to show your life through Lego characters, and everybody's in it. Everybody who helped him in his career in hip hop. It's kind of cool. I'm sure you know Pharrell, I think, don't you, Andrew, or met him?
Big
or
fan.
interviewed? Yeah, it's pretty cool. I kind of liked it. It's weird watching, 2 hours worth of Lego people moving around, but a lot of songs. But Terrifier 3, the clown with an axe, tough to miss. As Halloween approaches, tough not to be a success. I don't know what happened with Joker. What a great,
I mean, that's the story, is how much that fell.
it's really unbelievable.
Yeah.
It's really unbelievable. Coming up, it's been 1 month since Boeing's factory union went on strike. We're going to take a closer look at the company's troubles and if a deal can be reached. This of a big layoff number, 10%, 17,000 workers. Squawk Box will be right back.
Insurance.
Let's take a look at energy prices at the start of the week. You've got WTI sitting just below $74 a barrel, ICE Brent at $77.40. Joining us right now to talk about what's moving these markets is Amrita Sen, Energy Aspects founder and director of research. And Amrita, I mean, this is really a story of waiting to see what happens with Israel and Iran.
Yeah, and I think today's reaction is as much about the lack of Chinese stimulus details. The market was expecting potentially some more, and just talking to a lot of participants in Asia, they were just expecting more stimulus to be announced. It's not that it won't come, but it could take longer, and they haven't given many details. And then on top of that, of course, everybody's waiting for Iran-Israel to see how it kind of pans out.
I mean, WTI has been up for now 2 weeks in a row. It still can be a little bit of a surprise when you look at that price and realize this is where we stand with all the geopolitical risk of the world right now.
Oh, 100%. I mean, in the past, if we were in a situation like this, I think you and I would be talking about $100+. I think it really tells you how bearish sentiment is. And it's an interesting dichotomy because inventories globally are super low, but the market's kind of looking forward to 2025 and talking about, oh, it is going to be very oversupplied, and somehow kind of has gotten itself into this mindset of it doesn't matter what's going on right now. It is the kind of future and the bearish future that's what's dictating prices today.
Does that lead you to think that there's the potential for huge volatility if something does swing?
Oh, 100%. I think the volatility, especially because the market's so short, we just don't have anybody really who's long right now. CTAs, like the high frequency traders, are a little bit long, but discretionary funds aren't. So if they are forced to cover, let's say there is a target on kind of Iranian energy infrastructure and then there's retaliation in the region, I think that's when you can see the real risk. And a lot of traders seem to be trading via options these days. So again, if they have to then cover that via futures market, I think you're going to get some significant value.
I mean, we haven't even mentioned Russia and the potential for their oil being disrupted at any point.
Yeah, and I think the market in some ways is very jaded by exactly that. Since pretty much what I'd say 2019, the Upcake attacks, geopolitics hasn't necessarily led to supply losses. The sanctions here against Russia were never designed to lose Russian barrels. It was about trying to reduce the fine or the revenue going into Russia. So a lot of people bet on losing Russian oil. We haven't. It's just redirected to China and India. And I think that's exactly why the market is so jaded trading geopolitics. And now it's almost like we need to see if there's an actual outage. That's when the market's going to trade this.
So let's talk the supply side at this point. Production in the United States has been a big factor. Does that knock out the possibility of getting to the levels we used to consider being normal in crazy geopolitical situations like this?
So I just came back. I just came from Houston, and I think for me the biggest takeaway there were the biggest and the mid-sized and small-sized Permian producers telling us we're not going to be able to grow regardless of the price because we are running out of acreage. And this year, U.S. production has been pretty much flat. It hasn't grown. And you know, for all the talk of like, obviously, very importantly, the geopolitics, we haven't seen any media reports about how poor non-OPEC supply growth has been this year. We all started the year thinking about 1.5 million barrels per day of growth. We're tracking 300,000 barrels per day only.
Well, we keep hearing from reports that the Saudis are saying, look out, if you don't stick to your allotted production limits, we can produce a whole lot more. Is that the case? Can they just turn on the spigots there and flood the market?
Regardless of whether they can, I think that's the nuance that's getting lost because they're not saying we're going to go out for market share. This is not 2020. They're simply saying to those who haven't been complying, it's not like, let's not get into a free rider problem, right? That we're the ones cutting and you guys are taking advantage of us. So what they're saying is we want to go ahead with the planned increase, which is very small, by the way, like 200,000 barrels per day every month for them, and then some others kind of bringing on a little bit more. But that's what they're talking about. They're not talking about going to 12 million barrels per day and flooding the market at all, because nobody wants to create that massive kind of downturn in prices, then eventually that leads to a spike in prices. They do want some stability. It's just kind of saying, well, if everybody doesn't pitch in, this is what you're going to get.
And you started talking about the demand picture with China, and we have seen stimulus there. Do you think that will be effective? Do you think we'll see a big demand surge when it comes to China, or stabilization, improvement?
Surge is not, it's a strong term, I'd say, right now. And I think, to be honest, one of the biggest reasons why oil is where it is on the demand side. Chinese demand has been weak. Really, this is the first year we're expecting refinery runs in China to fall year on year outside of a COVID year. So it does tell you kind of the struggles there. But I do think the stimulus is important because at least the government's saying, okay, yes, it's not on its back foot anymore. It's kind of saying, yes, we're going to at least backstop the economy. We do think the worst is behind us. It stabilizes the economy. Some upside, but I think we'll see it in 2025. There's still a lot of housing inventories to go through before, you know, construction can really pick up.
Rita, thank you.
Thank you.
Good to see you in person.
Likewise.
Okay. Coming up in just a moment, a closer look at Boeing and if the company can actually stage a turnaround. We're going to discuss it and debate it. Don't go anywhere. You're watching Squawk Box, and this is CNBC.
automakers.
Boeing shares are lower this morning and down more than 40% year to date. The company now plans to cut 10% of its workforce, or 17,000 jobs, as the machinist strike enters its fifth week. Joining us now with more on Boeing, Ken Herbert, RBC Capital Aerospace and Defense Analyst. And Ken, it's kind of, other than Boeing, it's like the best of times in the industry, worst of times for Boeing. It's really pretty astounding, the dichotomy between aerospace and defense and then Boeing at this point.
It is. It's frustrating and yes, very interesting. You see incredibly strong demand for travel, which has resulted in very strong demand for aftermarket spending, which obviously benefits a lot of companies in the sector. I would just comment, though, that it's not just Boeing that's having supply chain issues and obviously a strike, but there are supply chain issues impacting other companies. But clearly, the outlook for defense is relatively robust, I would say, and those stocks, I think, have some opportunity as well. So, interesting time we're in, and let's hope we're hitting the bottom here and things can start to look better into 25.
When we talk about Boeing, though, whether it's deliveries or production or any of the things that you need to try to analyze the financials of the company, can you do any of that right now with the strike where we are?
It's a challenge. I mean, obviously, the free cash numbers in the third quarter with the pre-announcement on Friday, probably not as bad as everybody feared, just because I think there was some decent delivery activity in the quarter. The strike obviously started middle of September. I think there's really 2 points I would make. First, yes, understanding the cash impact now of the strike, ultimately what Boeing will have to pay is a challenge. I think most estimates, we would agree, are sort of the $1 to $2 billion a month in terms of the free cash flow impact from the strike. Having said that, that's why I think the announcement on Friday was helpful with some look at the broader cost structure and look at the ways, obviously the new CEO is able to start to take cost out, but then I think more importantly, it's really about giving investors confidence that as we come out of this, the $10 billion in free cash that the company had outlined back in 2022 is actually still an option. It's just clearly getting pushed to the right. So I think that's the most important thing, is we need to increase visibility and confidence and how the financial situation could look as we get through the strike and as the industry continues to recover.
If the strike ended and they go back into, what Boeing was doing before the strike, what about the 17,000 workers? Were they always expendable? I mean, if you get rid of them during a strike and then the strike ends, you're missing 17,000 workers, or did you not need the 17,000 in the first place? I'm confused.
Great question. I think you would say two things. One, there's clearly a lot of these people coming across other parts of the organization, that are maybe not as directly impacted by the strike, which reflects maybe there was just some opportunity there to take some cost out. Second, and Boeing's been very upfront about this, Boeing has kept sort of an elevated workforce through the crisis to be in a position to support, obviously, future rate increases when they layer in. So I think this also reflects just maybe incremental timing risk when you think about sort of the planned production and delivery increases out of the commercial side of the business.
How long will we think about Boeing being sort of out-competed by Airbus? How can they get back their mojo if they settle the strike and, Ortberg, improve safety and every quality, whatever needs to be done? It just seems like it's turning around an ocean liner in a very small area. I mean, Airbus probably be the benefit of this for at least a couple of years.
Yeah, I mean, unfortunately, these bets take years to play out across the cycle when you think about the product portfolio, and Boeing is still certainly struggling from the impact of the MAX and the 2019 grounding. So if you look at the narrow-body marketplace, which is the MAX and the A320 from Airbus, I think that has fundamentally reset at a 60-40, 65-35 advantage for Airbus, and those tend to be the most profitable programs. So I think though Boeing can get its mojo back as it just starts to demonstrate some continued execution and deliveries on the MAX. On the wide-body franchise, Boeing continues to enjoy a strong position in that market. Boeing's always had a strong position, certainly in the freighter market. So there, it's basically sort of equal footing relative to Airbus, maybe even a little slight edge still to Boeing. But obviously on the MAX and the A320, we have seen a structural reset there in market share, which of course, incumbency is very important in this industry. And then as you think about down the road, future aircraft, it gets much easier to sell a replacement than to convert a new customer. So there has been a reset, but doesn't mean Boeing can't hit their cash flow targets.
I mean, Ken, that's the big question I was going to ask. I mean, there are customers who are set in their ways. They have set up their entire operation to work with a Boeing infrastructure. Are there any customer defections you've heard of or rumblings to that effect? Because that would be a much bigger game changer that once that's gone, it's probably really hard to change it.
Yeah, you're right. Switching costs are incredibly expensive for airlines. There's always rumblings, and I think a lot of it is airlines like to negotiate in public. They love to have the ability to play Airbus off Boeing, and that's nothing new. That's been going on for years. So I'm not aware of any large customers yet that have significantly defected or are planning to defect. I mean, keep in mind, I think the MAX, obviously with the changes, is a good aircraft. When I say good aircraft, it's delivering the efficiencies to the airlines in terms of fuel savings and cost savings. So obviously airlines are having to wait much longer to get the aircraft, but I think the aircraft is performing in the marketplace. So your risk for Boeing right now is you just don't have the slots and you're under-promising or over-promising and under-delivering relative to when you can deliver the airplanes. But switching costs are very expensive in this industry.
Great. Okay, Ken Herbert, RBC Capital Aerospace and Defense Analyst.
Thanks. Have a great day.
You too.
It's 8 a.m. on the East Coast, and you are watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. Among today's top stories, private equity firms TPG and Blackstone are working on a joint bid for eye care company Bausch & Lomb. That's according to the Financial Times, which says offers could value the company at up to $25 a share. The FT says TPG and Blackstone have been interested in Bausch since before it went public back in 2022. We're also watching shares of satellite radio operator SiriusXM. A new filing shows Warren Buffett's Berkshire Hathaway bought about 3.6 million shares from the company from mid to late last week. Berkshire now owns nearly a third of the company's stock. It bought quite a bit this year through purchases of the tracking stock, Liberty SiriusXM. And an impressive sight in South Texas this weekend. SpaceX catching a booster rocket for its Starship vehicle in a test that the company hopes will put it on a path to reuse rockets to get to the moon and Mars. Mechanical arms called chopsticks caught that rocket. We're going to talk about this later this hour with Elon Musk biographer Walter Isaacson.
Meantime, take a look at the futures this morning. Got some red on the Dow, about 85 points off. The NASDAQ, though, looking higher, 47 points higher. The S&P 500 up about 6 points. The bond market, we should mention, closed today for the holiday. Despite this being a spooky season, markets have found little to fear this month, at least so far. For more on all of this, I want to get down to our own Mike Santoli at the New York Stock Exchange. Mike, we're only midway. We're midway through October, so unfortunately we still have got a couple weeks to go.
No, absolutely. I mean, there's always the opportunity for further payback. I do think, though, that this is how the market trades, Andrew, when you're kind of anticipating some volatility, but the fundamentals have been strong enough to really support things up almost 1% in the S&P month to date. And it has slowed down. I keep pointing out over the last 3 months since mid-July, that peak, we're up about 2.5% of the 22% year-to-date gain. So clearly it's become a little bit less generous, a little more sector rotation below the surface, but you have a Fed easing into an earnings upswing. You have most of the incoming data confirming the soft landing hypothesis. So anything about seasonal or pre-election or geopolitical potential volatility seems to be kind of overcome by those fundamentals. So you see we've actually kind of clicked to another new high, 45 of them this year. Take a look over the last 2 years. Of course, this past weekend, as many have said, was the 2-year anniversary of the start of this bull market. It was the 13th. We had the intraday low. That was yesterday. Here's the S&P versus the emerging markets ETF. It's all emerging markets. And then the Russell 2000 small cap. So you see emerging markets have traded like American small cap stocks over that 2-year period of time. Now, there's been a lot of talk that the Fed easing is maybe the medicine needed, and maybe a broadening of the economic growth and the earnings growth picture could help. But, you know, if you own an index fund, the S&P 500, you don't really care. You're up more than 60%
in 2 years. So you can actually see some of that clenching up that anxiety in the volatility index, which is unusually high for a market that's been calmly hitting new highs in the S&P 500. We're up here around 2021. Usually you would expect this to be 15 or lower, but of course it's that seasonal hedging, and that really is all it is. It's just like bid for volatility protection over the next few weeks until we get through the election. You can look at the futures. It goes away after that. So whether that's a legitimate concern or it's just kind of a hey, you never know, because people are otherwise, I think, involved and generally exposed to this market and think that the year end is going to be strong. So it's kind of funny that we're sort of showing some anxiety in the form of the VIX, but it's not really evident elsewhere, Becky.
Mike, thank you very much. That is exactly what our next guest seems to think. For more on the markets, we want to bring in Marianne Bartels. She's the Chief Investment Strategist at Sanctuary Wealth. And Marianne, you do think that we're going to get to 6,000 on the S&P 500 by the end of the year, but it may not be a smooth ride between here and there.
That's correct. I mean, there could be some investment inertia. You are seeing some hedges, as Mike just pointed out. So we could have a little bit of volatility, but I don't think investors should really be concerned about that. I still think, with the Fed now recalibrating, going to an easy monetary policy, the economy's still growing. We're at full employment, albeit employment has been slowing. But more importantly, corporate profits are growing. And, it's early in the earnings season, but so far, earnings are beating by 5%. So I think the investment outlook and the fundamental outlook and the technical outlook all align. That's going to allow the market to continue to rally as we go into November and December. And yes, we do think the S&P can reach 6,000.
And we did get a step closer to that on Friday with a new close above 5,800 for the first time, 5,815. So that target is looking less and less distant. Mary, we had Tom Lee on with us earlier, and he thinks that the market could behave a little bit better if it looks like there is going to be a clear winner for the presidential election. He said markets don't like uncertainty. They don't like neck and neck races. Would you agree with that?
I would 100% agree with that. I'm not sure, though, whether or not we're actually going to get that clarity. But what I've been saying is once we know who the declared winner is, I think there can be a relief rally, that the market finally knows who the president of the United States will be. And the concern is not just here in the United States, Becky, it's also overseas. Overseas investors are also very concerned about this election. So it's not just domestic investors that can buy the market. I also see foreign investors having the ability to come here and continue to invest.
Let's talk a little bit about the Fed, because obviously that's one of the huge issues that you pointed to too. CPI and PPI were a little hotter than expected. If the Fed decides that it's going to go on pause, what does that mean for the short term? I realize longer term we may still be headed in that same direction, but if it puts a little bit of uncertainty back into the picture for investors, what's the reaction?
Well, that's where you get the bucking bull, right? That's where you get a little bit of that volatility, but all it is the bucking bull. In fact, our year ahead thesis was that both the fixed income market and the equity market were going to both have positive returns, but you were going to buck getting there. So it's just a little bit of bucking, but the trend is clear. The trend remains up.
And you would buy any dips, not just buy any dips, you'd buy now, even when we're up 9 out of the last 10 sessions.
I absolutely would. And, if you look at the NASDAQ and you look at technology, they're still in that consolidation phase. The NASDAQ hasn't hit a new record high. I still believe that technology is the leadership of this market and that semiconductors remain the leader of the pack. So if you're looking to actually get into technology, I do think that this is the right time to invest.
Okay, Marianne, thank you.
Thank you.
And coming up, Netflix, one of the biggest reports we're waiting for this week as far as earnings. Investors looking forward to that. After break, we're going to talk about what to expect with Puck's Matt Bellany, and also get his take on the historically painful second week for the Joker sequel. Stay tuned. You're watching Squawk Box on CNBC.
Welcome back to Squawk Box. Netflix set to report third quarter results after the bell on Thursday. Shares are up nearly 50% this year. In the fourth quarter, investors will be paying particularly close attention to 2 NFL games that Netflix is streaming on Christmas Day. Join us right now to talk Netflix as well as Joker's fall at the box office. We mentioned that earlier. Disney's recovery from Hurricane Milton and so much more. Puck's Matt Bellany. Good morning to you, Matt.
Morning.
Let's talk Netflix first in terms of what you're expecting on the earnings front, but also maybe you can get into what you wrote about in the newsletter recently, this brouhaha over Netflix's business model, which is effectively potentially preventing it from acquiring and getting access to certain films that now want to be back in the theaters.
Yeah, I mean, first of all, I think on earnings, I think everyone's looking at subscriber growth. They're looking at growth in the advertising tier because that's a crucial metric. And also they're looking at engagement. I mean, that's the metric that Netflix is looking at most closely is what are people watching? How much are people watching? And is that number going up after the password sharing brouhaha? Now, on the front of whether they're going to be able to get the top projects, this is a real issue for Netflix. On the film side, we're not talking television, we're talking film, where Netflix is trying to compete with the major studios. They have a real problem because the top filmmakers still want movies to go to theaters. And Netflix, unlike Amazon, Netflix is saying theaters are not our model. They experimented with putting movies in theaters. They are just not going to do it. And we're seeing on this Margot Robbie movie, there's an adaptation of Wuthering Heights that is in the market right now from the director of Promising Young Woman and Saltburn, with Margot Robbie going to star in this. And Netflix really wants it. They're offering $150 million for this movie. And Margot Robbie and the filmmaker have not decided whether they want to go to Netflix because of the theater issue.
Let me ask you about the NFL for a second in football. How much of that is a play on engagement, literally just trying to capture users who are already subscribed and prevent churn? How much of it is an attempt to try to capture new subscribers that maybe aren't on that platform already? And are there enough of those?
Well, I think it's both, but I think especially on the latter front, there is a cadre of people out there. We've seen it with when Peacock had an exclusive NFL playoff game. We've seen it elsewhere on Amazon as well. There is a cadre of people out there that will follow the NFL wherever it goes and perhaps may not be subscribed to Netflix because they don't see themselves as, wanting scripted content or wanting reality shows. And they think that those people will subscribe specifically, it'll push them over the edge. But it's also an engagement play. I mean, Netflix has a huge initiative around live events. They're not even calling this sports. They're still saying that they're not in the sports business because they don't have one of the big major sports packages. This is essentially a stunt, using the NFL on Christmas Day to lure people over and to have people sign up or tune in just for these NFL games.
Right. Let's also talk about this past weekend, the Joker, a disappointment, I think now 2 weeks in. I think it's hard to say it's not. What happened here?
This is an example of the largesse that a film studio will give to a filmmaker when he grosses $1 billion with his first film. That first Joker, Todd Phillips, took a big swing. It hit in every possible way. And they said, you know what? We're just going to let this guy do what he wants. The first one cost $60 million. This one cost $200 million almost. The first one went to the Venice Film Festival and won the festival. So they say, okay, let's take this one to the Venice Film Festival. The reaction was not good. The fans are not liking it. And it's a real miss. This was supposed to be a layup for Warner Brothers Discovery. This was not the movie that they were supposed to worry about. Now it's going to be a gigantic loss. Theaters are being dragged down by this. The box office is down big percentages year over year. And it's just a total debacle in every way.
Let me ask you about 2 other films that I've been very curious about. One is about SNL, the creation of Saturday Night Live. Has not performed at the box office, I think, the way some people had hoped early on. And then there's The Apprentice, which is a movie looking at the early days of Donald Trump.
Yeah, both those movies really struggled this past weekend, both under $3 million. I think The Apprentice was about 1.5 million at the box office. That The Apprentice might set the record for the most earned media, most media coverage of a movie that grossed the least at the box office. People just did not want to see Donald Trump. If you don't like him, you don't want to see him in theaters. If you do like him, you're not going to see this movie because he didn't endorse it. So it sort of left it in no man's land out there. And as for the Saturday Night Live movie, I thought it was terrific. I think it's just a real challenge to get people to see movies about television in theaters. I predict this movie will do very well when it hits Netflix early next year.
And then finally, Disney and the parks down in Florida. What do you think the impact is going to be?
Well, they are certainly feeling like they dodged a bullet at Disney. They think that, yes, they're obviously they closed and there will be some damage, but they don't think that the hurricane will be a big factor on the overall parks trajectory. The bigger factor is simply the economy and simply the recovery or the sort of anti-recovery from the post-COVID surge. And I think that's what investors are watching at the parks. It's been such a profit center for Disney over the past 2 years. And if that comes down while they're still trying to turn the streaming service into a profit machine, that's going to be a real problem.
Matt Bellany, the newsletter from Puck. It's awesome. Really appreciate it.
Thank you, man.
Becky?
Thanks, Andrew. When we come back, what kind of edge does AI provide to professional traders who can afford to deploy it effectively? We will talk about that next. Then it's been a busy few days for Elon Musk. First, he went all out for former President Trump at a rally in Pennsylvania. Then Tesla unveiled its robo-taxi and the shares promptly tanked. Then SpaceX pulling off a daring mid-air rocket catch over this weekend. We're going to talk about all of it with Musk biographer Walter Isaacson. Stay tuned, you're watching Squawk Box, and this is CNBC.
Welcome back to Squawk Box. Futures about where they've been for most of the pre-market session. Dow is a little weaker, off about 86, but the Nasdaq a solid. S&P up a little. In the Dow, S&P, and Nasdaq coming off their fifth straight positive weekend with bank earnings kicking off last Friday. The financials saw their best day since all the way back in November.
Meantime, I want to talk about how things have ended in China today. The country's CSI 300 index up close to 2%. Chinese property stocks jumping today after Beijing laid out more support measures for that sector, I should say, over the weekend. But a press briefing now by China's Ministry of Finance seeming to underscore how officials are focused on tackling local government debt problems rather than stimulus that investors are hoping for. Separately, new data showing today that China's imports and exports both missed expectations last month. Joe, I don't know how that would fit into this sort of David Tepper modeling of all of this.
Yeah, and it's a long way for us to know exactly what's happening over there. And you know what? It'd be nice if I keep checking. He hasn't told me, whether he's got any updates. Have you heard from him at this point?
I have not. I've been waiting by my phone.
Yeah.
I was looking at my phone before.
Short term, it was a great call, great move. I don't know what long. And then if you listen to Kyle Bass, he says you're picking up dimes in front of a bulldozer. Right. Wall Street. We talked to one guy who has trying to use AI to pick stocks, and it's called like the Livermore Fund or something. Remember the guy who lost all of his money and was I think he killed himself. Wall Street hedge funds are competing for an edge using AI, finding new ways to try to beat the markets. Kate Rooney joins us now with more on that story. My question was, is it just Gigo? It just seems like there's so many ways to try and beat the market. Is this maybe someday? But think if it got AI as smart and sentient as humans who still can't do very well beating the market. So I don't know. Right? You'd have to be better.
Garbage in, garbage out, right?
Right.
Yeah, you got to make sure the data that goes in is really good and that you train these the right way, Joe. But portfolio managers are increasingly turning to AI. I've been talking to a bunch of hedge fund investors who are using it at this point. Some are spending millions to build out these proprietary large language models and are at a point where some are trusting it to execute trades with almost no intervention. They argue there are certain things that AI can just do better that can't be matched by human traders. They're using it for algorithmic trading. It can measure sentiment of news articles, of earning transcripts in real time, and it can help analyze hundreds of pages of financial documents or spreadsheets. It helps with technical analysis as well, things like pattern recognition. And this technology's superpower, as one person told me, is avoiding the emotional pitfalls of investing. This person says it's helped avoid FOMO trades, so fear of missing out. Although this person did say, well, it's really good at picking names, AI right now is actually not as good at getting out of certain investments. There are some potential broader market implications as well. So some pointed to the quant quake back in 2007 when hedge funds started using the same models to pick trades and then crowded into the same positions and then blew each other out, and that caused some major volatility. There is a risk that AI is also becoming so common on Wall Street that advantage really gets competed away. So all of this, of course, raises the bar for retail investors. These institutions, sometimes called the smart money, now pouring millions into AI. As one hedge fund manager told me, quote, "It is not a fair fight for retail, especially for some of the more active traders out there, guys."
Because we talk about all the different AI models, and they are similar, so I don't know why they'd come to a different conclusion. If they didn't, then they'd all be doing the same thing, and it'd be very similar to when everybody was piling into, using similar strategies in 2007, as you mentioned.
Yeah, so it all comes down to the way that you train these models, Joe. So somebody talked about using certain parameters, but say you want to train a model that invests exactly like Charlie Munger, for example. Some people are saying, hey, we've got sort of these proprietary ways we do things. We're training our models in the same way. So others have argued, hey, these are all going to look slightly different because there's so much training that goes into them that can kind of specialize and make them look different versus just all using the same exact sort of off-the-shelf models. So you're hearing hedge funds, investment banks also using it, and some are actually coming up with their own models. So there is a slight difference, but I think one of the risks is, yes, that they all come to the same conclusion, buy the same things, and then we end up with a lot more volatility. But I think it is a bit too soon.
AI.
AI.
They have like an intuitive gut that says, I'm going to rip up what I've always thought was true and change it based
Well,
on.
that's where you, instead of just trading by machines, which we've seen, this is not new. Machine trading, and most of the trading we see now is machine trading, and it based on algorithms, and it already does that. So I don't know how this, unless it takes that next step to analyzing something or gut feeling, unless it does that, it's just machine trading called AI.
AI.
Direction. So generative AI.
AI.
The advent of ChatGPT was sort of
It's AI.
where these have changed. They've become a lot
damn
more
you,
powerful.
AI.
Hedge funds and banks
How
have
dare
been using
you.
machine learning for years, and so have a lot of tech companies. They've said, machine learning or ML has been around for decades. Generative AI is allowing them to do different things, come up with different ideas, generate new investment ideas, and so they're saying that added power is helping a lot. But you're right,
But it's just that,
trading.
that switch. Yeah, I mean, it's just that switch where
Just give
everything
me
I've thought was
AI.
true to this point is no longer true. How does generative AI really get to that point where they say, okay, my answer is wrong, my thought process is flawed, and here's why, and by the way, I'm going to rip up all of my investments as a result?
It depends on who you talk to. So some are saying absolutely, and they've had to avoid having any sort of intervention and saying I need to trust AI because the emotional
AI
is taking over, and I'm saying, okay, I've either got FOMO or there's some sort of macro headwind that is not as big of a deal on the surface, but it's scary from a headline perspective. Folks have said it's helped them look a bit more objectively at certain trades. And so oil and China are one that I know Doug Clinton brought up with you guys. So there are certain trades that people have said, I would not have come up with that.
Just give you AI.
But again, it's becoming so commonplace that I think the bar is...
I can't stand you,
I think
AI.
the alpha, the edge is getting competed away in some cases, where this is sort of becoming the norm.
Have you seen my latest AI girlfriend?
Even better than AI at this point, but it's raising the bar for everyone, including retail, where it's hard enough to beat the market, but...
Today's word of the day is AI.
Well, it's not quite a zero-sum game, but once AI knows how to figure out the market, I guess we'll all be able to get 40% a year, and everybody will be rich, and we'll all be billionaires because we'll all be using AI, and we'll all be beating the market. Then who's losing? Anyway, Kate.
We'll just all buy an index, yeah.
Thank you.
Excellent.
Yeah.
All right, coming up, are we finally able to pinpoint what kind of landing the economy is making, or if it's making a landing at all? Former Fed Vice Chairman Roger Ferguson will join us for that conversation. And then Elon Musk biographer Walter Isaacson joins us to talk about a very busy few days for the Tesla and SpaceX.
AI.
Reminder to you, as we head to a break, you can always watch or listen to us live, or listen to us using the CNBC app. Stay tuned. Squawk Box will be right back.
AI. gonna be a good day. Oh, yes, it is. Gonna be a good day. Let me know. Gonna be a good day. I'm gonna make a cup of coffee. I want it to be fresh. On my way to go. I'm coming in early to get the job done. No more lollygagging out in the sun. James, is it true that you were once a musician? Yes. Is it true that you were once a stand-up comedian? Yes. Is it true that you were a president? Yes. Everything I hear about you, is it true? No.
Welcome back to Squawk Box. I want to show you the futures right now. You're looking at the Dow off, 84 points right now. The NASDAQ looking up is up, though, 57 points higher. The S&P up about 8 points. We should mention bond markets. They are closed for the day for the holiday. But let's also show you something that's not closed, which is Bitcoin. Always on, 24 hours a day. Now sitting just under $65,000. You're looking at $64,855.
Okay, Andrew, thanks. Investors still digesting inflation data as we begin a new week on Wall Street. That latest CPI number is coming in slightly hotter than expected, but wholesale prices showed no change last month. They pointed to continued easing in inflation. Joining us right now to help us decipher all the recent signals is former Fed Vice Chairman Roger Ferguson. He is former president and CEO of the IAA. He's now vice chairman of the Business Council and a CNBC contributor. And Roger, let me just ask, if you were sitting in that FOMC meeting that takes place at the beginning of November, what would you vote? How would you deal with things at that point, based on the numbers that we've seen recently?
Well, look, I started with the last time I was on, we were talking about this, I thought that the first move should have been 25 basis points, wouldn't have dissented at that point. I think they're still in a process of easing, which I think is probably on balance correct. You're right to say that the most recent, some of the most recent inflation data were a little hot, but not dramatically so. And we've heard from a number of them that basically said something I agree with, which is the path back towards 2% is going to be somewhat uneven. So I think the better move would be at least one more 25 basis point reduction to move closer to neutral, and then we'll see where we are.
You would not have dissented. There was one dissent, Michelle Bowman, who did dissent, said she didn't want to cut 50 basis points. It sounds to me like there has been more vocalization from other Fed governors, other voting members who say that they would not like to see this anything other than a gradual move on these things. You're right, it's probably working around a consensus, but it did look like in the minutes that the Fed chair, Powell, maybe put a little more pressure on people to get to that 50 basis points. How does that generally play out when you are trying to build consensus?
Well, look, I read the minutes pretty much the same way you just did. It was a very complicated discussion, we'll put it that way. They did eventually reach a consensus, but I suspect there are many folks who were, not totally comfortable with that consensus, and you've heard some of that coming forward. Having said that, I think there's a general consensus that all of the participants shared that policy is in restrictive territory. Inflation had been coming down and continues to gradually come down. Labor markets are in better balance. And so at that point, it's a judgment call. Certainly time to moving a little quicker earlier. I think most people would say, if that's the chairman's preference, then we'll go with it. We've since heard from a number of people that they're willing to continue to move gradually. And so I think that feeds the general notion of more 25 basis point cuts, not 50 basis point cuts going forward.
Is the possibility of a pause on the table or not at this point?
I don't think the possibility of a pause is actively on the table based on the data seen to date. Now, recognize there'll be more data that come in, but there was some discussion of that with some other participants in the public. And I think Raphael Bostic suggested he might be open for a pause, quote, if the data suggests that's the right thing to do. A couple of other policymakers, I think Governor Chris Waller, President Williams from New York, both sort of shrugged off the pause notion, suggesting that the data was always going to be a little uneven. So I think there's not much consensus for a pause right now. That may emerge over time, but based on the data thus far, I suspect most people are going to go into the meeting thinking 25 basis points is the next thing.
Roger, we had a conversation earlier this morning about just how restrictive rates are at this point. The economy's doing very well, even where things stand. There has been demand from business as rates have come down. It doesn't feel like restrictive territory that some of us who are older have gotten used to.
I understand that. One could look at the Atlanta Fed GDP now forecast for the third quarter, which was as of a few days ago, I think October 9th or 10th, and that number was roughly 3.2%. No one thinks that, very few people would imagine that potential growth here is 3.2%. All of that feeds into the question you just raised, which is exactly how restrictive are we? And that's the reason I think to be pretty cautious and prudent here and move pretty slowly. And you'd see on the committee quite a range of views on where they're likely to end up, which is another sense that no one really knows quite what the so-called neutral rate is or how far we are away from that elusive notion of the neutral rate. So moving gradually, being open to a pause if the data disappoint, I think is the better approach for the next couple of meetings.
Tread lightly. Roger, thank you.
Thank you.
Coming up, it's Elliott Hill's first day on the job as the CEO of Nike. We're going to talk with an analyst about what the new leadership could mean for the company. But next, Elon Musk biographer Walter Isaacson weighs in on yesterday's achievement by SpaceX. The company caught a booster, a rocket booster, as it descended to the ground. Speaking of Musk, Evercore raising its price target on Tesla this morning to $195 from $145. Hey, thanks for that. Thanks for that. Okay, it's at 219. The analyst sees something he likes there. Since he had a $145 price target before, now he's at $195. Stay tuned. Squawk Box will be right back.
We're now down to 3 Raptor engines. We can see those chopsticks now.
That was the first stage booster of SpaceX's Starship being caught by mechanical arms known as chopsticks. That was yesterday at the company's launch pad in South Texas. It was another test on the way to what SpaceX hopes is reusable vehicles for getting to the moon as well as Mars. It capped a busy few days for Elon Musk, who also unveiled Tesla's Cybercab last week. Joining us now on all this, a man with really quite a storied background who we now call Musk biographer, Walter Isaacson. It's come to that. Well, actually, you're a Perella Weinberg advisor, advisory partner, and a professor at Tulane University. You've had, biographies of some of the greatest men and women in history, and CNN and so many other things. But Elon Musk is a big enough person where his biographer can be Walter Isaacson in his own right, and that's okay. He's such a bigger than life character, and we need you to talk about him a lot.
Thank you, Joe. It was totally amazing to see those chopstick arms come on in and catch that booster. It's the largest rocket ever made, and not only did it land upright, which he's been able to do with his smaller rockets, but he didn't have landing legs. He used the chopstick arms. Nobody has been able to land a rocket upright and shoot it up again and reuse it. But Musk has done it more than 150 times with his Falcon 9. And now with this, he's able to do it with the biggest rocket ever made. I mean, China hasn't done it, Russia hasn't done it, NASA, Boeing, of course, hasn't been able to reuse rockets like that. And as you say, at the same time that he unveiled the Cybercab, running around, picking people up with no steering wheel and pedals, as well as Optimus the robot, which was serving drinks at the Cybercab unveiling. He also has been able to do that private spacewalk where he sent 4 people to the highest orbit we've done in about 40 or 50 years in this new spacesuit he built, and they were able to march. Plus, he's using his Dragon capsule to get the astronauts back from the space station that Boeing left stranded up there. So, and also, even AI, y'all were talking about AI earlier, he's taken XAI and brought it up to near where Google is from scratch.
Yeah, and save the Second Amendment and everything else. I saw some, I don't know what's AI and what's not, but I saw one of the robots, and I think it was an actual video, Walter, but he was kicking a football, actually kicking a field goal, and I mean, it was shocking to me to see that the moves that it made after it kicked it to stay balanced looked almost identical to the same moves that a human would make. It somehow they've programmed in exactly how the weight gets distributed after you make that move to be able to stay on its feet. It was that was mind-boggling to me too. I
remember 2 or 3 years ago being there as Optimus was being developed in the Tesla back studios. And you had to look to see, okay, the risk is actually, it's metal. It's not a real person. Because he's made it a little smaller than a human, but humanoid. And you're right, it's able to do things like, I remember when he was trying to figure out the fingers, and he was saying, how many degrees of rotation, how many digits should you have in each of the fingers? Do we really need all 5 fingers? And those hands are more dexterous than my hands are now, like maybe not saying much.
I don't know what we should be more impressed with, what evolution did in a couple of billion years. I mean, we are comparing it to what we do without even thinking about it, but so I guess both are marvels of both time and the double helix and everything else, the way it works. Walter, is Waymo and was it disappointing? Is it not or had the stock already run up? I mean, how do you read the robo-taxi introduction? The stock
well, let's compare it to Waymo, which is doing quite well, but Waymo depends on maps and being in a circumscribed area where each part of the road has already been plotted on a map. The thing about Tesla is that it can do it anywhere because it's done through the cameras, and that is pure artificial intelligence. It's 1 billion frames of video per day being analyzed so that a car knows how to do what a really good human driver will do. So I think that's much more important than being able to say, okay, we'll do it in this part of San Francisco or in this area that's been mapped off, because that doesn't make a car very useful. I think Cybercab and when eventually, I mean, Musk way over promises, especially with the timelines on self-driving, but in a few years when you truly get unsupervised full self-driving, it transforms transportation on this planet.
I've seen comments across the political spectrum about Elon Musk, and there's some people that want him to be even louder and more, I guess, controversial. But there's other people that really he's driving them, some of them, crazy. And regardless of his accomplishments, they can judge him and disparage him totally based on appearing at a Butler rally with the candidate that they don't like or not their preferred candidate. He doesn't give a rat's patootie, I don't think, about what people say. Does he, Walter?
No, in fact, I wish he would give a little bit more of a care about what other people say. You and I are probably in different camps on this. I think that it would be really good if he would put down his Twitter feed for a while and not be as incendiary and divisive as he is politically. I think it's hurting Tesla car sales. I think it's distracting, as you say, from the sort of astonishing accomplishments of the past 2 weeks. But when you ask about Musk, most people say, oh yeah, he jumped up and down at the Butler rally. I think all of that, I mean, I think that's ridiculous, but he doesn't really care. He's, even his Tesla board of directors, even his brother, is like, calm down, get off the politics kick, because it's certainly hurting Tesla. You look at the California Coastal Commission that has to decide or recommend whether or not he can launch rockets from Vandenberg Air Force Base, as they've done for 20 years. And as they're voting to maybe deny him the rights to do more rockets from there, one of the commissioners says, well, I've been reading his tweets, and it's bad politically. He's saying these horrible things. I think that's wrong to figure out whether you should shoot a rocket from Vandenberg based on the guy's tweets, but I don't think it helps him to do it. And even though I think you probably get excited by all this politics stuff, I find it really off-putting.
Yeah, I think you give me 100, take your pick. De Niro's, Jennifer Garner, give me one Elon Musk. You got a point. Look, Elon Musk. That's what if I was Trump, that's probably all I'd say. Elon Musk.
Well, I think one of the things you and I
rest my case. Smartest, richest guy in the world, unequivocally thinks this is an important election and thinks that it needs to go. That's all I'd say. I'd end all my campaign ads on that. And I'd probably say something, what do you think of that, Walter? And probably just tweak you at the same time if I were to.
I would say that you could be really, really smart in some areas and really divisive and problematic in others. I mean, the thing about writing about Elon, you got, in my opinion, a very dark side to him. You have this amazing genius to him, and it takes, I mean, Shakespeare tells us, we're molded out of faults. Even our heroes, like Henry V, kill the prisoners, but I find it would be much nicer if Musk could focus on rockets and focus on cars, focus on AI.
That depends on where you're sitting, exactly as you say. We all have a dark side, I think. Anyway, thanks, Walter.
Whoa.
Okay.
All right, news on Southwest Airlines. Leslie Picker joins us right now. She's got more on that. Hi, Leslie.
Hey, Becky. Yeah, it's official. Elliott announcing this morning that it is officially planning to launch a proxy fight at Southwest Airlines. The firm has about an 11% economic interest and therefore is able to call a special meeting of shareholders. In the press release that crossed just moments ago, Elliott says it is intending for that special meeting to take place on December 10th, 2024, so just a little under 2 months from now. And the firm says they will be filing an accompanying proxy statement with the SEC. In this statement, the firm says that after exhaustive attempts to persuade Southwest to implement the necessary governance changes. We are formally calling a special meeting to give shareholders the opportunity to elect a completely independent, best-in-class slate of director nominees. The firm has nominated 8 such directors to the Southwest board. Becky?
Okay, Leslie, thank you. When we come back, we're going to talk about the new chapter for Nike that begins today with a new CEO. Stay tuned. You're watching Squawk Box. This is CNBC.
Oh, interesting.
Welcome back to Squawk Box. Today is the first day of Nike CEO's new job on the job. Mark Elliott Hill's first day. Join us right now with what we may be able to expect from new leadership is Barclays analyst Adrian Yee. Good morning to you. Is there a lot that they can do immediately, or we're not going to see the effects of this for another 12 months?
It's the latter. So whenever you have a new leadership come into particularly a retail or a branded manufacturer, you have about 6 months of stuff that's already in the pipeline. So the first, 3 to 6 months is somebody that's coming in to sort of see what they can do to change the pre-existing conditions of the business. Once they make those changes, sort of after that 3 to 6 month period, the horizon for when that impact is actually going to be felt is 6 to 9 months hence. Having said that, Elliott Hill was a 31-year veteran of the business. He doesn't need a lot of coming in and kicking the tires. He knows exactly what's wrong with the business. So to the extent that he can immediately start telling to stop doing things that are wrong, that's just as valuable as trying to figure out what to do right.
Okay, but we have only about a minute, real quick. Does he throw the kitchen sink at this thing? Meaning, is the next quarter just going to be horrific? They basically get rid of all guidance forever, and just because he wants to put it all down there. And then two, when it comes to innovation, part of the whole argument here has been that they spent too much energy, resources, money on Dunks and Air Jordans and what might be described as fashion sneakers at this point.
and less on the innovative stuff. That's why Hoka and others have come on strong. Can they fix that? And is that something that's fixable quickly?
The latter is, I'll just answer that quickly. It's not fixable quickly. It is fixable over time. They have to reinvest back into R&D and demand creation. To your prior question about whether they're going to kitchen sink it, they just kitchen sinked it. However, they kitchen sinked it under the pre-existing status quo John Donahoe strategy. So the answer is maybe not next quarter, but something he's going to come out with a completely new strategic direction for the company for sure.
Right. Okay. Adrian, we want to say thank you and appreciate you joining us this morning as we try to make sense of Nike. Folks, that does it for us today. Make sure you join us tomorrow. Squawk on the Street begins right now.
Good Monday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Coming off all-time highs, the bull market enters its third year. Futures are mixed. Bond market closed for the holiday. Big week ahead with earnings from Goldman, Morgan Stanley, Netflix, Procter. Our roadmap begins with investors celebrating 2 years of this bull market following another record-setting week for the Dow and S&P.
Plus, we're keeping an eye on shares of Southwest Airlines activist investor Elliott calling for a special meeting. We're going to go over that and give you all the details. Boeing is one of the biggest laggards on the S&P in the pre-market. It announced plans to cut about 10% of its global workforce. That was late Friday. Of course, this as the company's losses mount and that machinist strike enters the 5th week.
Let's begin with the markets, though. Celebrating this 2-year bull run goes back to October 12th of 2022. S&P's up more than 60% in that time period. Jim, record highs for the cap-weighted, the equal weight, industrials, financials.
Not supposed to happen, obviously. We've got a lot of worry. It doesn't seem to matter. We can place a new worry would be Mideast, and yet the oil's down. We had a lot of people who felt that Powell handled it badly, but what seems coming back, we have a remarkable semiconductor round, and it is at the heart of this market. And I would tell you that one of the reasons why it's so great is the dynamism of American capitalism, David, is in semiconductors. It is the idea. Not only are we
it's in the design of semiconductors, not the fabrication of them.
No, the design, because I don't like to see the Chinese doing a blockade. We didn't talk about this one. Chinese doing a blockade of Taiwan, mock blockade.
I mean, it's always worth just mentioning because people who don't pay close attention. NVIDIA designs all those
chips.
We
don't do anything.
But they are all of the highest end chips are manufactured by Taiwan Semi in Taiwan. Now that may change as they open up plants, I believe, in Arizona.
Yes.
But to your point, I don't want to divert here. Dynamism certainly in the design of chips.
Right, and I think that, look, there's things that happen. You'll see NVIDIA's up today. But what NVIDIA demonstrated, and Ben Reich was on this morning from Mellius, but I did a lot of work last week on what NVIDIA did. They did a road show. They came to New York, went to Boston, went to Baltimore. Now, this is a CEO who, if you listen to Renee Haas's excellent podcast this week, says, listen, I'm not an actor. I'm out there doing things. Now, what is he doing? I think the most important thing is that the new Blackwell chip is designed, Carl, for video. Now, video ingested is what you need if you're going to have a self-driving car. Now, there were a lot of people who didn't like what Tesla showed on Friday, but I've got to tell you, they have the technology for the self-driving car that doesn't need LiDAR. You don't have that thing spinning up at the top. You have, I know things were muted with the NVIDIA. With Tesla, but if they had talked more about NVIDIA, I think you would realize they're ahead of Waymo. Waymo's got all three are NVIDIA. You know, you've got the brain in the car, you have the super brain, and you have a training brain. But if you have NVIDIA and Tesla, what you have is a car that knows everything. So that's why I was disappointed in the way Musk presented Tesla. I wasn't disappointed in Tesla.
Of course, Tesla shares trying to recover some of Friday's losses. We do have these reports that some of the robots serving drinks were operating with human assistance, not completely on their own. But you're right, as for NVIDIA, Ben's at 165, and he goes takes pains today to say that this is not Cisco circa 2000.
I thought that was amazing because it's literally in the first paragraph. Listen, it's not Cisco. The fact that he still has to keep saying it's not Cisco, that is a bleep. This is what I'm talking about, David, in the dynamism versus 2000. You have companies that are dominant. Now, you also have companies that are challenged. For instance, Waymo is Alphabet. Alphabet is challenged by the Justice Department, right?
Yes, yes.
But if you notice the free-flowing nature because of NVIDIA chips, what's happening with Meta? I mean, Meta is Meta AI plus Reels, where you can give money to Zuckerberg and design your campaign. And then one of the great comeback stories is Amazon. Amazon has a so-called weak quarter. Stock goes all the way down to 161. It is now well above. Amazon is the company that Jensen kept referencing to me as being a great friend. Jesse.
Well, AWS is certainly a huge buyer of NVIDIA chips.
Right.
Along with so many others.
Now, I know that to be so is NVIDIA.
And they are still the largest cloud provider.
But to be the NVIDIA-centric is not wrong. Because I'm going back full circle to the 2-year anniversary.
Right.
And it's NVIDIA, then second is Supermicro. Now, they were added to the S&P, but that is an NVIDIA.
I knew exactly where you were going, and you're right. NVIDIA's up over 1,000% during this 2-year period. It is the top performer, as you say. Supermicro is second. And Meta, by the way, which you just mentioned as well, Carl's up 363% over a 2-year period, helping provide the fuel for this rally.
On a day where Goldman goes to 636 Meta.
Meta is, if they can get Meta AI right, and Jensen is saying, listen, don't worry, they'll get it right. I mean, this was a goodwill tour by Jensen, and I just keep thinking about the fact that he said to me, it's so easy. It's so easy to be what he's doing because he's so excited. Life is good. He comes in peace. Look at the companies that are not begging, because he told me, not begging. He says, don't worry, we'll get them. But, and then you're talking, Mellius is talking about the next generation, the Rubin. Philadelphia's on.
The Rubin.
Yeah, the Rubin.
That's the
not
next.
the Rubin like you get in Zingerman's in Michigan. I'm talking about the Rubin. The Rubin like a scholar and star, but it's just, it's more of a halcyon time than people realize for our technology. And I think that Ben Righteous is kind of the leader right now. And I know Ben, look, I know Ben. Ben's father is a friend of mine. He's a great hedge fund manager. He was a fabulous chemical analyst, so runs in the family. But I just think that you see so much good there. And then you have this weird 2-year anniversary Palantir, which is a love stock by the...
Well, you call it a meme stock.
Yes, I do.
And then that really upsets some people.
Upset some people?
Yeah,
well, I don't care about them. I can be like Coach Nick Sirianni, and I can just say, screw the fans. The fans aren't what this is about. It's about my kids, so why don't you focus?
Okay, but tell people why you characterize it as such.
Because there was an amazing article in the Wall Street Journal that talked about how Alex Karp caters to the individual, not unlike what Adam Aaron does, except for, unlike Adam Aaron, who does movie theaters,
caters to the individual investor.
Yeah. He creates, but now look, Palantir, I think has good business. I saw the CFO.
Palantir has real businesses
I saw the CFO
that are growing
Palantir
in a significant way.
Our CFO conference last week.
Yeah.
He gave me the Heisman. He said, "Hey, how you doing?"
Well, yeah.
I said, when I asked to sit down with Palantir, you gave me like the guy who covers Kellogg and General Mills. I mean, come on, focus.
When you say something like that, it means that the 439% gain for the stock over the last 2 years, you think is what, ephemeral? You don't think it's sustainable?
I think that it's about Defense Department and special stuff that we don't know about. Black box.
Yeah.
Black box.
Well, that is certainly where the company's was focused for its earlier years, but they've commercialized a lot of the applications
Well,
as
just
well
saying
in
that,
terms
like,
of understanding your data.
Alex is a hard guy to look. I'm friends with Max Levchin, for heaven's sake. If I'm friends with Levchin, I could be friends with Card, but it's just not working out. So I want to focus on Royal Caribbean, which is another.
What comes first? Is it because you
egg
call them a meme that they don't like you, or they don't like you, therefore you call them a meme?
I don't know why they don't like me. And you know what? Kind of not unlike Marshall San Gerard, I don't care.
Or another guy that we know pretty well is also Elon Musk.
A lot of guys these days just don't care about anybody.
I don't care. I mean, Elon Musk, God love him. I like Larry Culp from GE,
From May of
who created more
2023.
wealth than any of these people.
And by the way, look at that. Number 6 on the list here.
Created a huge amount of wealth. I mean, I'm going over, I'm trying to be a little fair, Isaac. That is FICO. By the way, all these companies that are like FinTech, they're FICO. And then, what do we come down to? We've got Broadcom, which is NVIDIA. I mean, what am I going to say? NVIDIA is the backbone of this 2-year anniversary. And unlike Corp, Jensen's a good guy.
And Vistra is
Now,
related
Corp
to it.
might be good.
Vistra
It
is
doesn't like
related
me.
to NVIDIA as well.
Which one?
Vistra, right?
Well, really?
Well,
I mean,
kind of.
because they need the power.
Yeah.
Yes.
Yeah.
So it's NVIDIA is in a data center which needs Vistra.
Right.
So, I mean, look, unless Royal Caribbean, though, I mean, is there anything
That
about
one
Caribbean
not.
and Jensen?
No,
doesn't-
that's
I don't-
not.
he doesn't-
That has nothing to do with
Doesn't
this.
seem to me like he's a cruise guy. I mean, he's a lot of things. He's a chef. He's an architect.
We're going to talk more about how this leads to Goldman upgrading equities and in a falling rate environment, what that means for some of the results we've gotten so far. We do want to touch on China, though. Investors digesting the country's weekend press conference regarding more stimulus. Our Eunice Yoon is live in Beijing with the latest. Morning, Eunice.
Hey, Carl. Well, the government is attempting to send a signal to the market that it does indeed want to support the struggling economy. However, it's left investors guessing exactly what the scale and the specifics of that plan is going to be. Over the weekend, the finance minister held a very anticipated press briefing, or briefing, I should say, and he focused a lot on the need to address the local government debt, saying that these would be the most powerful steps in years to tackle these problems, including like a one-time debt swap program. Also mentioned the effort to address the problems in the property sector, saying that they would expand funding for unsold homes through special bonds that would go to the local governments. And then finally, the authorities had hinted that there would be ample room for deficit expansion, so greater government borrowing. Now, some investors were expecting to hear more. Most people wanted to see a firm headline figure when it came to fiscal spending. However, others saw the briefing more positively. For example, Bank of America called it a policy pivoting point. And of course, there's still anticipation that we could see some specifics down the road in the coming weeks when there's going to be a committee meeting at the end of this month. Now, the divergent views, as you could expect, played out in the markets, both in Shanghai as well as in Hong Kong and in the U.S. now. The need, though, for this effort became more apparent. We had a series of bad market numbers. For example, the core inflation figure was out over the weekend. It hit a new low since 2021. Export and imports figures came in saying that they were going to grow far less than expected for September. And then the credit and bank growth numbers also hit fresh lows. So a lot of reasons for the government to take some stronger action. Guys?
Eunice, we got these possibilities of further stimulus. At the same time, we've gotten reports about government officials detaining Taiwanese manufacturing personnel at a Foxconn plant. Today, Jim mentioned these military exercises, which Taiwan says is a record number of military aircraft, 125.
Yeah, absolutely. And that's led to a lot of confusion about whether or not companies would want to do business here. You mentioned Taiwan. One of the founders of UMC, big chip company, was sanctioned as well. So you have all of this kind of mixed messaging. And in fact, the authorities here just today said that they wanted to help support private business and to try to get rid of, they said, these efforts that sometimes are illegally either detaining people or confiscating goods. Like they want to try to get rid of all of that. And so they said that this is going to help support a private business, but it's, you still need to do a whole lot to get the confidence back up here.
Eunice, back to sort of the question about stimulus and the specifics, as you mentioned.
Stimulus.
What is going to be a sign, or when are we going to know? It seems obviously it's different there than it is here. So what are we really looking for when it comes to specifics? Do you have to wait and actually see the actions take place?
Oh, it's happening, brother.
Well, that's the big question. I mean, a lot of people have been wondering what it's really going to take for the government to come in with bigger action. We know that the authorities here are very concerned about the risks that they have the memory of the stimulus that they had in place in 2008, 2009. After that crisis, they don't want to have to deal again with those big risks. So they have that on their mind, and also there are there's a lot of discussions here about whether or not the authorities here, especially Xi Jinping, has an ideological bent. That he's talked about how he doesn't like welfareism, what he's described as welfareism, so doesn't want to give out handouts. So there's a lot of discussion as to that perhaps that's another reason why it appears that the authorities here have been slow walking a bigger stimulus.
But Eunice, I'm confused to follow up with what David's saying. Look, you can buy back all the stock you want. I don't know how much stock people have there. But it's the apartments that go down makes it so it's deflationary. Unless your apartment goes up, why would you buy an apartment? And isn't the stock market too small to impact China?
Well,
A lot
the
of
stock
people.
market impacts China in the way that people look at the sentiment, right? So, so the authorities here have been jumping in, kind of trying to prop up talk up the market here, and that helps to boost sentiments, which is kind of what they're trying to do, which is to boost confidence here. But as you said, most people don't have their money in the stock market. Very, very few people actually, and more people would be putting their money into the property sector, but that continues to decline.
Eunice, busy weekend for you guys. Appreciate you bringing us up to date. Eunice Yoon in Beijing tonight. Let's take a look at the pre-market here as we get this week underway. We'll get to this downgraded Caterpillar, which I'm sure Jim has some thoughts on. News on Boeing and Southwest and Starbucks in a moment.
Well. Can't wait to see what happens here at open. Do.
a lifesaver.
Elliott is requesting a special meeting for shareholders of Southwest Airlines to vote on what are now 8 nominations it's making to that board of directors, a board that will have 12 seats. So that just gives you some sense here. We've been following this fight for quite some time. To rewind a bit, remember Elliott owns 11% of Southwest Airlines. It's been pushing for any number of changes related basically to oversight, governance, and to its current CEO being
10 minutes left here.
sent away, essentially. And now it is moving forward with the threatened so-called proxy fight. It would be the first one it's undertaken in quite some time. I believe it was 2017, Arconic, when it last actually went to a fight. Remember, Elliott is the most active of activists, but it often ends in settlement. In fact, almost always, as I point out, given it's been some 7+ years since its last time of actually soliciting proxies from shareholders. But that's going to happen here. They're asking for December 10th as a special meeting. They're going to get the meeting because it only takes 10% of shareholders to vote in favor of a meeting. They own 11% of the stock. So that's an automatic. The question, though, is to when the meeting will take place. Let's assume in the next couple of months. And then they're going to be seeking, again, as I said, 8 directors sitting on the company's board. Jim, they will go back and keep saying over and over again, even after the meeting, the investor meeting, in which there was a positive response to many of the plans that were put out there. Their point at Elliott is, yeah, look at that. As longer the meeting went on, even during the course of that day, the less the stock was up. In fact, since that time, certainly Delta has outperformed Southwest. And when you go back 5 years, you can also see the lack of performance versus its peers. I thought we had some of those stocks for you as well.
That's all right. Well, I'm ready to talk about it.
And you know, they continue to want. There it is. That's 5 years. We also had since the meeting itself, but they failed to deliver. They say on their previous promises. It comes simple as that. You're going to get a lot more details from that when you have a fight like this. Expect to see a big fight deck, as we like to call it, and a lot of specifics. They don't have that out yet.
You know, David, when I look at who they want,
these 8 directors.
They've got Air Canada, former CEO, WestJet, Ryanair. Here's what Virgin. Here's what I come up with. They're attacking Southwest on governance. Now, if you look at the actual board of directors, you do come up and say, you know what? They may have made a lot of changes, including changes Elliott liked. And they've done a lot.
Right. Well, remember their board itself. 6 directors stepping down very soon, and then Mr. Kelly stepping down at the annual meeting next May. That's 7 directors. They shrunk the board. Hence, Elliott has shrunk its slate from 10 to 8.
But I come back and say, you know what? If you get rid of the board members who you didn't think were that impressive, because it's kind of it wasn't. I'm going to say this, kind of a cronyist board.
Well, they said there were 0 independent directors with outside airline experience until they recently appointed one.
And I like who Elliott wants. I think you're dead right. I think they get 3. They already have a lot that was good. There was by the way, there was a board member bought $100 million worth of stock. So I say, get together, solve this, stop the acrimony. There. I come in peace, like 10 bears. Not unlike 10 bears.
Be interesting to follow a fight, of course. They don't happen that often, Carl, and that's what's interesting here. Yeah.
Get together, make peace. Come on.
We'll get Kramer's Mad Dash and countdown to the opening bell. Take another look at the pre-market as the S&P at least takes aim at the 46th all-time high of the year. Stay with us.
We have 6 more minutes left.
Make money.
Take a look at some S&P laggards pre-market. We brought you up to speed on Southwest, which is close to that list. Boeing we'll get to as well as after their announcement of job cuts on Friday. And then you see Freeport as well. Copper down 2% plus on some of these overnight concerns on China. Opening bell is coming up in just 4 minutes.
Okay, we're about to go here.
Can you get Alex coffee?
Hit my little support bar. Apple looks good. SPY has 3 white soldiers on the 1 minute in a way. Pretty obvious. KRE. Hello, I'm here. I'm just watching this Apple. Boing. And the SPX had a nice little breakout.
The analyst there added Apple to its tactical outperform list, said it's bullish heading into earnings later this month. Apple reports on October 31st on Halloween. The Evercore analyst notes that Apple's sentiment has turned more bearish in recent weeks and thinks that buy-side expectations are likely lower than current consensus estimates. So as such, says Apple is well positioned to outperform against low expectations in the September end quarter and more importantly on the December end quarter guidance. So thinks that inline results against current estimates should help the stock move higher. Says bearish investors remain focused on the Chinese smartphone market, but we think the risk here is overstated and can be offset by growth in developing markets and a strong upgrade cycle in the US, where our survey work points to strong upgrade demand driven in part by AI. Of course, those AI features actually have yet to be released. So, some analysts say that could drive some more momentum for iPhone 16 sales. So shares up about 1.5% right now. Should note that the majority of analysts very bullish on this name, about 73% rated as a buy, despite the fact that it's up about 20% year to date, and as you said, about 2.5% away from the highs.
All right, Apple really moving $231, responding to a note, pretty strong conviction. Seems like still really big piece of the puzzle. It's got to fall into place between now and the end of the year. Maybe it's a post-election thing that's going to give us some focus, given that the holiday season will really kick in the last 2 months. Apple's got a lot to live up to now, as the bulls are certainly
definitely flying. Apple
some of
is.
the investors here.
Yeah, I think that's the hope, right? I mean, there has been some, I would say, more downbeat analyst coverage in terms of what the initial iPhone 16 sales are looking like, but we know that As I said, the AI features, Apple Intelligence features haven't actually been released yet. And of course, the holiday shopping season is key for those iPhone upgrades. So the bulls maintain that it's not even just that people will want to upgrade because of the new features, it's that they'll need to upgrade because several or millions haven't actually upgraded in the past few cycles. So that should drive momentum for the iPhone 16. But it seems like the news that we've heard in terms of the initial sales has been pretty mixed. So it'll be interesting to see how this plays out. Not just obviously when Apple reports at the end of this month, but as they start to talk about, kind of outlook for the rest of the year.
All right. Yeah, going to be a big one. We got to see who's going to come buy these phones. Still, to me, seems like something that's got to really live up to expectations. The other product to unveil, from Tesla last week that had a lot of drama around it, didn't go so well. Obviously, Apple's got a lot more reliable of a track record in terms of kind of the staple-like nature of phone refresh cycles, but I still want to see if people are going to come out and shell out cash for the new phone. Let's talk.
Who discovered that the back of their phone is completely shattered.
There you go.
Might have to upgrade sooner than expected. Didn't realize that, but that was a fun surprise to see.
Woods is due. Get that fresh one into the holiday. All right, we got two negative notes this morning, though. One on Caterpillar, another one on Flutter. Let's talk Caterpillar first. Just a note here from Morgan Stanley. Down 3.5%, but the stock was just put in highs over the last 2 weeks. So what are they saying here?
And the year-to-date performance is partially why Caterpillar was downgraded over at Morgan Stanley. Shares are under pressure today, down about 3.5% after this downgrade because Morgan Stanley's all-out bearish now, downgrading shares to underweight from equal weight with a price target of $332. That's down from $349. So Caterpillar closed Friday at $402. So this represents about 17% downside, but shares, of course, down, as I said, about 3.5% right now. Morgan Stanley sees mounting risks of destocking and limited offsets from mega projects and manufacturing. Says when combined with the stock's year-to-date performance and a mid-cycle multiple on peak earnings, Caterpillar faces rising earnings revision risk. So Caterpillar reports earnings on October 29th. I will say, though, that JP Morgan went the other way. Obviously, the year-to-date performance, shares still up about 31% year-to-date, despite today's decline. So obviously implies strong earnings. So JP Morgan actually raised their price target on Caterpillar stock to $500 from $435, kept a buy rating, and said, we remain long Cat because a major profit margin reset the bears are penciling in looks increasingly unlikely, adding Caterpillar has exposure to several themes to keep bulls engaged. Those include U.S. infrastructure growth, backup power generation, demand for data centers, prime power generation, opportunity for its turbines, and a rebound in Chinese economic growth. So, kind of seeing as Caterpillar stock continues to rise, obviously outside of today, see these analysts kind of going in opposite directions here. Analysts pretty split on this one. The Morgan Stanley analysts very much in the minority, but if you take a look, 9 buys, 13 holds, and then 4 sells with a median price target of $336, which is significantly lower than where Caterpillar is currently trading at around $388 right now. So, shares definitely under pressure, but it's had a pretty great year-to-date performance. We'll report at the end of this month, so we'll see which analyst is right here.
China stock's down another 2% too. Caterpillar's got some important connections there. Definitely kind of one to keep an eye on as it had a really good year, but maybe some of the potential being called into question here ahead of the earnings. And so, not exactly like the biggest cut to their price target, but still one that's pretty deep below where it
Apple's
trades.
one I think I'd want to short.
Let's talk some gambling. Kind of a shake-up at the end of last week, possible taxes for sports gambling in the UK. Analysts are trying to wrap their head around it. There's an upgrade at Wells Fargo, a bunch of notes out over the last couple days. So the bounce back this morning of 4% for Flutter seems like maybe some cooler heads are prevailing. People still going to play even if they're taxed a little bit more.
It seems like many analysts think that it was an overreaction on Friday, of course, too, amid speculation of increased taxes on online gambling in the UK. Shares were down about 7.5% this month heading into trading today, but we're seeing a nice pop, as you said, up about 4% today. Quite a bit of bullish analyst activity today. Wells Fargo, as you mentioned, upgraded Flutter Entertainment to overweight from equal weight with a price target of $295, up from $224. So that implies about 34% upside from Friday's close, so about 30% upside from here. Saying Friday's sell-off reflects a near worst-case UK tax scenario and minimal offset. So they have confidence that FanDuel will increase structural hold to 15% in fiscal 2027, thinks that one could arrive at Flutter's targeted fiscal 2027 revenue targets on fairly conservative assumptions. Meanwhile, B of A reinstated coverage of Flutter Entertainment with a buy rating and a $300 price target. That's a straight high. Also added the stock to B of A's Europe 1 list of top ideas. B of A says that 35% the upside potential from that price target is premised on FanDuel's unique positioning and vigorous market backdrop, which leads it to put estimates 18% ahead of 2027 consensus. B of A also cites large value creative opportunities, with Brazil being the last example of what it calls misplaced growth potential. And then Benchmark reiterated a buy rating and a $265 price target on Flutter shares, saying it looks at the decline as an ideal opportunity to capitalize on the pullback, given its expectations for a far less severe outcome than feared. Benchmark actually met with the CEO and the IR director recently, and they were very impressed with the U.S. and broader North American secular expansion opportunities and felt confident that the company will continue to lead in product innovation for years to come. So sticking with that bullish rating. We also saw JMP maintain a market perform rating, but raised its price target to 287, so significantly higher than where it's currently trading now. Nathanson raised to 275 with the buy rating, and then Susquehanna raised to 273 with a positive rating. So quite a bit of bullish analyst activity for Flutter today, and shares in response are up about 4% right now.
Seems like kind of no matter what headlines come, investors find a way to be positive on the sports gambling stocks with the trend in their favor. On the flip side, our last mover this morning, Caroline, real quick, it seems like it's always just the opposite, finding reasons to sell. In this case, it's Boeing, as they're going to make cuts in the middle of a strike.
Yeah, a lot for investors to consider. Of course, there was Friday's pre-announcement that was a wider than expected loss. There were layoffs, there was plane delays, and then, of course, there's a bunch of analyst reactions. So this, of course, Boeing said that it's cutting about 10% of its workforce, 17,000 people, delaying the delivery of its 777X, which is still uncertified, by a year to 2026, and basically said it will stop making commercial 767 freighters in 2027, and then forecast that wider than expected loss of $9.97 a share.
Boeing to cut 10% of its workforce.
So in turn,
Not
JP
good.
Morgan lowered its price target on Boeing to 195 from 235. Did keep an overweight rating, says the forecast from there requires a number of assumptions with few details, and so the range of outcomes is
Right
wide.
now, I can't really
Meanwhile,
tell.
TD Cowen also maintained a buy rating, but lowered its price target to 190 from 200. Citi maintained a buy, lowered to 209 from 224. I will say Wells Fargo lowered its price target on Boeing to 109 from 110, but kept an underweight rating on shares. So on the bearish side there, said the surprise with the pre-announcement was actually the cash component, which came in $2 to $3 billion better than it had modeled. But says this the near-term cash pressure eases, but Wells still thinks an equity raise is needed in Q4. So sticking with its bearish rating. So Boeing under pressure once again today. Shares down about 2.4%, now down 43% year to date.
Spy.
Yeah, brutal. Another 2.5% off. Doesn't stop the pain. Thank you very much, Caroline. Good stuff. Taking us through the movers here. I always appreciate that. Getting us started for the week with some action there. Apple looking pretty good, helping the market firm up. We'll talk some banks when we come back. Get into the details on Wells Fargo, JP Morgan. Also, we've got fresh moves too for the market broadly. S&P's extending, NASDAQ extending. Looking pretty good this morning.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
Here's our reversal.
Welcome back to Morning Trade Live. Let's talk some financials here. It's a tech morning for sure, but banks are hanging in there after last week's pop. McCrae Sykes joins us from Gabelli Funds, portfolio manager. And McCrae, welcome back to the show. Good morning.
Great, thank you for having me.
Thank you. We got JP Morgan, Wells Fargo last week, ripping. We got Bank of America coming tomorrow. Walk me through how you're thinking about the financials and what role they play in the market right now.
Yeah, I thought the reports on Friday were very encouraging. First on JP Morgan, great execution there. We saw the investment banking revenue up 30%, extraordinarily well-managed balance sheet, good outlook in terms of some of the kind of headwinds that they're facing in terms of their total NII, but we'll see a turn in that next year. And I guess more of the same there, but we also got some, macro feedback as well from Jamie Dimon, to be cautious there. So, but just, again, great execution, fundamental growth, well-positioned, just something to own. And that's one of the main holdings we have in our Gabelli Financial Opportunities Fund, which is an actively managed ETF, symbol GABF. And then in Wells Fargo, I think more of the same in terms of great NII outlook, good execution. It's kind of a special case that's been emerging in terms of reinventing themselves after, a period with some regulation issues. And on Friday, what was great was that we got a path to this relief from the asset cap, which has been in there for 7 years, and it will restore confidence in their ability to grow going forward, deploy capital at higher ROEs. And so that should be a catalyst for the company's shares even today. And with the group up 26% year to date, we still see pretty good value there at 1.4 times and, an improving fundamental picture as well.
Okay. The message from the earnings last week versus the message from the bank conference last month, when a lot of these leaders came out and talked fairly negatively about the outlook. Stocks sold off late September. That kind of shift in tone, was there anything behind that, McCrae, or was that just kind of a leadership lowballing, setting up for earnings?
Well, I think there's a lot of moving parts, and investors are going to be trying to dissecting this. I mean, you do have to go on a company-by-company basis. If you think about JP Morgan, they're going to see some pressure on their NII next year, but their net interest margin is close to 3% on the contrary side. Bank of America, which has faced some headwinds in terms of some of their HTM securities, their NIIs or their NIM is around 2%, and so they expect to trough in third and fourth quarter and have rising input from there going forward. So. There's a tale of two cities within the major banks, but within the regional, smaller banks, there's just a lot of feedback on deposit costs, how the banks are positioned on the asset side in terms of fixed, variable loans, et cetera. So investors are going to sharpen their pencils as we go forward. But in general, it looks like we're going to see a trough for the industry in terms of NII at the end of this year, first part of next year, and accelerating gains going into later 25, 26, which is a good setup for bank investors in general.
Okay. We've talked before about some of the interesting picks you guys have in your fund, which is beating the heck out of the financial group sector in the S&P itself. The kind of ideas outside of sort of the core money center banks. I know you've got some big financials in there, but some of the other ideas on top of it seems like you guys have been pretty creative successfully. So does it help to kind of have some stuff in the portfolio outside of these core banks, though?
Absolutely. So we do own banks, but there are a lot of secular themes that we're leveraging in terms of the portfolio management of the fund. We see a pretty extraordinary boon in terms of asset gathering for the alternatives. So Blackstone, Apollo, Blue Owl, et cetera. These names have been very strong performers, but reflective of their fundamentals and their share in the industry, as well as their performance within their individual funds. And we see that continue even with the strong performance year to date. So those have been big contributors to the fund. And then within payments, American Express has also been a big contributor. And, there's a major investment firm, or major financial services firm growing at 10% top line, 15% bottom line, terrific management, great brand, and good secular trends in terms of their engagement with younger people. So within our fund, there's a number of secular themes we're taking advantage of, and those are just a couple that we can name.
All right. Hey, McCray, real quick, regionals, any interest in that cohort at this juncture?
So we own M&T Bank and PNC, and we're looking at those. Obviously, they've been laggards in terms of relative to the bigger banks, but an evolving credit situation, with CRE and exposure there. So, on a price to value basis, they certainly screen out a little cheaper than the bigger banks.
Meta just had a nice little breakout. Meta.
And we'll just have to see in terms of how the market evolves over time in terms of credit, consumer, et cetera. But, there could be an opportunity there. And right now, we're just sticking with PNC, M&T, and First Citizens.
Understood. Okay, thanks for the catch-up. Appreciate that.
Great, thank you.
Absolutely. McCray Sachs, portfolio manager, Cabelli Funds, GABF. Is the ticker. All right. Hey, Tom, let's do some trading in the options market. All right. Their fund's doing great. But if you want to get stock specific here, let's look at JP Morgan after last week. Let's look at Wells Fargo too, because those are two big ones. JPM right now just below the high.
Yeah, just below the all-time highs, just above $225 a share. On this massive, 30% rally that we've seen so far this year. So looked at a short-term positioning where, hey, maybe I can take advantage of a slight grind higher, but maybe that, that all-time high just above 225 becomes resistant. So I looked at a short iron condor. We sometimes refer to this as a short iron butterfly because it's the same common middle strike that I'm selling on the call and the put. So looking at this one, going out to the November 1st weekly series, so just 18 days to expiration, where I'm going to buy one of the 215 strike puts, and then on the 225 strike, I'm going to sell the put and the call. So there's your short straddle there in the middle of this short iron butterfly, and then buy one of the 235 strike calls. So in essence, you're selling a put vertical, the 225, 215, and you're selling a call vertical, selling the 225 call, buying the 235 call.
Boing right there.
Common strike. You're collecting on this $10 wide short iron butterfly $6.30 credit. So that's what you can make on it. And you can see it from the risk profile. It gives me my break evens of about 218.70 on the downside and 231.30 on the upside. So you got a nice wide range. It's positive for theta, so time decay. The price of this type of position contracts on a daily basis. I went to the 225 strike, so if it does creep back up there, you're still safe on this one. But a range-bound type of strategy over the next 2.5 weeks, you expect some consolidation after the massive rally that we've seen.
Okay. All right. So I like that. A way to trade maybe some more slowing of the pop around the highs. How about for Wells Fargo, which has got a little bit more of a technical breakout?
Yeah, technical breakout, but maybe, the gains that we've seen, maybe it kind of putters out, or maybe you give yourself some upside. I think on a trade like this, I always look at strategies, relatively basic. I looked at a covered call one where I can create yield on something that's already had a meteoric rise, over 5% gains just on Friday post earnings. They still got some trouble on their balance sheet compared to the other big banks. So I looked at a cover call strategy. For every 100 shares of stock you buy, you're selling out of the money call to take advantage of more yield besides collecting the 2.6% dividend yield. So buy 100 shares of Wells Fargo. You sell one of the November monthly. These expire on the 15th. The 65 strike call that's out of the money to the upside, paying roughly about a debit of $61. Might be a little bit higher. The stock has moved higher. But that debit you pay is also your break even. So buying the shares at a discount because you sell the out of the money call to create yield. And then because you own the shares, you'll also collect that dividend yield of about 2.6%. And as you get closer to expiration, over the next 32 days, you can buy buy that short 65 strike call back, roll it out another week, 2 weeks, a month, collecting more credits. That increases that break even. So you're still owning the shares, but getting yield, paid to wait type of strategy here on Wells Fargo.
Okay, different approach. Seems like it makes sense though.
Yeah.
All right. Not ready to, doesn't seem like super wise to straight up bet against, the company breaking out.
Yeah, and if you feel like you've missed it, but you want to buy the shares, collect that dividend, selling those upside calls is a good way to play it.
Okay. All right. Nice 62.57 this morning for Wells Fargo, fresh 1-year high. Thank you, Tom. When we come back, we'll talk some tech, looking at AI. Taiwan Semi going to start planning plants in Europe. We've already got Taiwanese companies building here in America too. So as we diversify the supply chain for semis, perhaps another reason to be bullish. We'll be right back. This election season, stay out of the muck and the mudslinging.
Nice shooting star.
Find the numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Stocks heating up here, the rally trying to accelerate as we've got a really good start in tech. We'll talk some more about semiconductors and where we're going to be making them and who's making them, and the supply chain hopefully smoothing out as NVIDIA here is set to put in records and extend. We've got some good stuff to talk about. AI picks will be one subject. NASDAQ up 1%. That's your tell that it's a tech-heavy day. It's an AI day. We've got NVIDIA right now at more than 3%. Only red in the Mag 7 is Tesla, still languishing a bit after last week's response to their robo day. But overall, markets are in really good shape here. Russell Dow really close to flipping positive. We've talked financials. We talked through some of the analyst notes this morning. We're going to continue to get ready also for earnings and look at big notes out that are making waves. Upstart, Affirm, both have upgrades. There's a downgrade on AppLovin. Chartmaster will take a look at that for us. So we got a busy morning ahead as we get ready for a week that will be earnings focused and a lot of stock specifics, likely. Economic data, pretty light, and news flow, pretty calm, though we will get a good bit of Fed speakers. George Tillis joins me, back for a check-in on the market session. Off to a good start here, George. We continue the trend.
Yeah, I mean, it's pretty unique. It's the usual suspects today. The mega caps, NVIDIA's trading very well today. You're seeing some pickup in Apple and Microsoft. So essentially, kind of the opposite of what we saw on Friday. I mean, earlier the financials were down. They're starting to pick up a little bit here. Energy materials are to the downside. Crude's down. Copper's down, and in yields, OJ, the 10-year yields and 30-year yields are back to the upside after some reprieve going into Friday of last week. So, like you mentioned, it's a pretty quiet day. So the quiet day, you would expect maybe some of the default usual suspects moving higher, and that's been the case today across the board. Companies like Broadcom are higher, Micron in the semiconductor space also moving to the upside.
Okay. George, we're going to talk TSM, putting plants in Europe. We know that we've got a lot of semiconductor manufacturers building here as well. It seems like part of the story also is that there's a lot more smooth running, just kind of machine in terms of the global supply chain. And it's part of the reason why inflation's come down too. It just reminds me of our conversation earlier this morning about things normalizing. There's not a lot of big tail risks here. It seems like even though the market pricing in VIX is 20, as we talked about, probably like a little election ball built in there.
Okay, we're finding some support right here on the SPX.
Yeah, I think so. I mean, obviously, if you look at production in the United States, oil, the United States is one of the largest producers now, if not the largest producer of oil. That again is disinflationary. Semiconductors, the United States is becoming a powerhouse in manufacturing, so that's again disinflationary on a forward basis. We did talk about the volatility index. Still have concerns about that, slight concerns because with the S&P
Right about now.
and the Dow as well. The Nasdaq really hasn't caught up
Right
yet,
here.
so maybe we'll see some significant pickup and catch up in the Nasdaq, but nonetheless,
58, 48, 13.
because again,
Close to it.
volatility is to be expected during the election, and there can be winners and losers from stocks and sectors and industry groups based upon who wins the election.
You're
you
there.
expect perhaps if Trump wins, energy markets will probably perform well. Some of the EV or solar markets probably perform well if the Harris administration goes into office. So I'm just giving you a couple of examples, but that's probably what we're going to see as we move into the next few weeks towards the election.
Okay. George, looking at also just the calendar for this week, there's not much. There's a lot of Fed speakers, though.
Yeah.
What role do you think they're playing in the market right now? Could there be any unwanted volatility after the minutes last week, did show some, some dispute in-house a little bit?
Well, I mean, yeah, there's some dispute just based upon one of the members didn't go for the 50 basis point cut. Was going for a 25. I'm just going to look at it from the market standpoint. Obviously, the expectations were 1% to the downside this year in terms of federal funds rate. I guess some would say that the 50 basis point cut was an ominous sign. That's maybe the Fed getting a little bit, feeling a little bit troublesome about the economy. But nonetheless, it looks like 2 25 basis point cuts are expected in November and December. And you can look at this however you want to look at it, but if you look at the inflation prints, which are now more normalizing, this is more of a normalized economy, so the Fed is normalizing rates on a relative basis to inflation. So they're just going to pivot towards the cost of capital relative to the cost of final goods and production. And so it's matching in interest rates relative to inflation or better alignment of that. Some would call this, the soft landing approach to normalization, where the Fed is just doing its due diligence from a mathematical standpoint. So, I think that's what's happening here at the very least right now. And I still think if you just look at the fiscal flows, just the interest on the debt last year was tremendous. And so, it's a liability to the public sector, but it's an asset to the private sector. So holders of bonds have gotten a windfall. And I think that's also been very supportive
Good job, George.
of capital formation in our equity markets. And lastly, too, I look at long-term interest rates rising as a good sign for the economy, but at the same time, you have to consider perhaps the resurgence of inflation. And maybe that's also part and parcel of what's happening with long-term rates rising.
All right. So far, market's okay with it. Economic data been beating expectations.
So far.
Maybe a little inflation sticking around as long as we don't fall apart. Decent trade-off for now.
Right.
Thanks, GT. Good stuff. Good analysis. Appreciate that. Nice check-in on the market now, rallying about 34, almost 35 points in the S&P 500. Jeff Pierce joins us for a look at some more detail on where Taiwan Semi is going to be building their chips. Jeff, take it away. What do we got?
Yeah, we've got potentially more good news to try to meet that demand that the company is seeing. Reports out of Bloomberg say they're planning on more plants in Europe with a focus on the market for AI chips. They've started construction of their first fab in Dresden. They're already planning next few fabs in the future for different market sectors as well, according to the Taiwan National Science and Technology Council minister. They did not specify a timeline for the Taiwanese chip makers' further expansion in Europe. However, we know that this would be on top of a current plant worth about $11 billion, which broke ground in August. This, of course, is important because we continue to see TSMC Their advanced packaging technology becomes more and more important for this AI process, but those chips are sold out until 2025. As a result, this company is really pushing to expand. Right now, the company expects to end 2024 with advanced chip packaging capacity of about 45 to 50,000 units per month. That's a big increase from what we saw in 2023, where they were coming in at just about 15,000 units. This should allow them to fulfill more of those orders and try to catch up as the demand continues to spike.
Okay. It's really big because this does limit some of the downside possibilities of disruptions in supply chains, geopolitical risk, which some had described as being, maybe a tail risk or an unlikely one, but something we had to consider for Taiwan Semi being a major player. I feel like we've now distinctly kind of diversified enough, their manufacturing to not be so worried about that.
Yeah, I think that's starting to become the case, right? I mean, we've seen shares fall in the past, and we've seen shares fall around commentary from President Biden, from Republican nominee Donald Trump, that they kind of really focused on this chip market. And then, of course, the macro headwinds, as you mentioned, the inventory headwinds, and then the smartphone and PC, slowdown that we've seen since the pandemic. But if you look at some of the expansion, the $65 billion that's spent in Arizona, there are more and more calls for them to continue to do more manufacturing here in the U.S. I think that all bodes well for their future. And if you look kind of past that and just what the company is doing right now, we look at last week, they reported a 40% rise in their September sales, coming in about $7.82 billion. That brings Q3 sales to $23.6 billion overall, ahead of the expectations set by the company. We know the full announcement's coming in October 17th. I think we're going to be seeing a lot of focus on the 3-nanometer technology, the development of that 2-nanometer technology, which is anticipated to really drive revenue. And we'll see if these pressures, inflationary, macroeconomic, geopolitical, we'll see if they're still playing a big role, or if investors are largely kind of pushing through that. I think we'll get a glimpse of that in this next report.
Okay. So as long as volume is able to increase, I mean, I feel like the logic, the math is pretty straightforward here. More plants, diversified regionality, where they're building, stock at highs. What is there not to like? More plants, more production, and more getting NVIDIA's chips through the door, essentially. So even though this is kind of a more CapEx heavy business than NVIDIA and the others that are designing the chips, it still has been a really great trade.
Yeah, absolutely, and that is a great point, the spending, right? We know CapEx this year, 30 to 32 billion. That's compared to the 28 to 32 billion that they had previously forecasted. 70 to 80% of that's going to go towards that advanced technology. But as you pointed out, when you're partnered with NVIDIA for their A100, their H100 chips, now the Blackwells, I mean, it's going to continue to be a lot of demand there. They're trying to meet that demand, and that's where we're seeing the spending go.
Okay. All right, good stuff. Taiwan Semi, 1.5%. Fresh breakout, extension to highs, 193. Really good trade here today. 194 at the highs, but we're a record. So Taiwan seeming unstoppable, making highs alongside NVIDIA. Makes sense. Good stuff for bulls. Business continues. Thanks, Jeff. Good morning here. We got the Russell turning positive as well, by the way. Now just looking for the Dow to join in. Not quite there yet, a couple of pips off, but seems like we're going there. Alan Nuttman joins us, Chief Market Strategist at BullseyeOption.com. Emphasis on the bull on a Monday where we're putting in more records. How high are we going, Alan?
Records are made to be broken. So, the question is, how much momentum can we get here? We've got the beginning of earnings season, $20 billion in pure profit for one day from 3 banks. So, the train's on course, and it's just a matter of using just good money management. Sell too soon. The last couple of weeks, we took advantage of these booming markets, those Chinese stocks that gave us a second chance here mid-summer after that action we saw earlier than that. So there have been some plays there. So it's about money management is all it is right now, risk reward, and there's still amazing opportunity.
All right. Amazing opportunity in the broad market. Stock picks. I know you're bringing us a pick per usual. Today you're looking, it seems like, for the crypto world to warm up a little bit. You're going for a Bitcoin miner.
Yeah, I like the setup technically, but I just want to talk about the macro market for a second.
Okay.
It continues And again, a couple weeks ago, XPEV, we talked about some of these Chinese plays. There was 100% gain in a week when we had that surprise stimulus. No, I didn't know that, and that was not my plan to trade that stock looking for a stimulus to happen like that week. But like we said before, it's always the central government's, goal is to make sure the stock market does well. And China had the worst risk reward. Now they've had a big breakout. They had a little bit of disappointment over the weekend, but you've got to look at the sectors that have suffered. And I think the energy sector is the big market to keep an eye on. We've been talking about that for about a year, but 75 has been that pivot in crude, and you're starting to see some of these energy stocks. Even look at Exxon. Exxon's leading the way when it comes to energy, but some of these others, the Oxy, the Schlumberger, the Halliburton, they're starting to show some serious signs of life, and they have the extreme risk reward on their side.
All right, I like that. Extreme risk reward, time to take it. High beta trade, should we lean into this market by going long stocks, Alan, or should we be short in VIX? Because vol's at 20 still. Seems like it wants to see this election go by smoothly or something.
20 is right at the average of my lifetime. So
it's about 5 points higher, because your average is the same as my average. It's like 17 to 16 and a half.
It's not high, it's not low, so it's relative. But for the way I look at it is, there's a lot more downside potential in the VIX, meaning more upside potential in the S&P. And just to throw out a number to you, I think I threw out a number to you many weeks ago, and I know it sticks in your head. What was that number for the S&P target?
Seems like 6 or 7K. Hard to know.
No, it was 6,300. It was an odd number, but it's funny that Goldman came up with the exact same number. It's just simple, though. I just make it ridiculously simple. The fact is the distance of that drop on that old top. So 6,300 is the first target there. But in the NASDAQ, the V recovery target, once we get that complete V recovery, which we're closing in on, is 24,000, which is about 15 or 20% up above. So it's happened every time in history. So there's still a lot more. And that's why we come all the way around back to this crypto, because I think crypto has a little risk reward, bullishness as well.
All right, so that brings you to Riot, one that's kind of been dead money for a little bit. So if it wakes up, if we get a little trade going, how high do we go? We're at about 859 right now. The low is at 636, the high at 19. So if you're looking for swings, this stock is for you.
Right, and with limited risk options and the way I trade, it's very important that I can sleep well at night in a stock. And again, look at 6 is that low. So I'm looking at a 7 call. We've got the stock at what, 870 or something like that. That option's trading for about 250. A January option has 3 months of time. But the best part is, if there's no development, the stock stays, essentially the same. In 2 months, the December option is trading for about, 225 or 235. So the cost to hold this for a couple of months, barring the market moving lower, if it just stays, it's not much. So I call this a looky-loo trade. We can see if we can get some movement, and an in-the-money option is going to give a great payoff on the upside just from a modest move. So if we see a modest move in the stock, and you know how it can move, that this can have a big gain from just a tiny move in the underlying stock. I'm not looking at it going to 20 necessarily. Just like in that XPEV, it's a smaller dollar stock, a couple dollar move makes big impressions on the bottom line and on our returns.
Okay, so buying the in the money call and looking for Riot to rip here, riding it out for a while. Your target, Alan, when you bail?
Well, I would like to see it get up to, if we're looking at an option for 250, I look for my option to double in value. So if I need a $5 move from 7. So we're you're putting me on the spot here, but we're looking at $12.50, $13 is what we're looking for in this stock for this option to double in value if we're paying $2.50 for it right now.
Got it. All right. Hold up in the morning. Thank you, Alan. Appreciate the trade.
Thank you.
Appreciate the thoughts. Alan Upton, Chief Market Strategist, bullseyeoption.com. When we come back, we'll get into tech in some more detail. We talk to Taiwan Semi, construction of European production facilities. They gotta make the chips that everyone's designing, and it seems like there is insatiable demand. However, in the midst of NVIDIA's dominance, some popular trades have struggled. AMD in the past week took a pretty big hit. We'll talk about the give and take and leadership within the sector when we come back on Morning Trade Live.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
All right, let's keep talking some tech here. It's leading the market once again. With
Missed
NVIDIA
it.
making highs. Taiwan Semi doing the same. Mike Smith joins us from Allspring Global Investment, Senior Portfolio Manager and Head of the Growth Equity Team. Mike, good morning. Happy here.
Missed it.
What's leading us again this morning? Good to see you.
Good to see you too.
So tell me how you guys are looking at the AI trade versus general growth and where you can find maybe some potential outside stuff. But let's kind of start at the nucleus here, at the core of it. I mean, NVIDIA's making highs again, so does that assume that our old winners from the first half of the year are going to come back to lead us?
650 to 950.
Long-term investors and trying to follow, all of the secular growth themes. Two things stand out. One, AI and NVIDIA in particular, that is the zeitgeist. And when so much focus is on one thing, we have two choices: stare at it and try to see things other people don't, or listen for the dog that isn't barking.
I just stared at it.
Elsewhere. And I'm excited about the opportunities, frankly, to do both right now.
How dare you?
Okay. Looking at the leaders right now, I mean, AMD seems to have slipped behind a little bit, but
Who's this guy?
Going past NVIDIA, kind of down the rung into maybe some of the less appreciated plays?
I think so. AMD has about a 5% share of a $500 billion market that's still growing, and their share, I think, has significant upside. Mainly for two reasons. One, I think the customers of NVIDIA don't want NVIDIA to run the table, and so spreading the love, if you will, to some of the other suppliers is in their best interest. Second, I think as AI transitions to what's next, which is away from training and forward inferencing,
5850s did very well.
I think many of NVIDIA's customers may look for cheaper opportunities to serve their customers and build their products and services.
When do you think we'll start to see that kick in? That's certainly what it seems is the logic. And then you've also got Lisa Su arguing that just from a pure computational standpoint, that computers built on their new tech is going to be just as good. Market's been kind of doubting it though. Like, what do you think is the timeline? Do they really need to make a big breakthrough or show some big purchases or risk getting left behind? How long do we give them?
I think fundamentally we focus on the next 1 to 3 years in our investments, and I think the market's good at seeing the future. So, NVIDIA has all the momentum right now, very likely to report another good quarter, and that carries them for the next 2, 3, 4 quarters. But the most important question for investors is what happens after that. And so I think as we get through the next 3 to 9 months, that's going to be the focus.
Looking at some of the non-AI stuff, take me through some of your guys' other picks too, because I think a few of them are pretty interesting. Kind of healthcare related. Natera is one that you're bringing to my attention for the first time, which is a cancer-related diagnostics business, but it seems like there's a lot of reason to believe that there's plenty of growth in that market.
Absolutely. I mean, for all the hype around AI and all the focus, there's really amazing things going on elsewhere. Unfortunately, 10 million people a year die from cancer worldwide, and that's obviously way too many. And there are some
way too many
companies that are doing some amazing things to improve on those outcomes. In the diagnostic space, Natera is one of our favorites. And, they have the opportunity to catch cancer earlier. They have the opportunity to catch recurrence earlier, and timing's everything in terms of treating cancer patients. So we're bullish on the growth opportunities for Natera.
Pretty amazing year, 200% rally. Take me through the expectations for the price. Like it seems like there's been quite a bit of valuation expansion, but also the market's rallied it on earnings 3 times. So what's that trade-off between cost of earnings and the actual profit growth that's happening?
I'll be right back.
Definitely have seen some multiple expansions.
Something's going to come up.
Off a fairly low starting point, and we still see relative opportunity in the multiple. But the big reason for the performance and what's going to carry it forward is the growth, and they have, multi-growth vectors, which is what we look for. They're launching new tests, they're entering new geographies, and they're hiring more salespeople. And all of those things are combining for a very powerful growth trend.
Okay. Pretty amazing stock. Definitely one that we need to be watching a little bit more closely. Really good eyes on that, up 200%. Nothing to complain about, even in a market that's done quite well. You also in Axon, which is I think many will know is another big winner on the year too. But the company behind the taser that's definitely expanded now a lot of different kind of use cases and products. It's a pretty interesting business the way this has grown throughout the years.
Yeah, you nailed it. The company formerly known as Taser has really diversified into a full suite of products, primarily driven by their software business, actually. And tying it back to the AI theme, we think public safety is one of the markets where you're really seeing strong early adoption. And when you think about the market Axon serves, about 18,000 law enforcement agencies, about 800,000 law enforcement officers, the number one goal is safety, and the number one cost is labor. And the solutions that Axon is bringing to the table are an improvement for both.
All right. Pretty big move also to the upside. How, when you get these big growth winners, do you handle taking profits and monitoring and kind of gauging the exposure in the fund to the trades? For those that are kind of watching, sitting on big gains for these, how do you handle that, Mike? How do you figure out when's the right time to take profits on your views?
We take an incremental approach and we rebalance our portfolio when the market presents those opportunities. And then I think the biggest thing is what you alluded to earlier, just trying to match the stock price trend with the trend in the business. And the benefit I have with my team and our approach is we invest in companies that grow, and the underlying growth.
Very smart move.
That we've invested in oftentimes is keeping pace with those strong moves that you're seeing in the stock prices.
Good stuff. Great picks. Thanks, Mike. Appreciate it.
Thank you.
All right, a couple big winners there to watch in the growth category, and hopes for AMD.
He's serious.
Play a big role in AI. Mike Smith joining us from Allspring Global Investments. Coming up, we got some charts, a couple upgrades, one downgrade this morning. Affirm has been rolling lately, taking a little bit of a pause today, even with the positive note out from Wedbush. Shares at $47. They'll have moved quickly up from the mid-20s earlier this summer. Upstart going wild this morning, up 12.5%. Why not? Markets at highs. Rates have been cooling off. Maybe take out a fresh loan. Then we're going to look at Apple 2, which is shrugging off a downgrade. We'll be right back.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends?
All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network. Welcome back. Let's talk some technicals. Let's get some charts going. We got Alex Coffey and Ben Watson joining me for our Chart Master segment this morning as we look at some of the tone from Wall Street. Good morning, Ben. Good to see you, sir. Welcome back to the show. Good morning, Mr. Coffey. All right, let's talk. Maybe let's go to Affirm first, Alex, because it's a little quiet today, but it's had a really big move. And we've also got Upstart, too. So kind of in this kind of similar discussion about the market kind of frothing up a little bit, people taking risk, people buying stuff, people taking loans. Affirm at $46, real close to the high where it started the year, like $50.
Yeah, and so it's important to know that while it's an upgrade, it's only an upgrade to neutral from underperform. So it's incrementally more positive, but they're not saying this is like their top pick or anything like that, which we've seen a lot of that thrown around by analysts lately. But it is Wedbush. Upgraded to neutral. Price target's 45. What you'll notice is, well, the stock's at 46.64. So again, take it with a grain of salt. Their actual 12-month price target is actually, let's call it 2.5% lower than where we're currently trading. So it's not the most optimistic of notes, but it's not
really
either. They talk about lower interest rate environment being beneficial to the company on several fronts. That might be counterintuitive. But it talks about lower funding costs. It talks about incremental gross merchandise volume growth. And they talk about credit quality consistently outperforming the firm's expectations over the past couple of years, despite the higher rates, due to the short duration of the company's product in terms of what they're actually loaning out. So again, it's that buy now, pay later, maybe 4 installments, $200, 50, 444, or your 50, 50, 50, 50. And that's allowed for, a little bit greater focus and less, default on the credit that they are extending. So, again, I would say incrementally positive, but maybe not enough to give a jump start to the stock here. What's largely an optimistic day.
Yeah. Shares down 1%. To your point, not really moving in the way you might suspect. But again, this is more a bear kind of capitulating, basically.
Yeah, catching up, I think.
Yeah, I just feel like that still is pretty symbolic, though, because a lot of people really had doubts about this business. To some extent, including myself, too, that companies would be able to replicate their tech pretty easily if they wanted to do that. But it turns out that they don't really. They'd rather just kind of offshore this to a third party.
I think they did kind of in a totally different industry what Roku did. It made real big partnerships, leveraging the brand power and awareness that they had and loyalty that they had. Where you look at Affirm partnering with companies like Amazon when they could, and just getting involved while they still had that leverage. Because Apple's coming into this space. We know PayPal's in this space. And so you go down the list, there are bigger players. And so it's important while they have that lead to leverage that lead to kind of get a little bit more of a moat around their business.
Okay. Nice. Well said. Ben, chart-wise, it's a pretty interesting one as we're now almost neutral on the year after a sell-off in the first half. How are we looking?
Yeah, absolutely, Oliver. This has been in that kind of intermediate length downward channel through most of the year. And then on this last earnings announcement, you see a little bit of a tone change, right? You see that gap to the upside. It now kind of digests that over the last month and a half and bounces up off of that 37-ish support, banging its head twice into this 46.70 resistance that it broke through on Friday pretty solidly, but sitting back down. And oftentimes that happens, when we see those breakouts, we'll see a little bit of a pullback and a retest. But this seems to like those kind of symmetrical moves. And the potential here is for a bounce off of this level of support, maybe back up to that 55 range. Now, obviously, that's outside of what the analyst price target is. I mean, we're kind of sitting right about that point right now. But you see that move up from a technical perspective, Oliver, that seems to be not only achievable, but probably the logical next move. Now, no guarantee that that's going to happen. but sentiment is certainly going that direction as well here, Oliver.
Okay. So potentially a nice little lift off here if it continues to strengthen. I mean, it looks like it's set up pretty well.
Yeah, I think you see this little bit of a pullback today, again, as kind of that digestion of what was really a very strong bullish candle, even though had a little bit of an upper shadow at the top there Friday, but comes booming out of that resistance. And, sometimes it takes a little bit of digestion, but boy, I tell you look at that long-term sentiment line, really from before that earnings announcement, as there was starting to be some nibbling on the price, pushing this price higher, it kind of digests that sideways, translates now into trading time for an upward price move.
All right, pretty good looking potential there. All right, let's talk Upstart here. Alex says big move here today. I mean, double digits. We've seen this before. When this stock gets going, it can really get going.
Yeah, it really can, Oliver. And when you look at the short interest in this stock up in the 30% range, it explains why you get these explosive moves at time, particularly around positive incremental updates, either from the company or maybe how the analysts feel about them. Wedbush upgrading Upstart to neutral from underperform. When you look at the situation on this front, it's very similar. They talk about improving quality of the credit metrics, etc. In Upstart. But when I think of Upstart, I don't necessarily always think about the credit side of it as more of it's an AI lending platform. They're more connecting the consumer to banks using data and AI to help you get the best available option. And so they're almost the middleman connecting two parties that may not interact with one another without it. Now, it's something that could be disruptive, of course, and I think that's why there's many that are betting against it using short positions. And how do you value it? That said, there is at the moment, some use for this company. Of course, that's why you see the pretty interesting kind of growth metrics at times. But the AI component of this, I also think adds that explosive sort of upside potential. Analysts, though, on balance, there's only 18 of them that cover compiled by Bloomberg. 10 of them are in hold, 7 in sell, and then there is the one outperform from Dan DeLev over at Mizuho. Price target's 48. So even the most optimistic of analysts has a price target that's below the current share price. I think it goes to show that these stocks can move a lot. We talked about that pendulum of optimism. Maybe it's swung a little bit to the upside here. I'd expect some analyst adjustments building on this, even from the ones who are a little bit more pessimistic on the stock. It's
going to be challenging for analysts because it was trading $400 at one point, and it just obviously withered in the last few years. But now to make higher highs on the near-term chart, Ben, are we looking at breakout, $52?
Yeah, I think absolutely. And Oliver, look, if you take the story out of this, and it's great fundamental information about this particular company, but if you look just at the stock, what this realistically is from December to now, the breakout of kind of a long, rounded, well-formed cup and handle formation above that support down around the 22, 23 range. And you see a little bit of a test on that handle side at 44. It blows through that on Friday. Today coming out of the gate with a gap up rally blowing above the top edge of the rim, that previous resistance in December at the 50 mark. Now, the objective of this pattern, I mean, that puts it up, or, if you just look at that measuring objective, up around the $70 mark. But you said it before, this is a stock that was trading 3 years ago near the 400 range. It's just barely kind of eking its way out of this sideways relative range that it's been in. But boy, sentiment just booming to the upside in both of those short and intermediate term lines, trending higher up at the top of that kind of overbought range in that lower panel.
All right, looking pretty good. Kind of similar to the other one. Making moves to the upside. Ben, when you have huge, destruction in stock price stretching back on the long-term chart, does that factor into the intermediate or near-term one when you're trying to think about price projections, or is that like a whole different world ago, and this is kind of a new world for Upstart?
I'll tell you what, you might think investors are thinking this is a whole new world, but you know what? You go back to those time frames, and those support and resistance levels that existed even on that meteoric rise and then the pullback, those are going to be present because as investors, typically there's some anchoring to those prices, and they think, wow, this can, because it's been there before, get back up to those meteoric rises. So it factors into it, but it's got to break out through these ranges. And the first the trip to the moon starts with the first step, right?
Yeah, all right, fair enough. Last one we got here, downgrade. Some negativity on AppLovin. Shares are shrugging it off, but again, for those that are thinking about trades that have generally had a good year, and some that also I think have kind of surprised in how they fit into the growth category. I mean, this has also been a pretty impressive one. $148. It was at $34, and then a massive swing too. If you look on the multi-year chart, as it crashed real hard from $100, it's now well above that. It's really been an amazing comeback.
Yeah, and this almost seems like a catch-up a little bit. This is an analyst who was optimistic on the stock, but you look at the price target adjustment up from 103 to 150. This tells me they just hadn't updated it in a while, but they do downgrade the neutral. They just talk about balanced risk-reward ahead of earnings as the primary. So this is a valuation call. This is a too far, too fast situation. They're not outright selling it, but downgrading to neutral from that outperformer by equivalent rating. You know, when I look at these type of situations in the market, oftentimes you don't see the market get super spooked by them. This is a natural feeling that investors have as well. This is taking some money off the table when ahead. And I think we're seeing a lot of this. Where you're seeing, like in the first two, you saw a kind of capitulation from sell equivalent ratings to neutral, playing catch up, and now you're seeing buyers, buy equivalent ratings, optimism in different names, kind of taking money off the table that way. For those unfamiliar with the company, or maybe know it but don't know totally what it does, kind of similar to Upstart in a different industry though, where they play middleman between app developers and then basically digital ad marketing agencies that help you market your app, monetize it, and get it out in front of people, all sizes from the smallest apps to some of the biggest players. They're also now stepping into connected TV, which we know is a burgeoning little industry as well, or piece of the digital ad space that's growing. So a lot to like about AppLovin. Not the biggest fan of the name, but live and you learn. I guess we're stuck with it.
In stocks, made a big comeback. And to your point, the kind of development process for applications to use some of their AI tools. They talk about their software as being AI driven as well. I think that's kind of why it's gotten some of the really momentous trend behind it here. Ben, when you break free of the old highs, I mean, it seems like we're kind of, the other charts we're looking for breakouts, and this one really has already done it.
Yeah, absolutely. Investors said above that 93 mark, I'm AppLovin it, and took it almost straight up. I mean, this was almost a parabolic or ballistic type of move, right? One candle after another was solid green and moving. Hit a little bit of resistance, a bit of a pullback there at that 133 mark. Now that becomes critical because that could be seen now as a new level of support that could prove to be the test, maybe the launch point for the second leg of this higher.
50 puts.
Symmetrical 40-point moves that it's made 93 to 133 straight up. 133 to 173 is kind of going sideways a little bit here, so watch the pullback to 133. If it breaks down below that, maybe back down to 25 or so, kind of the base of that little challenge on the
new chart master here.
Once again, sentiment, Oliver, is driving this higher. I mean, it's pounding to the upside, even with today's gap down rally.
Yeah. All right. Pretty amazing stuff, especially when you've got a note that has to bring the price target up as much as it does.
50%.
Yeah. Then right. It's still a pretty positive note. Good stuff. Thanks, guys. Alex Coffey, Ben Watson. Let's look at a few of the winners in today's session, a few of the analyst commentaries. Coming up, we're going to talk a little bit more about commodities, got some OPEC news, and we're also going to look at a note on some retailers, too, ahead of retail sales this week. We'll be right back.
Boom, boom. Oh, yeah.
accelerate your market knowledge,
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
There's the knife. What looked risky for 1 second, don't look too risky now. I was looking at it, God, the 58.50 puts.
Welcome back to Morning Trade Live. Let's talk about the session here and a few other news items. Caroline Wood's back with us from New York, and Kevin Green jumping back as well. Let's talk some commodities here. We haven't really hit that so much yet this morning. KG and the subject of crude oil down about $1.40, but off the lows of the morning. What are you watching here?
Yeah, obviously we did have the geopolitical risk premium kind of being backed out of crude oil right now. And then we also had OPEC actually reducing its global demand expectations for not only 2024, but also 2025. So those are two headwinds that we've seen with crude. And we kind of go back to the fact that the fundamental data pretty much around the globe has been, lackluster to say the least. If you look at China's data overnight, once again, just did not hit the mark when it came to the market's expectations. And the risk of Iranian infrastructure being hit in the near term is just being backed out. So unfortunately, we are seeing a little bit of a pullback, or maybe fortunately, kind of depends on how you look at it. We are seeing a pullback when it comes to crude. You're also looking at this reflation trade being backed out from some of the other commodities as well. If you're looking at, let's say, copper or even silver for that matter. So I think it's going to still be a little bit of a back and forth until we get greater clarity as to the geopolitical risk that could be out there, as well as trying to get some data for this week, the API report on Tuesday, the EIA report that's going to be on Wednesday. If those show positive signs, maybe we see a small little rebound in crude for right now. But I think this is more of just a geopolitical risk premium just being backed out of the market.
Okay. So the demand growth limitations from OPEC, not as big of a, you think this is still moving on some of the kind of more speculative elements of geopolitics?
Yeah, definitely. I mean, OPEC has actually overestimated the global demand story for a very long time, and now you're just starting to see a little bit of a recalibration of that. And I think the market, when you're looking at energy traders, are probably actually a little bit excited about that. I mean, we continue to scratch our heads and say, where's the EIA? Where's OPEC? Where's IEA getting these demand pictures when we do have India kind of slowing down their imports, China doing the same, and for the U.S., for the most part, our gasoline demand and just demand in general has leveled out. Now, I think there's going to probably be a little bit of a pullback when it comes to production in the winter months as we have maintenance season going through here. That might provide a little bit of a floor at that $65 to maybe even $70 level for crude. But the upside,
SPX is hit to 63.
Politics to really try to push this through, and the fundamental data is going to have to be very key for that. And I think that's where you're going to see China really shine if they're able to get the stimulus story right.
Okay. All right, as far as this week goes, in terms of new
So we'll see if it bounces up here or
not
not.
a lot on our calendar, Caroline, but as far as the economy goes, retail sales
Caroline
might be the highlight for this week.
Yeah, I would say that could give us a lot of insight into the strength of the consumer. We also have earnings from Discover Financial that could give us some insights into kind of some of the credit trends as well. And
what about the 63?
I actually have my eyes on a few retail names that are under pressure today. Potentially, these kind of seem very company specific, but obviously, any signs of weakness for the consumer is notable given how solid they've stayed. Wells Fargo, though, downgrading a few retail names, including VF Corp, the parent company of shoes like Vans, downgraded to underweight, lowered its price target to $15, saying stock has run and valuation appears to be baking in much more upside than appears realistic. Should note that Stifel maintained a buy rating and actually raised its price target to $25. So two very different moves from the analysts there. Also downgraded Canada Goose, really linked to China, to underweight from equal weight, lowered its price target to $12 Canadian, said they're too many China macro concerns.
China.
This has made China central to its DTC expansion plan, now accounting for 40% of stores and greater than 30% of sales, leaving the brand overexposed to the volatile macro, which has gotten progressively worse throughout the year.
Yep.
And then Amer Sports actually downgraded to equal weight, raised its price target to $19 a share. It's lower today. If you take a look, all three, Amer Sports down about 3.6%, Canada Goose down 6%, and then VF Corp down a little bit more than 5% right now. So definitely seeing some weakness amid this, record territory that we're kicking off the week. Not all winners.
Yeah, for sure. But at least we got enough working for us. Pretty nice start to this week. 0.8%. Crypto markets heating up. It kind of looks like we're going into a little bit more of a frothier version of risk on, KG, and I wonder why we wouldn't without much on the calendar this week.
Yeah, I would agree with you, as well as the earnings announcements that we're going to see this week. I mean, the bar is actually set pretty low when you're looking at this quarter. I believe it's around 4.2, 4.3% when it comes to EPS growth. So if we're able to actually exceed those expectations and guidance is actually better than the market's expectations, I think that can continue to be a little bit of a catalyst or maybe a little bit of a tailwind for us in the near term. And as you kind of talked about, I mean, outside of retail sales, which we're not going to get that until Thursday, the Bulls definitely have the market in control here, barring any other news that hits the wire that could actually negatively affect us. So I think this is a really decent setup. I mean, we talked about it earlier in the session. 58.30 was actually the area of resistance I was looking at to start off. We kind of blew through that, hit 58.50, and now we're kind of backing off of that level right now. But once again, if we can kind of maintain that 5,800 level just in general, I think the Bulls are looking pretty good to start the week off here.
Okay. As earnings too haven't gotten in the way, how much they're going to add to it is up for debate, but they certainly haven't gotten in the way. But that's going to be, I guess, the last kind of piece this week to fall into place. Caroline?
And overall expectations, it's looking for something like 4% growth, which many say is pretty,
doable.
Could be pretty doable. But if you take a look at some of the names, especially this week that are reporting, Netflix, United, Taiwan Semi, ASML have all seen huge year-to-date gains. So I would say the bar is pretty high, so there could easily be disappointment. Even if they do, come in even a little bit better than expected, it might not be enough to justify. I mean, United now up 52% year-to-date, TSM up 85%, ASML
oh, she's got
up,
fear all over her face.
But then Netflix is under a little bit of pressure today, but up almost 50% year to date. So I would say the bar is pretty high. So
it's a high bar, all right.
Surprise to the upside there, and give some good guidance as well.
I agree.
Good stuff. Well said. Thank you, team. Nice setup for the week. Appreciate that. Caroline Woods, Kevin Green. Thank you for joining Morning Trade Live. Trading 360 with Nicole Petalides is coming up next. See you this afternoon at 2 p.m. for Market.
Puts, huh? Is that what you're trying to tell us? $58.50's at $5.80.
This election season, stay out of the muck and the mudslinging with Schwab Network's By the Numbers coverage of the presidential cycle.
You ain't kidding.
This election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Take her to a bar.
Being lucky and trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace.
Lace her drink with the rape drug.
Staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for
Okay, we're at the
10 years
63
And
now.
it's almost second nature to me.
It's
You
truth
think
to
that
consequences.
This is essentially a human superpower.
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's
God.
The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
My money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
The 5850s are now at 840. $9.
Good morning. We're 90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. So glad you're with us. We have
Ooh,
a
look
slew
at that.
of earnings, Fed speak. It's a holiday for the bond market, not for the stock market, and we're seeing some up arrows right now as I speak. Our 360 Spotlight will dive into the week ahead as TSM and Netflix highlight earnings coming later.
That's a
this week.
$1.60 drop right there.
WorldCom after Mizuho raising the price target on shares. In our 360
$9.70
round,
now.
the financial sector after strong earnings from JP Morgan, Wells Fargo. Those closed out last week. We saw records for the S&P and Dow, right? And once again, we're watching for those for today's close. In the meantime, here's a look at the exact numbers
Drop more.
as we speak.
Don't stop.
The Dow Jones Industrial Average is up 48 points now at 42,912. The S&P right now is up more than 0.5%. We are seeing
No reason for it to stop.
20,390. That's up 0.5%, and the Russell up almost 0.2%.
Yeah, it has.
Oil and gold both lower. Gold's down over 13.
I have two reasons.
26.62 a troy ounce, and oil's down $1.26. This has
There's one reason right there.
Demand numbers for 24-25. It's at 74.28. The Dow. Definitely worth noting that the 10-year is at 4.13% today.
Oh.
Let's get some insights, the news shaping the
Oh.
markets. For that, we welcome in Max Wasserman's with us, founder, senior portfolio manager at Bear Market.
The computer's doing its thing
Thank you so
again.
much for being with us. What's your big picture? I mean, what are you focusing on this week before we get into all the intricacies?
Okay.
Sure. Thanks for having me on. I think you're just looking for confirmation that there's still earnings growth and that the
This
companies
has to
are
stop.
dealing with the higher interest rate costs. And basically what you're dealing with is a market that is richly valued. So now I'm looking for earnings to justify it. I think interest rates are going to continue to come down because that's what the Fed wants to do. But I think we're just looking for justification of these multiples. That's really what
I think we could have another leg down.
Understood. The Fed, of course, getting in some
Nicole
more
understands.
inflation prints last week, watching what's going on with the Labor Department. What do you think the Fed will do in November and December and beyond?
Well, what I think they're going to do and what I want them to do are two different things. I didn't want them to be so aggressive. But
Hey,
I do believe they're going to cut a quarter.
that's
basis
not funny
points.
at
I
all,
think over
mister.
the next 12, 18, you're going to see 150 to 180 as they try to bring the neutral rate in line. And what I mean by that is the Fed funds rate is about 4.8%, and they're claiming inflation's under 3. So that gives them room to bring interest rates down by 180 basis points, and I think they will. I don't think it's going to be as aggressive because there are signs of inflation still being there. It's still stubborn, but the Fed is committed to go lower, and I think they will do that. Now, again, if there's a shock to the system, it may hold it off a little bit, but I think they're going to go lower over the next 12 to 18 months.
Maybe they could pause in the next meeting, or no, you think it's 25? I mean, right now you have 86% likelihood
No pause.
for the 25. No one thinks 50 bips anymore, even though the last one was unchanged. Has almost a
1070.
14% likelihood. You think we're going to get the 25? And why not wait one meeting?
I wish they would have only done 25, and then they could continue at a lower rate. But yeah, I mean, if you look at the predictions that the market's been claiming, they've been wrong for the last
58,
several
50
years.
puts.
The Fed's going to, cut interest rates last year and more aggressive at the beginning. I think the reason they're going to give you 25 is because they're going to say that the trend is lower, and they focus on the trend, not the most recent, just the recent number. They shouldn't cut it by 50 basis points. There's no reason. If they pause, I think the market will get a little spooked, and I think you see a little bit of a sell-off because the market wants lower rates. And it's pricing itself for much lower rates.
Right, understood. In the meantime, when you look at the global picture and think about how OPEC is
58,
lowering
40s.
demand, I mean, so much of this has to do with China, but lowering the
China.
demand outlook for oil for 24 and 25. What do you think of that?
I think it's reflected. If you look
I
at
think
the
China
large
sucks.
integrated oil companies, they're not doing that great this year. The Chevron and Exxon, we haven't invested in Chevron, but they're not doing the greatest. So
You're too funny, Jim.
Showing that, and they're redeploying assets for the basin, in Texas, and looking at that areas to grow. But I think the economies are slowing worldwide, and they're telling you they're doing that. And you're seeing governments start to cut.
58, 40s are looking
you're
good too.
A massive cut of liquidity across the board, and as time goes on, I think you're going to see it. China's a whole different issue. China's paying their own brokers basically to buy their
A lot more
stocks
serious.
on top of their economy. But so it's very hard to say what they're going to do. But the economies are slowing down worldwide. They're just not recessionary now. I mean, but they are slowing down, and with major deficits, we need cheap money. That's basically what the governments are saying.
Yeah. Some of your picks as we talk about these international situations, you do have a few aerospace and defense names in your sights, right? You have, my mistake, but I think you have Lockheed Martin on there, right? Tell me a little bit about that.
We have Lockheed Martin and General Dynamics. I mean, we're both very bullish on them both, but they've run up pretty strong this year. I mean, Lockheed Martin, they have 35s, you have, demand worldwide, basically due to the uncertainty, and they're starting their production, they're getting their act in order. So as you have more demand for fighter jets, they're supplying everyone. So we really like them. General Dynamics is your Sikorsky, is basically your Abrams tanks, your Strykers, and 20% of it is the aerospace side of the business, the Gulfstreams, and that's starting to come back online. You're seeing the G700s will be coming online. So we like both of them. The world is extremely uncertain right now. You're seeing that in the Middle East, and you're seeing that over in the Ukraine and Russia. The world is basically on a powder keg right now, and nobody's really taking much notice of that. The market is turning everything off. But you could have a problem in the Middle East with Iran. You could have a problem that Ukraine gets out of hand with China. And we think these are two great plays for the portfolio. Again, we have investments in that, and we're dividend investors, and they've rewarded investors over the long term.
Yeah, and when we think about politics, we sort of have somewhat of a neck-and-neck race for president, but also how Congress gets shaped. A lot of folks are in a wait-and-see mode. Are you planning a portfolio one way or the other? Depending more about
not much you can do, honey.
Less about the politics, please. But how do we set up now between now and the end of the year or into January?
Take your money and run.
Again, leave politics out of it. Just look at they're both are saying they both want lower interest rates and they both want to spend a lot of money. So in our opinion, you're going to get low interest rates and high deficit spending. So we could see the yield curve actually steepen, and we could see the 10-year and everything go longer. Because both sides want to spend a lot of money. You have social programs, you have military programs, you have tax cuts. I don't really see a difference economically between the
58, 50s
two. Basically,
are getting
they
cheap
want lower
again.
rates and higher spending, and that creates more deficits. And we think that could be inflationary on the long-term end of the yield curve because deficits are going to go higher regardless. So we like that. That's why in our bond portfolio, we're shorter on the yield curve right now because we think you get paid better. And we think as interest rates come down the short end, we think longer end you could see a steepening of the yield curve as both sides want to spend money. We don't see anyone talking about deficit reduction.
Right, right. You know, we did have reinversion of the yield curve. I mean, that sort of began late last week. That's something you're watching. Does it indicate anything to you? Are you a believer in watching that?
Yeah, I am a believer, but I just think right now it's so much spending took place. Look, the U.S. Treasury has spent so much money during COVID and did it with short-term bonds that the Fed wants to cut the rates. So we could see the 1-year come down probably to the low 3s. And you could see the 10-year probably go up to the mid-4s. And we think that would probably be a better yield curve. But right now, the Fed is focusing on the short term. And we think when you look at it, discounting, you know, like a slowdown in the economy because the 10-year's down, we think, no, we don't look at it that way. We look at the Fed's going to cut, and we think it's going to be inflationary due to higher deficits later on down the road. But right now, the Fed is telling you they want to cut.
Yeah. Yeah. Sorry to interrupt you. I wanted to ask you about Google because, you know, the question is whether or not the AI play is still alive, very much alive. You know, what inning are we in? This is a name you like for the long term, right?
Yeah.
Yeah, I do. And, you know, we just started that position recently when they started paying a dividend. Roughly, you have a company growing over 10%. The YouTube side of the business is growing, plus the cloud is growing, and they're roughly 10% of the revenue, respectively. The stock's trading roughly 20 times earnings, and it's discounting, I think, all the negativity. It's down from like $190 a share. So we think here, they're going to be the big beneficiary. Now, you're facing the government issues. You're facing all the talk about a breakup, and we think that's gives us an attractive entry point. And when you compare it to the other Magnificent Seven, if you will, they're trading at much higher multiples. So we see there's really top-line revenue here. Advertising's looking good. So we like the company, and we think, you know, asymmetrical risk return. We see there's more upside than downside. And if the government were to jump in and break it up, it'd probably unlock even more value for the company. So we do like it. We do think it's a major beneficiary of AI, and they're not being priced at such a high multiple compared to like the Apples, the Microsofts that are trading over 30 times earnings.
Yeah, yeah. And look, as we look at all the Mag 7, there's a lot of debate about which ones have more value. Later today, we'll have Dan Ives, who really likes Tesla. He has a $300 target on Tesla today. So there's a lot of discussions to be had. But to your point, AI for Google, and it's a name alphabet, we will continue to watch. Max Wasserman, thank you, of Miramar Capital. Good to see you. Thanks.
Thank you so much. Have a great day.
You too. Thanks. All right. Plenty more to come here on Trading 360. Up next, it's the big three. 3 stocks, 3 charts, 3 trees. Kevin Green will take us through the technicals. Mike Shore will take us through the trades. For J.R. Horton, Block, and Alibaba. Next on Trading 360, right here on Schwab Network.
Market's a tough one today. Nvidia coming back and retesting right now. SPY tested the VWAP. Missed that. Sure did. How many minutes ago was that? That was 3, 6, 9, 12 minutes ago. Oh my. Yep. Been a perfect buy.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. So glad you're with us. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. It's time for the big three. 3 stocks, 3 charts, 3 trades. Kevin Green will take us through the charts. Here to take us through the trades, Mike Shore, Director of Trading Education at Prosper Trading Academy. Good to see you both. Good morning. Mike, how are you feeling about the market these days? I mean, we have an election coming up. We'll have a couple of Fed meetings. You know, we had record closes on Friday. Do you see more records ahead?
I see pullbacks, and I think you should buy those pullbacks. And until I'm wrong, then let's keep doing that. That's been the whole story of 2024.
Yeah, buy the dips. Okay. First up, you have DHI, which is trading around 185 today.
There it is,
Tell me
to the 50.
Yeah, so what I'm looking at D.R. Horton, they have earnings coming up. I do like the fact that they are almost holding. They're sitting right at its 50-day moving average. And with the interest rate environment and everything else, I certainly like the upside more than the downside. And I believe, from an option standpoint, that the implied volatility will hold up there. So even if we stay here or go a little bit higher from here, I think that this is you might get a nice move up into earnings, and if not, then that implied volatility is going to hold for the call calendar that I'm putting together.
Yeah, understood. Let's take a look here. I mean, you do see a winning day here for D.R. Horton. The chart does look pretty good. But of late, let's have Kevin Green look through those technicals, please.
Yeah, obviously the chart has been to the upside here, and we've had a lot of optimism when it comes to the rate cutting cycle, and that could actually fuel some of the gains here for D.R. Horton. But we are seeing a little bit of weakness here in the near term, Nicole, especially if you're looking at the 1-year daily chart. The first thing that actually pops out to me is going to be that 20-day moving average, which we have failed and kind of breaking through this channel that we've seen, let's say, since the beginning of August. So that would be kind of the first signal for me that I would be a little bit more cautious. But there has been some pretty decent technical setups for this name for a fairly long time here. You have support sitting at 165.25. That's going to be your first area of support. The next one, 156.80. And then the last one that we're going to be looking at here is going to be 139.30 for the most part here. The 200-day moving average has been a key area of support. So even if we do see a pullback, I expect maybe some buyers to actually kind of step in for now. And then for the upside move, it's kind of hard to find an extension here. You could actually look at maybe the $230 level over the next 3 to 6 months if we do have favorable data. But overall, when you're kind of looking at this bearish divergence that actually took place for the RSI, that's been in place since late July, early August, and the MACD is doing the same here. Now, this is a trending stock, so sometimes you can get false signals, but I would probably expect a little bit of a pullback from a technical standpoint before trying to move higher here, and that may actually happen here in the next couple of trading sessions.
I'm sure you're watching the 21-day moving average. You're watching the RSI, which has turned things like that. Final thoughts, please.
Yeah, so this is more of semi-directional, but even more so that I'm buying implied volatility with the overall bullish trend. Excuse me. That I think that the implied volatility will hold this spread up, and so you buy the implied volatility after earnings and then sell the one before, and then before earnings.
Yeah, understood. Okay, how about we get to what used to be Square? We call it Block now. SQ is still the ticker symbol. It's trading around $70. This is a name that has been all over the place the last several years. There was some really high hopes pertaining to the Cash App, and then some of your thoughts on where this one could be headed today at around $70.
Yeah. I agree with you. This is a frustrating stock, but we have gotten above and are holding above the 200-day moving average. Yet at the same point, the IVR, the implied volatility rank, is at about 62-63%, which means that only 37% of the time implied volatility is higher than this. And so I'm going to go with the trend that we're going to hold this 200-day moving average, and yet still, and with most stocks that are above their 200-day moving average, you don't see implied volatility in the upper half, much less almost the upper third of implied volatility. So I'm going to sell a put spread here.
Okay, he's selling a put spread. That's where he feels he's watching that volatility too that we've been seeing. Kevin, some of your thoughts on the chart, please.
Yeah, as you kind of talked about, the stock has been all over the place. And if you're kind of looking at that 1 year daily chart, it is consolidating for the most part. But that 200-day moving average has been a key area of resistance over the last 2 to 3 months. Now, Mike is right. We are actually breaking right above it right now. But I'd like to see some greater follow through. And I'd like to see that follow through on a pretty large volume here. Now, one thing that is kind of key, we are in this ascending channel that is taking place, but it's actually kind of contracting. So you are expecting maybe either a break to the upside or a break to the downside here. And hopefully this is not a consolidation range where we actually continue to see some of this bearish price action from the highs of around $87.50. First area of resistance that I would focus on is $72.50. If you get above that, once again on large volume, I think that's probably where you would see a breakout. But a breakdown below the $68.93 area, which is that 200-day moving average, could put into question the further movement to the upside or potentially a breakdown further for the stock moving forward. The point of control on the volume profile is sitting at around $64.60. That's another area of support. And if not, and we do break and see a flush to the downside, $47.50 is where you can actually see some buyers stepping in. I also have it highlighted here on that chart. Around August 2nd, we did see this nice little power candle or this reversal candle taking place. That also coincided with a large amount of volume. So we did see a shift in sentiment for the stock in the near term. Now you're just going to need to see some follow through. That MACD is also actually very bullish, making higher highs on a relative basis and just crossing over that zero line with a 12 EMA, trying to cross above that 26. So yeah, I would say this is a coin flip for the most part, but it still has to prove itself to try to get above that 72.50 area. It's going to be a key area for me to say maybe this trend is going to be to the upside and a breakout is apparent.
Yeah, I mean, look, year to date, we're down. We're down 8%. If you look at a 1 year chart, you could say we're up nearly 60%. But the year to date, and then we remember when this stock was 270 or something a couple of years ago. So people, as you noted, the shareholders have been whipped around. But, now is now, and that was then, Mike, right? So you're making your calls here.
Yeah, so this is a risk to reward scenario here. That we do hold that 200-day moving average, and if we can sell that put spread, if we do get that pullback to the 200, you should be able to get about 1.25, 1.4 to 1 that you're laying odds of holding that. I do not think that Square is going off to the moon. My bet is, and that's what option players do, is that we are going to hold or go or stay here or go a little bit higher.
We have an expansion pattern.
Okay. Next up, Alibaba. We talked about China stimulus, and there was actually a meeting on that this weekend. A lot of questions about how much more would be coming, if at all.
You're ready to
Alibaba had,
squeeze.
just like many of these Chinese stocks, had an incredible run up recently. In this case, I mean, if you looked at a longer term chart, you would certainly see the most recent spike up to maybe 117 or so. Where do you think it could be headed now at 109?
So at 109, so the whole thing is based on just China just pumping money into their anywhere that they can, and Baba's going to be one of the places that would be the first place that they would do it.
That's what they say.
So what you're looking for, and what we continue to think going forward, is that China's not showing any signs of stopping this. They have plenty of money, and so I'm looking for any sort of pullback. And so this is actually what I call a whole reversion here. Just that we saw some new highs or recent highs, pull back, and then go up from here. very difficult market to trade, but you know, that's the thought behind this.
Yeah. All right. You know, Kevin, any final thoughts here?
Yeah, less optimistic when it comes to BABA in the near term here, Nicole. It had a really nice run to the upside. We actually saw a basing formation pretty much since the start of this year up until September. And then we had that breakout to the upside. But what is a little bit concerning is, one, I have it highlighted there in that circle. You had this hanging man candle, a very aggressive one. We actually had some buyers kind of stepping in and try to advance the stock, but then we did see a failure. That's a reversing trend. And we also have two major gaps that could be filled here. Gap one sitting between $97 and $102, and then gap two between $90 and $94. Those could actually be filled. Now that would not be overall bearish for this stock because it would still maintain its uptrend. And you can use that upper channel line that's sitting at around $86.60 as an area of support before trying to break higher. Just very thin up here. MACD is also crossing 12 below the 26 EMA, and I've highlighted each and every time that we have seen these MACD crosses that the stock does actually pull back. I would just be very cautious with this name in the near term, next couple of weeks.
Yeah, Mike, short final thoughts. Yeah.
Totally agree. Again, a reward to risk. So a 13-17 call spread here that you can buy for October 25th for $1, and basically right where we're sitting there right now, we're getting 3-1. So that is.
That's the Boeing.
I agree. I don't think this is going to 125 or anything like that, but I do think that we could revisit the recent highs, and then you know I'm a trader in this in this way, not an investor. So I'm looking for the next 2 weeks.
Yeah.
Give or take.
All right, good to see you both. Thank you for the big three today. Right, we had D.R. Horton, we had Block, and we had Alibaba. Thank you, Mike Shore, Prosper Trading Academy, and our own Kevin Green there on the charts. Thank you. Coming up, we'll spotlight the week ahead. Peter Tuchman will join us right here at the New York Stock Exchange. I also sat down with Peter Tuchman on this week's Market Overtime, airing 4:30 and 8 p.m. Eastern Time here on Schwab Network. His many decades here on the floor and what he's thinking now. You don't want to miss it. Check it out.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday,
There's the pullback.
Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network. Ethan! How's my favorite client?
Great! I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends?
All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Trading at Schwab is powered by Ameritrade, bringing you futures and forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Welcome back to Trading 360. I'm Nicole Pedalides, live on the floor of the New York Stock Exchange. Time to spotlight the week ahead. Joining me right now, Peter Tuchman, Senior Equity Floor Broker at Trade Moss. Glad you're here.
Good morning.
Good to see you. Friday, we had record closes. You know, for every time we have pullbacks and every time they get to see records again. It's pretty amazing. You think we'll see more records between now and the end of the year?
I really do, and it's not.
Jimmy might see more.
Crystal ball. It's just the way the market acts, right? It really feels like
9:20. Did I just hear a fart, old man?
To April, then July.
I think he just farted.
August 5th, then the first week of September. These were the most significant pullbacks we've seen this year, and each one of them, and then the last one, a week and now, whatever the October 5th, right?
I'm sure he did.
Significant pullbacks, whether they were a day. The biggest one was probably April, which was a month, and it was a pullback of 9%. But every one of them was rebuffed by a much stronger rally, right? And you know, look, if people wanted to be selling this market, if people didn't have confidence in the market, in the economy, in the future, in interest rate cuts and the Fed, they'd be selling the market. We're at record highs, right? And so
oh man, please.
Where, you know, this would be the place where I think.
Don't get me started.
I'm going to ask you about the election because I'm hearing so much anxiety from folks. But I'll leave that in a moment. I do want to focus on this week. We have a slew of banks.
You tell him.
We already heard from JP Morgan, Wells Fargo.
Nicole.
So far, so good, right? We're getting more.
Tell him what I told you last night.
And pretty good, right? What did you think?
Yes. So it's, you know, when you get earnings out, when stocks are trading at record highs, like that means that they've got to be firing on every piston.
That's right.
To be able to come
every
up with
piston
earnings when they're trading at such great valuations, and they still are, right? And that shows so the banks are healthy, right? Consumer seems to be a bit healthier as well, right? You know, look, we are flip-flopping.
Wrong.
1 week we're getting, you know, numbers. Look, 258,000 jobs created, right? Last week, that was a good number. Unemployment down to 4.1. So we're getting more good news than we are getting a couple of reports that are not great, but I think for the most part we're looking good, and we've got seasonality, right?
I was reading about yes, we do. I was reading Susan Collins was saying some back and forth. You know, looks like it could be a soft landing, but we're still watching inflation. We're still watching jobs. We're still, and she'll be a voting member next year for the Federal Open Market Committee. You know, what are your thoughts on what the Fed should be doing? Because we have 2 more meetings this year.
Okay, so what do I think they should be doing? I think, look, we definitely, I believe, 1 more 25 basis point cut, and if the data allows it, another 25, so that we will have gotten 1 full basis point cut by the end of the year. I think the market can handle it. I think that everyone will be benefiting from it. Right. I think it's best to cut them as we are in a nice rally, as opposed to do it. It's proactively as opposed to reactively. I'm a firm believer in that. We don't want to play catch up. We don't want. Look, we saw that happen. I think in August. Part of the analysis of that August 5th sell-off was that they had missed the opportunity to cut at the end of July. Remember that? You know, we came in, we had a week of Fed meeting on the Wednesday. We had the jobs number that was disappointing Thursday. We had the escalation of the Israeli-Iran thing Friday. The weekend was a Japanese crash, stock market crash, and we came in on Monday. We were down 1,000 points, and people were thinking, you know what? I think the Fed missed the opportunity, and perhaps that's why we got the 50 basis point cut we did, because they were playing catch up.
Right.
Oh, slick old man.
Tomorrow, it was always like to see the New York manufacturing print. Sometimes it tells a different story.
Very
The
good.
Consumer Price Index on Wednesday, jobless claims on Thursday, retail sales, just to name a few of the things that we'll be watching as far as the economy. Are there anything, home builder confidence index will be in there, business inventories and
She'll
housing
crunch you
starts
if you
on
don't
Friday.
behave, my
Some of
man.
your thoughts on the big picture for the economy? Is there any of these numbers that you're definitely not going to, I know you won't miss any of them, but you're definitely not missing.
I think we're going to, at some point in the near future, is going to probably have to address.
Good question.
Right, because you're affecting insurers and reinsurers.
Right. He's got him shook up.
Affecting a lot. Those were major events, right? And I think we're going to probably.
Yeah.
Is it going to completely dislodge the trajectory we're in at the moment? No, but it's
No.
something to keep your eyes on. And I think that we are. Look, politics rarely have an effect on the market, but this is such a controversial election, right? Whether it's
Really
policy
is.
related, whether it's the bifurcation of the dissent amongst the ranks, that we're so split, right? You can't sit down to Thanksgiving dinner with someone that you're on the opposite side of. It's become a strange.
I was in a bridal party a couple of weeks ago.
Oh, you
The
were?
girl didn't want to walk with the gentleman. She was Democrat and he was Republican, and
And they
she
didn't
called
wanna
the
go.
bride
No.
the night before and
Like
said,
that.
"I'm not
So
walking
that-
with
yeah,
him."
so that's crazy.
I mean, I said, "Zip it."
Yeah.
Everybody just go down the aisle. Anyways, they changed her. When you look, they changed her. It's unbelievable. I mean, just keep it,
Look, Santa Claus rally, right?
Santa Claus rally for investors. That's always a good thing.
Right,
So
we're getting
some
through
new
October
highs.
quite
Buy
well.
the dips. I mean, you're the buy the dip.
I'm a
You're
buy
a
the dip
forever
guy,
bull.
absolutely.
Right? You said it
And
last
it's
week in
not
our
me.
overtime.
Yes, and I think it's not even me. It's just look at the historic data. Proves out that if you've bought every dip, right? Whether you bought the dip in tech, whether you bought the dip on August 5th,
Yeah.
whether you bought it the first week of September, which is the worst week for tech since COVID, right? We saw it, right? And so the market tells me that. It's not that I have a crystal ball.
What do you think about the 10-year? 4.13.
For me,
Come on, weren't you surprised when you saw that?
Yes, I was,
Now
but
it's
I'm
still
not
clicking
able.
higher?
That doesn't. My brain can't get wrapped around the whole.
Not watching that as closely.
Yeah.
Not watching that as closely. Some of these names, and when you talked about the banks, we noted that they're doing better.
Look at
Dan
Texas
Ives is
rebounding
coming on.
beautifully.
Your friend Dan Ives is
Yeah.
coming on later today. He
Oh,
likes
is he?
Tesla.
Oh,
Yeah,
okay.
he has a $300 target on Tesla.
Okay.
We have Apple that Caroline Woods is going to come and talk about the outperformance
Caroline
list
Woods?
over at Evercore ISI. There's a lot, and we just had a guest on. Mike Shore was looking at, or one of our guests was looking at Google. So Max Wasserman was looking at Google, so he likes that. So a lot of the Mag 7s still have, and NVIDIA is pushing highs.
100%.
So people are still liking Mag 7. Do you like Mag 7?
Yeah, I do. And it's just because of the way they act. And that they've obviously gotten knocked down a couple of times over the last couple of months.
Yeah.
And they bounce back. Look, obviously Tesla is going through a little bit of some growing pains here, and they are painful. I know a lot, and I know that's probably hard for Dan too, because he is the inveterate bull in Tesla as well. And I think a couple things
And
that
he was
came
hot
out
on
there.
Apple too.
And there he was right, and on NVIDIA he's right, and Tesla he's still convinced that he will be right, and that's fine.
Yeah,
right down the line.
Understood. Let's get to the election, because I know there's always a lot of noise and a lot of folks say
She
"We think
understands.
all these elections and look what happens." The concern that people express to me is that we could have a real reactionary sell-off for whatever reason. And how long will it take to get back to normalcy? I mean, you remember, first of all, we dropped 50% in the market during the recession, the Great Recession, right? We saw a big sell-off during COVID. The question is, if we have big sell-offs, are they buying opportunities? Maybe yes, but how long until you get back?
So think about it. Think about when Trump was first elected. The night he was first elected, we were 3 in the morning. We were down 1,000 points.
I remember.
By the time we came in that morning, we were up 1,000 points. So we had, within a 4-hour period of time, we had a 2,000 point reversal, right? It was, whether it was short covering, whether it was people trying to understand the news, what it was going to be like with the Trump presidency, whatever it is. And I think we're going to, whoever wins, we're going to see a major reaction. But I think that the boat will get, what's the word? The boat will get
Right, we'll get even
righted.
that level.
We'll get righted
Right,
quite
right.
quickly. And not for any other reason than that's what the market has been giving us.
Right.
Every sell-off, we think about I think August 5th was significant in so many ways. We had a perfect storm, led to that major sell-off on Monday morning. The opening print at down 256 handles on the S&P on Monday was the low of that little tranche of a sell-off. And we spent the next 2 weeks clawing back all those losses.
Right.
So the market, that's what the market's doing.
So you're going to say that it's probably going to be noise, and it could take 1 day, 2 days, 3 weeks. I don't know. Is it more of a near-term problem?
Do we know? Do we know
Well,
is
here's
it
gonna
going to be negative? Is it going to be negative or not?
I don't know.
I don't either.
Could be great,
It
right?
could be
great. And then that might not last either. I mean, I don't know. But here's the thing, and there's a lot of anticipation too that we may not know. I mean, they're going to have to go back to certain counties. Correct. They're going to have to recount ballots because some areas will be very close.
Correct.
So I don't know.
That's why I try not.
Like that.
I try not to get too wrapped up in the election because I don't think. It's just not worth getting going.
China stocks, do you like those or you don't stay?
So look, the thing going on with China, there's obviously a number of tranches of major stimulus happening, and China markets are a bit skittish, right? You saw a major rally when they announced the first ones, and then you saw an immediate pullback. And then they're announcing, they're sort of dangling some more stimulus today, right? We've not seen the market rally in anticipation of that. So I'm not really sure. It's a very scary market in my opinion.
All right.
It was just at $6. Now it's at $6.90.
Market stuff.
Peter Tuckman of Trademont, thank you so much for being here, and everybody can continue to watch the market overtime
that kind of
special.
sucks.
That Peter was our feature guest during that time.
We're acting beautiful.
His decades of experience here. Peter Tuckman, thank you.
Thank you.
Coming up next, disruptors. We'll focus on Broadcom, Mizuho raising the price target there on the shares. George Sillis is standing by. He'll walk us through the Mizuho note. He will give us an example trade. Stay with us. We'll be right back.
Don't get Bobby started. Do get Bobby started. Doo-doo. I was just watching this little ride up, wanting to know when I was going to get in it. The 5850s. So I went to look at my coffee, see how cold it was, and before I knew it, she went from 6 to 690. Bam! All because of Dan Ives. You think you're cool, don't you, Dan? You and your pink shirt.
On the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome Welcome back to Trading 360. Glad you're with us. I'm Nicole Fedelides, live on the floor of the New York Stock Exchange. Look at developing stories this morning. We bring in Caroline Wood, taking a look at Apple. Caroline Wood, senior markets correspondent here on Schwab Network, and Evercore ISI releasing a note on Apple. Some of the thoughts from that one, and outperform on there.
Yeah, and adding it to its tactical outperform list. Evercore says it's bullish heading into earnings.
Is that a
Earnings,
big
of
deal?
course, later this month on October 31st, Halloween. The Evercore analyst notes that Apple sentiment has turned more bearish in recent weeks, but thinks that those
I didn't know that was a big deal there.
likely lower than current consensus estimates. As such, says Apple is well positioned to outperform against low expectations in the September end quarter, and even more importantly, on the December end quarter guidance. So in-line results against current estimates should enable the stock to move higher. That's what we're seeing it do today. Shares are up about 1% today. The Evercore analyst saying bearish investors remain focused on the Chinese smartphone market, but we think the risk here is overstated and can be offset by growth in developing markets and a strong upgrade cycle here in the U.S., where our survey work points to strong upward demand, driven in part by AI. Of course, those Apple Intelligence features have yet to actually be released, but those will be coming soon. So as you said, Evercore maintained an outperform rating on shares and a $250 price target. If you take a look, Apple shares currently trading right around $230, so $20 upside from here, according to Evercore. And I should note that 73% of analysts at this point still have a buy rating on shares of Apple, despite the fact that they're only about 3% away from the highs.
All right, thank you for that. And we see it higher today by about 1% at 229.84. Caroline Woods, thank you. It's time for the disruptors, and George Sillis is here, a senior markets correspondent, taking a look at Broadcom. A note from Mizuho and a price target raise along with it. Let's hear about this one. Good morning, George.
Good morning, Nicole. Yeah, actually, if you look at Broadcom in the past few weeks or so, it's actually broken out of a trading range, $180, but it's pulling back today a little bit. But one of the things about this company is first off, Fortune 500 companies, about 80% use their technology. And everyone's talking about the hardware for artificial intelligence, but what's interesting about Broadcom is it really started off as a application-specific integrated circuits company and a semiconductor products company, providing things like, or selling things like set-top boxes and integrating 5G and Wi-Fi networks with hardware. But at the same time, it's really become a company that's evolved into integrated infrastructure, software, and security solutions. And essentially, it's an infrastructure backbone stock that integrates data, networks, and AI server technologies, as well as the infrastructure associated with artificial intelligence. And if you look at last quarter, the company denoted about 43% additional sales that included AI interfaces, and they do expect about 55% of their sales are going to be AI related going into 2025. And with that said, the company's estimates have been growing about 14% last year in earnings estimates. In terms of earnings growth,
overhead resistance
expected next year. It's trading around 29 times next year's earnings, and typically speaking, when you see companies growing at 20+% earnings growth, they can trade around 2 times that earnings growth. And so Broadcom seems to be trading less than that, and I think that's why Mizuho has actually raised their price target on the name. They do maintain a buy rating on the stock, but they increased their target from 190 to 220. I think it really comes down to that the company is actually growing into its earnings, and I think that speaks to why the stock is breaking out. But again, a little softness today in the software space, and that's why it's pulling back.
Okay, so with that, how would you go about an example trade today, George?
Yeah, so I think the breakout is important. It happened last Tuesday above the 180, and it corresponds to levels the stock really had trouble getting through, and it goes all the way back to June, July, and again going back to late September. So I think that level will hold. You could see a little bit of additional pullback closer to that 180. What I'm going to do is I'm going to structure a bull call spread for November monthly contracts around that 180 level. And so I'm going to buy the November monthly 180 call contract, and then I'm going to sell simultaneously the 190 against it. And so altogether, it costs you about $4 a share or $400 a contract. So break even on the trade is 184, and max profit is $6 against that $4 potential risk, and that happens if the stock hits 190 or higher between now and the expiration in 32 days.
All right, George Sillis, thank you for that. A good look there at Broadcom today on the heels of that call and an example trade. Thanks. Coming up next, our 360 round earnings season is underway. We heard from the banks on Friday. We'll have a slew more this week.
Oh, now we
Our
broke
panel is
out.
ready to break down the numbers on Friday and what they could tell us about some of the other names to watch throughout this week. We have Kenneth Leon and Stephen
Jimmy's
Bigger.
odds now aren't as high as they were. So I don't know. I'm gonna put so far so good. Had me nervous there for a second.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network. Ethan! How's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech. Trends?
All that research sounds exhausting.
Nope. Schwab's technology
It
does
is
the work.
exhausting.
So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
It's time to look forward
Find the next trend.
from every click to every tick.
There's no fear of missing out on next gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. It's time for our 360 round, all about the financial sector. We saw them highlighted beginning on Friday. We saw some good numbers out of JP Morgan Chase, Wells Fargo, BlackRock. We're all in focus on Friday, and we have a
BlackRock.
big banks due this week. We'll watch Citigroup, Bank of America, Morgan Stanley, among others, just to name a few. We're likely to be in a lower interest rate environment, though that's not necessarily evident in the last couple of days. Kenneth Leon is with us, Global Director, Industry and Equity Research, CFRA, and Stephen Bigger is with us, Director of Financial Services Research at Argus Research. Thank you both for being with us. Kenneth, I know you have
Tight stop.
A buy rating on JP Morgan, for example. What stood out from what we've learned from the bank earnings thus far, and how will it make you watch certain parameters this week?
Yeah, it's great to be here. So really no surprises compared to our preview. We're overweighted financials from a strategy standpoint. We think the largest banks and really some of the other major financial companies are going to be delivering strong results, strong outlook. I think on differentiation with the largest banks will be, as we have Goldman Sachs and Morgan Stanley, which don't have the high exposure or percentage of revenue from net interest income, but benefiting from investment banking and other services. I think additionally, our analyst Alexander
Went ahead and broke out.
who covers the regional banks and smaller banks, we're seeing a picture of still a pretty healthy consumer. Every quarter, we go through the entire banking industry looking at credit risk measures, and so far things are good. So I would say stay the course with financials and these banks.
Yeah, and I saw there's a buy on Goldman Sachs, you have a buy on Morgan Stanley, the buy on JP Morgan that I mentioned. Stephen Bigger, when you were looking at these, you did note some of the, the lending that slowed for credit cards, sluggish loan growth, but the big picture here is still pretty good. I mean, you said net charge-offs, for example, were maintained. Some of your thoughts from the quarter?
Yeah, hi, Nicole. I think the results were pretty good. And you saw the bank group rally on Friday. and I think for good reason. So yeah, loan growth has been sluggish. Higher rates have persisted now for a couple of years, and that's put a big headwind in lending growth at this point. But lower rates from the Fed, I think, are going to help. We've had lower rates from on the 10-year side already, and that should help stimulate some growth, loan growth. But you also look at deposit costs, and those should start moving in the right direction downward as the Fed has begun to ease here. So a little bit better picture for the net interest margins going forward. And then you did mention card losses and just net charge-offs in general. So I think that's for JP Morgan, maintained that 3.4% net charge-off guidance. And their credit cards had been a worry going in. We've had some pretty robust growth in there. It did slow down a little bit, card lending growth, but to be able to maintain that 3.4%, I think shows that they feel the consumer is in good shape here, and credit quality is not a concern for at least the next few quarters.
Yeah, we'll hear from Bank of America tomorrow, Morgan Stanley on the 16th, for example. Do you have buy ratings on any of these names, Stephen, right now?
Yeah.
I do. We reiterated the buys on JP Morgan and BlackRock as well, and Wells Fargo. So, and we have buys on Goldman and Morgan Stanley. I think this rebound in capital markets is durable. Fixed income issuance is doing fantastic as the credit spreads have fallen. Equity underwriting rebounding, M&A activity rising on better CEO confidence levels. So it's really a pretty strong narrative, I think, for banks across the board here.
We do note here the deal making. We've seen a lot of investment banking. The other thing that we always watch are the rates, but that doesn't seem to be as big of a topic at this moment. Kenneth Leon, you've seen a lot of deal making and investment banking and things like that, right? How's that looking?
Yeah, so rates are
How's that looking, sucker?
We've seen the first 9 months of this year record performance
see a drop.
for debt underwriting. The equity markets, particularly IPOs, a little bit slower, but beginning to come off the trough from last year. And additionally, just rate specific across the table, it's just getting comfortable where rates will be. They don't have to go to zero, but between buyers and sellers. So, for example, when you look at areas like M&A or even equity underwriting, financial sponsors have been a much smaller percentage of the total business. That will increase over the next 12 to 18 months because they're sitting on $1.2 trillion. These are companies that I cover, the private equity firms, that need to monetize that so they can get to new fundraising. So I think a lot of good activity ahead, just knowing where rates can be. It doesn't matter whether it's 20 or 50 basis points here or there. It's just getting a sense in the parameters. And that's going to be good for the Goldman Sachs and Morgan Stanley's especially.
Yeah.
Wonderful to see you both. Thank you so much. Kenneth Leon and Stephen Vigor, thank you both for a great look there at the banks, because we have a slew this week to keep an eye on. Thanks for being with us. I'm Nicole Petalides here on Trading 360 every day at 11 a.m. I see you at 2 o'clock as well for the watch list, so don't miss that. And in the meantime, download our app, the Schwab Network app. It's available for free in the Apple App Store. Tune in 24/7, schwabnetwork.com. I'll see you at 2 o'clock. Fast Market is next.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being getting lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Of course it is.
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
Here we go.
Good afternoon, traders. Welcome to Fast Market here on the Schwab Network. I'm Tom White. We've got a great lineup for you today, including discussions, and we'll have some option strategies. We'll take a look at some more banks that report earnings. Goldman Sachs, which is at all-time highs, into their report tomorrow morning, and Citigroup, which is up about 28% so far this year, into their earnings report tomorrow ahead of the open. And like Folio, they'll break down consumer sentiment data on Flutter Entertainment. The online betting stock has rallied nearly 30% in 2024 and was upgraded today. Now let's take a look at the major indices, which are pushing to more records. We've got the S&P 500, the benchmark, up nearly 0.7%.
Jimmy's going to have to do some mathematical luck here.
0.4%. New all-time highs. NASDAQ 100 up over 0.6%. The Russell 2000 small caps up 0.4%. To help me break down the market action, let's bring in my co-host for the day, and that's going to be Kevin Green, senior markets contributor here on the network. KG, more record highs. It's Columbus Day. It doesn't seem like there's a lot of headwinds to markets or economic data. Earnings season kicked off on Friday. Pretty decent results out of the banks, so maybe we should be at these all-time highs, right?
Yeah, especially when you're looking at the makeup of the advances for today here, Tom. It's not just tech. You're looking at other sectors that are really outperforming. You have utilities up around 1% here. You have real estate up about 0.6% in the session. You also have financials up 0.6%. Now, you talked about those earnings that came out on Friday. We will have another round of those for the big banks coming out tomorrow. And then we'll have some of the smaller and super regional banks throughout the week here, too. And that's really the area that I'm keeping my eye out on. But you're right. I mean, we don't have any economic data today to really try to dampen down this market. We have the bond market for the most part closed. We do have a futures trading, but the bond market itself is actually closed. So there's a lot of tailwinds for this market for now. Let's see if we're going to be able to hold this up going into the close. But this is actually a remarkable last couple of days. Last thing I will kind of highlight here just to kick it off here, this is actually the lowest level that we've seen the VIX in a very long time. I would say actually since October 7th. So for the first time in about a week, VIX actually broke below that 20 level, and we may see it continue to move lower here, and that could actually give equity markets a little bit more of a boost as some of that vol expectations, especially when you're looking at geopolitical risk and election risk, starts to dissipate here over the next couple of sessions.
Yeah, I'm actually surprised, KG, that the fact that the VIX is still just under the 20 level with equity markets at all-time highs, because typically I'd see this price action that we've had, with the SPX and the Dow Industrials up at these records, that I'm surprised it's not at 15 at this point, because maybe it should be, but then, as you mentioned, geopolitical risks, right?
Yeah, well, and actually, I don't think it's so much geopolitical risk. I think it's election risk that's being priced into the market. So if we kind of go back 2 months or 3 months, and if you're looking at the VIX futures curve, we've always seen this kind of elevated VIX in the October contract that was really highlighting the election. And so, yeah, we have some geopolitical risk that started to kind of creep into the markets, but I think that's really just election risk. So even if you kind of look at where we were compared to where we are right now, let's say that we can get down to, let's say, an 18.5 VIX. Based on the election cycle itself, that would be relatively low in my opinion. Also, last week was really kind of that last final week of that heightened seasonality for volatility, so we should also have that as a tailwind leading up to the election. Obviously, we might have some election risk on that day or maybe a couple of days after that, and then once we have kind of the deciding factors, especially when you're looking at Congress, maybe the presidential, then we start to gear up for that Santa Claus rally type of season, and you can see that in the VIX curve as the VIX future for the December contracts trading at around 18.2, but on a relative basis, if we
Santa Claus
down, that should also kind of re-rate to the downside. So this is actually a really good setup. You have the economic growth from GDP. You had a stronger labor report. Yes, initial claims came in a little bit hot last week, but we also know that we also have some weather events that are taking place. Maybe the port strikes might be trickling into that number for the most part here. And for this week, I mean, the biggest headwind for me, Tom, and I'll ask you this, it's retail sales, and that's pretty much it. I don't see anything else that's really on the calendar for the U.S. side of the equation that could really kind of rock us off of this upward trajectory that we've been seeing over the last couple of weeks.
Yeah, is the consumer holding in there? And you brought up, KG, you already brought up the Santa Claus rally. Man, oh man.
Yeah. We're looking forward here, buddy. We're looking forward. More than just the here and now.
Yeah, I think the markets are looking forward, maybe too much at this point, getting extended here a little bit, but let's extend this conversation, bring in our next guest. That's going to be Alex Coffey, Senior Equity Contributor here on the network. Alex, give me your take, because it doesn't seem like there's anything out there that's going to stop this rally at this point. And it's like that snowball effect, right? Markets are going up. People are feeling more comfortable. Data's been pretty good. And it's almost like that snowball wealth effect where, hey, you want to push into things that are working out right now.
There's a phrase, and I always want to attribute to someone because I can't remember who I first saw it from or heard it from, but a hedged pot rarely boils. Volatility is elevated because there's been kind of a risk-off sentiment behind the scenes that's sort of positioning ahead of not only the election, but you start looking at the 30-day window that we're in right now going out into the future. You're going to have a next month's jobs data. You're going to have a CPI again. You're going to have PCE. You're going to have PPI. You're going to have a Fed meeting. There's a lot of things, including the election, that are on the calendar over the next month or so, including all the earnings. You guys mentioned retail sales Thursday. You also get TSMC Thursday morning, and from an earnings standpoint, you also get Netflix Thursday afternoon. Today might be a holiday where the markets are open, kind of an extended trade from Friday with not a lot of new news. Thursday is going to be a completely different animal. I mean, we might see, from an action standpoint, it all centered around Thursday for the most part this week in terms of ultimately the settle of the score. But until then, maybe more of the same. I mean, until you have something derail it, you got to defer to the trend. And, sometimes it feels gross thinking that, especially near all-time highs or at all-time highs in several of these indices. But to both of your guys' point, there's really not a lot to get in the way of things right now. And even when you look overseas, where you could say, okay, incrementally maybe dollars will just find other homes as opposed to the U.S. markets, there's already doubts from some of the stimulus out of China. Is like, is this even really going to do much? Is this big enough? Well, what's it?
Spy at the top two.
Right. And you're already starting to see some doubt settle in there. So again, it has that couple weeks of in
1, 2, 3. We'll know something
But the U.S. has been
real
the best out of
soon.
the block. The block maybe is in better shape than many thought a year or two ago. But even if it isn't, it's still the best place. And being the best at anything at any point is always preferred over being the kind of the turnaround story.
Yeah, with that soft landing narrative, all the money, they keep talking about the money that's on the sidelines. Some of it's pushing back against the markets, but it's almost like the positive or optimism that we have here in the equity markets is blending into that pushing equities higher. And typically the fourth quarter is the strongest of the year. But KG, Alex mentioned China and the stimulus. They had a press conference this past Saturday. They expected more details. They didn't get a lot of details, but I don't think that matters at this point because it's just maybe the thought that the Chinese government and the finance minister is on board with providing more stimulus at some point, right?
Yeah, they're giving me guardrails. I mean, if you're kind of looking at the commentary itself, they have the ability to expand the balance sheet or expand their deficit in order to kind of, attack some of these areas of weakness in the market. The market wanted to hear more. It does sound like they're also going to be issuing some sovereign bonds. It was reported around $1 trillion worth, $1 trillion yuan worth of sovereign bonds over the next year to be able to also assist with the stimulus. So I think right now it's just the data has to be reflected in that. And we just have to be patient. Stimulus is not going to be reflected overnight here, Tom. But if you actually do see maybe lack of enthusiasm there, that's also going to permeate when it comes to the commodity market. Now we are seeing crude kind of pulling back here a little bit. Maybe that's geopolitical risk kind of getting backed out of the market. Maybe some of that China stimulus measures being backed out of the market. OPEC lowering their demand. That's really kind of what the Fed really wants to see. You do not want, if you're the Fed, you do not want to see a massive ramp up in the Chinese economy while you're kind of going through the steps of a soft landing. That puts you in a little bit of a rock and a hard place between inflation as well as trying to not only just maintain jobs, but to have a steady course when it comes to the rate cutting cycle. So I think that's kind of everything that's kind of wrapped into that. Last thing I will say, regional banks, keep your eye out on those for this week. I want to continue to harp it because they could actually be that catalyst for small caps. And the small caps are going to be able to break out to the upside. This is the S&P 600 Regional Bank Index here today. But earlier in the session, it was down 0.6%. Right now, we're seeing that up about 1.2%. The enthusiasm is there. I think that's your risk on tone. And if we actually get some good earnings, good guidance, good commentary about the economy, especially in these smaller communities that they really do serve, I think that probably gives you, I don't want to say the nail in the coffin for the soft landing for now, but I think that gives you a really good backstop there for any doubts that we might have some cracks in regional areas of the market from a geographic standpoint. So keep your eye out on that one going into this week. And if that is successful and that regional bank index actually does break out, I think you kind of look at the small caps or you look at the IWM and maybe it's time for it to kind of break out of its consolidation range as it's been in for the last 3 months.
Yeah, the small caps haven't still below those all-time highs that we saw in 2022, but at the same time you have to wonder the consumer. If you look at JP Morgan and Wells earnings reports, the consumer is still strong, but loan growth is weak. So we'll have to parse through those regional bank earnings. Those are on tap. But Alex, we mentioned things that can't really stop this market at this point. You had Boeing laying off 10% of their workforce at 17,000 employees. Caterpillar gets a downgrade, but that's not stopping this rally. Dow was negative earlier today, now up about 0.4%. So that's not out there stopping it. It's just individual names that will not stop any type of rally like this, even if there is negative news on them.
Yeah, and this is just the nature of a bull market, right,
Yeah.
Tom? I mean, when you're in a bull market, good news is good news, bad news is good news. Now, we were in a bull market in the first half of July, and things changed abruptly. So one thing that I think is something to be just aware of, it's not necessarily the run for the hills moment, but we were pretty overheated on a lot of momentum indicators. You started to see sentiment ramp up. You started to see fund positionings ramp up when it came to positioning and sentiment around the market, momentum from a technical standpoint in July, and then we saw what happened as the market sort of cooled off, allowed for some of those things to get back in line with more historical levels and then move higher again. we're starting to approach some of those levels. Now, we're not there yet. It might take another couple more weeks of this type of a trajectory for that to happen again. But just know that sometimes the cure for high prices is high prices, and the same goes for the market at times as well. Now, does that mean you want to flip positioning, be short against this massive bull market? I mean, for some maybe, but for many, most of the time, no. But just maybe awareness of where we're at on the chart, and depending on what your goals are, perhaps it's a time to think about pairing positions off, prepare for some sort of a pullback, especially with all those things on the calendar. But I love Kevin's point about regional banks. I mean, that was really what the biggest fear was. I mean, the Fed hasn't really outright said it in a couple of years, but the biggest fear that the Fed has is when the bond market starts going crazy, when the banking sector is under stress. We know that the biggest banks were probably more positioned, post GFC to be prepared for downturns. So naturally, it goes to different parts of the financial sector, and that's been more the regional banks. They're tied to CRE, commercial real estate, which we know has been under pressure. I think that's probably the primary reason the Fed wants rates lower, is because of what's going on in that world right now. Right. But we'll see. We'll see what happens. Like to Kevin's point, we're going to hear from a lot of them. Some will be good, some won't be. And we'll see if the market can take that next leg higher. If you have regional banks joining the party, it's hard to see the market doing significantly worse from here.
Yeah, and the fact that you got tech leading, NVIDIA up once again, trying to get back to those all-time highs. But KG, if you look at the interest
where we
rates,
are.
I think that's a big caveat for me. I try to follow the bond market for a little bit of leverage into what's going on in the equity market.
No more
and I
VWAP?
just don't see an area where, you've got the 10-year yield rising above 4.1% again, where that's going to actually induce more activity, maybe lending from some of these banks and small banks. And I think it puts pressure on consumers moving forward.
Well, I think the 10-year yield move before the cut was way too aggressive to the downside. I think we're seeing a little bit more of a normalization right now here, Tom. And to kind of counterbalance that, yields moving up and we're hitting all-time highs, right? That's early cycle behavior. Now, by no means am I saying we're in the early cycle of this whole thing. But when you got yields going up and you have equities going up, that kind of signifies, for the most part, risk on in the market. If you start seeing yields getting bid up a little bit more, equities selling off, that would kind of symbolize, risk off in the market. So I'm actually looking at around 4.25 to 4.3% from a technical standpoint to be your area of resistance for the 10-year, and then you still get a large amount of institutions over the next couple of Fed meetings in November and December, still trying to bid up and try to gobble up the shorter end of that curve there, and then once again having that spread 2-year 10 or 3-month 10 starting to widen out even more and more, and I think that's exactly what we need. Alex is actually, he's right. At the end of the day, we might have elevated inflation for now, but here's my take. That we have elevated inflation, that doesn't mean that equities have to sell off. And actually, if you go over time, higher inflation rates in the right inflation, meaning demand growth and not supply shortages,
stagflation,
because of logistics, has actually been positive for equities over the longer term. Now, I think if we can continue to see wages annualize out at around 4.2 to 4.8%, but you have inflation sitting at 2.5% or so for CPI, that's positive net for the consumer for now. Now, any type of supply disruptions, I think we have a little bit of a bigger story, a different story to kind of talk about. But right now, it's a really good setup. Last thing I will say, usually when we have these major pullbacks after a
I'm getting my knife,
cycle, right? Because that was the biggest concern. It's off of liquidity and credit. We don't have a credit issue right now, right? 08, credit. Even 01, the internet bust, for the most part, was credit and lack of liquidity and lack of money out there for private equity. You can go back throughout all these cycles. We have pains, but really the lack of credit and the constraining of credit for the consumer is really what kind of brought equity valuations to the downside. Until we do see that, it's very hard to fade this market.
Yeah, and even JP Morgan and Wells Fargo noted that in their earnings releases that the credit quality still pretty good out there for the consumers, at least.
Real quick here, Tom. That's why we watch the dollar index. Because to say it another way, what Kevin's saying is it's really availability of dollars. The more expensive the dollar gets, the harder it is to get them. It creates shortages. That's what a credit crisis is. So watching the dollar is actually much more interesting than watching yields, because that's more reflective of kind of that availability of dollars and how easy it is to get them. And if dollar index goes lower, Don't expect the party to stop. It perpetuates it.
Yeah,
That's
we're
why
at
it's going high.
we're at 2-month highs for the dollar, though.
Which is going to show that maybe some of that stress will start to build back up. It's when the dollar goes down that it actually perpetuates the system.
Yep. Healthy right now, and optimism's reigning supreme. All right, guys, let's take a quick break. When we come back, we're going to take a look at Goldman Sachs. The investment bank stocks at all-time highs into their earnings tomorrow morning. Stick around. Fast Market's coming right back.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Knock, knock. #1 broker here for the #1 hitmaker.
Thanks for swinging by, Carl.
No problem. So, what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah.
Choices.
I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know, Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Fast Market here on the Schwab Network. We're talking more earnings. Goldman Sachs, they report tomorrow morning. Shares are up about 35% so far this year. At all-time highs going in earnings, not surprising. KG, when you look at this, this company, investment banking, that sector's been doing pretty well. I think they're doing a pretty good job of trying to get out of specific areas that aren't producing the returns that they want at this point. But, you start looking at M&A activity picked up a little bit. Net interest margin, maybe that does a little bit better here for this company, but seems like they've been doing everything right, but the bar is really high going into this report.
It is, but this has been a
It
really good
is.
turnaround. I mean, what was it, 6 months ago, everybody was asking for the CEO to potentially step down, and now you're starting to see some positive results when it comes to investment banking. And I think that's going to be the key area here moving forward. You're going to see a thawing out of the IPO market as well as just private equity deals, and they're going to be the direct beneficiaries of that. And then on the trading side, too, I mean, they have a significant amount of exposure when it comes to the treasury side and their trading arm there, and that actually has been able to provide them enough cash flow to be able to push them over the top when it comes to earnings expectations. Now, is the bar going to be high on this name? Definitely, but they have been working out and trying to spin off a lot of the retail consumer type of businesses which just wasn't their area of expertise. There's other companies that were able to do it better, so now they're kind of going back to the institutional side, and that could be a tailwind for them in the near term. Also looking forward to some of the commentary that they have regarding the economy and how that's really going to fit into the picture for them in the near term here. Going to be a tough one to try to trade here. I know we have an example trade, but this has been a really good stock to the upside
$3
so far. Let's see if it's going to be able to continue this type of trajectory in the near term here.
Alex, when you look at this stock, RSI about 66, 67, so not overbought, but it's been a tremendous run. If you look at investment banking, that's starting to pick up. You see how trading does this quarter. They're parsing some of their markets, businesses as far as loans goes. and they just closed that Green Sky lending platform. They sold that off also. So they're kind of trying to tighten the ship. But I think if you look at it, is the move already built in, or did this maybe have more move to run to the upside because of the fact that things are going well in the economy and for their businesses?
I think those are great questions, and I think for a longer time frame, there's something you have to consider, tremendously, especially if you're considering, purchasing this stock for a portfolio. But I kept it a lot more, simple in terms of the narrative behind it. I do this and think about this similar playbook almost every quarter, it seems, in the financial, stocks. We hear from a few of them, particularly JP Morgan, that has a pretty wide net, pretty much, as a main player
Look
in
at
all
that
of these
run.
markets, and is relatively indicative of its peers. Okay, it also moves its peers ahead of the results, and so we have part of the story for Goldman Sachs understood already in the market that limits the volatility around these results. So I think you can do have similar conversations around Home Depot and Lowe's, UPS and FedEx. When you have companies that have a lot of overlap in terms of how their businesses work, and you hear from one of them, I think it reduces the volatility or perhaps the surprise factor when it comes to volatility around these earnings events. And so I looked at a neutral selling of an iron condor, basically equidistant, just outside the expected move for the week, about, let's call it 30% outside the market maker move, maybe a little bit more than that, and effectively just fading reaction. So not saying it's going to be a good report, not saying it's going to be a bad report, just simply saying I think the market's going to have a pretty good idea of what Goldman Sachs is going to say before they say it. And so what I looked at here was this Friday's expiration, 500, 495 put vertical, paired with the 545 call vertical. So a stock trading around 520, $20 above, $20 below, $5 wide spread, collect about $1.50, it might be a little bit less. And if it is, that's fine. I would probably be comfortable with a 4-day trade or 5-day trade going down to $1.25 on a $5 wide spread. I probably wouldn't go much below that. That's just, again, a personal kind of guideline I use. In the same way, if this was to the other way, I probably wouldn't go above maybe $1.75 for the size of the credit. So those are sort of that's my 50-cent range.
Gotta be a way to make money on this.
Just for some context, $498.50 though, if you do get $1.50 is the break even on the downside. $541.50 is the break even on the upside. You're risking $350 with the chance to make $150, so a little bit worse than 2-to-1 risk reward, but it's a short-term trade outside the market maker move. And it's also, Tom, outside the move for the entire week. So there's always a chance that there's an outlier, but the nice thing about the iron condor is, unlike the strangle, you're not exposed to outlier risk. Yeah, you'll have your max loss if it's some multi-standard deviation move, but you know what that max loss is. If you were just selling the call, just selling the put, sometimes you can have, 10, 15, 20x losses versus that credit. In this case, it's just a little bit worse than 2-to-1 is the worst case scenario.
Neutral strategy with the stock trading 521 on this short iron condor that Alex brought us.
58.50s.
Selling the 500 put, buying the 495 put, selling the 540 call, buying the 545 call. So we've got $19 on the upside to that short call vertical, just over $20 to the downside in this. KG, when I look at this, a trade like this where, hey, you just want this stock to consolidate post earnings, but you look at the probabilities, 85% probability that it will be above 500 at expiration over the next 4 days.
Oh, yeah.
And then also
Jimmy
on
likes.
the 540 strike that you sold on the upside, nearly 81% probability of finishing out of the money. So that narrative of higher probability of success while staying risk defined is the basics behind this strategy.
Yeah, Alex is really capturing the implied volatility move, the elevated IV going into the earnings announcement here, and really kind of basing this trade on that implied move to the upside or downside. Maybe it will not go outside of that one standard deviation range here and stays within those strikes. I would also say, too, that $500 level has been a really key area that the stock has been kind of trading around over the last couple of weeks here. So that could also be an area of support where buyers actually do step in. So risk defined and trying to get a minimized move either to the upside or downside, and then also gonna manage the trade post. I do want to ask Alex though. Alex, tomorrow after the earnings announcement, what do you do with this trade? Do you keep it for the remainder of this week, or do you try to take it off after the IB crush?
I think that's going to be person to person, Kevin, but it's a good question. I would say if it was me, I would have a number in mind that if it was trading near that, I would be comfortable offsetting this position and closing it out before expiration. But if the move is outside, let's say one side or the other, I would probably manage by removing the side that has no value left and then playing out the week on the side that was maybe tested a little bit. So it's going to be a lot of times reactionary to the situation, and it's going to be very dependent on each individual, trader's rules that they have for themselves.
Yeah, and also, Alex was talking about, putting it outside that anticipated market maker move, which is about $14.50. Maybe some of that implied volatility got taken out after JP Morgan and Wells Fargo results. But you mentioned the October 18th, a monthly cycle, that's about $17.50, $18 either way. So you're outside of that into the end of the week also. So that's why you've got those higher probabilities, right?
Here's one thing, too, to build on this. Agreed, though, yes. But what I would also say is part of the reason that it has a little bit more is because there is a little bit more time. This isn't expiring on the same day that the earnings are taking place. But a really easy rule of thumb, kind of back of the envelope way to determine whether or not you should take something off or not, is ask yourself, would I put this position on here? And if the answer is no, you have your answer as to whether or not you'd want to take something off.
Right, and positive time decay, so that contract the price of that strategy contracts as you get closer to expiration, and expecting that historical vol crush post earnings also, which will contract the price of the short iron condor. All right, good look at that, and thanks to Alex Coffey, senior equity contributor.
Short iron condor.
Markets and Goldman Sachs had an earnings coming up after the break. We're going to be joined by Andy Swan from Likefolio for a look at sentiment data in Flutter Entertainment. The FanDuel parent stock is up nearly 30% this year. It was upgraded.
If I just get a little bitty bounce on this, I'm going to get out.
Sold off. Stick around. Fast Market's coming right back.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools,
Right now it's bullish.
including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Neil, how's my favorite client? Quick question, Carl. Can you offer me the same choices as Schwab? Choices? Yeah. At Schwab, I can get full-service wealth management, advice, and invest and trade on my own.
Come on, you know Carl's the only choice you need, right? Neil, tell me you know this.
Gotta run, Carl.
Schwab.
Have a choice in how you invest with Schwab.
No touch.
Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in Andy Swan, co-founder at Likefolio. Welcome back to the show, Andy.
Thank you. Happy Monday.
Happy Monday. So we're talking Flutter. Well, I don't think we've hit this with you guys before. I know you guys have talked about Flutter, which owns FanDuel, competitors, DraftKings, Penn Gaming in this space, but shares have done pretty well. There was a report that came out last Friday that the United Kingdom's weighing proposals for higher gambling taxes, maybe doubling them. Stock fell pretty sharply, but up 4% today on the back of an upgrade. What's your take here on this? Because, you think of Flutter Entertainment, you think FanDuel. It's usually a leader globally, but how is it doing here in the States? And do you have the data to back up this nice rally we've seen this year?
Yeah, this is really great timing to talk about both FanDuel and DraftKings and kind of look at how they're faring head-to-head, because this, the beginning of football season, whether it's NFL or college, is an extraordinarily important time for both of these companies in terms of acquiring new customers and of bringing customers back to their platforms that may have taken the summer off a little bit in terms of wagering. And so we are actually looking at a quarter-over-quarter data on this because we think it's really indicative of where the customers are flowing and therefore where the gambling dollars are flowing. And when we look at the web traffic between the two, both seeing a really nice spike, as you would expect going into football season, with FanDuel up 33%, but DraftKings really surging into unexpected territory, quite frankly, at plus 57% quarter over quarter, really outpacing FanDuel, who I think, from a year-over-year perspective, they may have simply just gotten ahead of themselves a little bit. And when we look at, consumer happiness levels, again, DraftKings beating FanDuel, 64% happy to 60% happy on FanDuel. Penn Gaming looks pretty good, although they're very beaten down. They had a big breakup with Barstool that kind of screwed things up for a little while. But they are doing a good job with the customers that they do have and probably keeping retention pretty well there. So overall, as we start this very important football season, I think that we could be in for a little bit of a changing of the guard. It's been FanDuel's crown to lose, and I think DraftKings is mounting an extremely comprehensive fight here, beating FanDuel in both, that demand metric, that web traffic, and consumer happiness levels. A pretty good 1-2 punch going into near the midpoint of these football seasons.
So, Andy, it seems like they're in a little bit of a trifecta right now, too, right? You have the NBA kind of starting back up. Yep. You also have football, and you also have the MLB, and the playoffs going on at the same time here. It seems like it's a rising tide lifting all boats when I'm kind of seeing your data, just high level here. Do you think that's still going to be the case here? I mean, I have heard less and less when it comes to these state approvals being a tailwind for them. Do you think that's already priced in, and this is just really a battle of price between these competitors, or is there enough market share to go around and kind of continue this lifting of the industry?
Yeah, that's a really good question, and I think really spot on. The tailwind of legalization seems to be, I would think, pretty much priced in. There's not a whole lot of surprises in the pipeline. There's always these threats of, taxes like the UK put out there that could be a headwind. I think that overall the consumer market for gambling is growing at a pretty normal pace. I don't see anything extraordinary, so that's why we try to look at it on a head-to-head basis and just see who's winning. Because what's really happening here is these two companies, especially DraftKings and FanDuel, they are having to fight tooth and nail for every single customer that they get. They're having to put out bonus bets. They're doing a lot of promotional activity just to keep the customers that they have, because quite frankly, it's really easy to have both apps and to just pick which of the two has the best promotion or the best line for the bet I want to make today. And I think that's happening all over the place. And so it's really a battle of not just acquiring new customers, but keeping the ones you have.
Spy new high.
Expensive battle that could, push high levels of profitability well out into the future.
Yeah, and I think we talked about that before, Andy, with when DraftKings a couple years ago, stock was under $10 a share. Acquisition costs were a really big headwind for a lot of these companies. But the blowing up of live sports, right? Live sports programming has exploded. ESPN's got, their own betting app now also. Is that contributing to part of maybe the growth trajectory and the optimism in this space? Because it still seems like acquisition costs are really high. The promotions that they do are really elevated. Is this more based on the fact that we're going to see continued growth in live sporting events, and that's going to spur, maybe revenue growth?
Yeah, I think that's definitely a huge factor. FanDuel has its own, content channels now. I spend some time watching the FanDuel TV horse racing feed quite often. Look, the problem with this is that you can inundate people with as much live sports as you want. There's only so much people can watch in a day, but more importantly, there's only so much people can afford to gamble. And, when you get to the point like both DraftKings and FanDuel now, where you can bet during the Monday Night Football game on whether this drive will result in a field goal, a touchdown, a punt, or a turnover in real time, you've pretty much tapped out the wagering opportunities, and it really becomes how much can your customer handle before they just simply have to go away and can't reload again this season. And so I think it's a wallet share grab as much as a customer grab. I think both companies are doing an excellent job, but this is going to be a bloody ocean for a really long time because both companies extremely well funded and both seem to be very committed to getting as much of that gambling public and the gambling wallet that they can.
Yeah, and I think a lot of times we forget the fact that, hey, the economy's doing really well, the market's doing really well, the wealth effect is taking place.
You like 586, huh?
You feel comfortable maybe gambling more. If the economy turns down at all, that might contribute. But Andy, they don't have earnings for a few weeks here. If you guys had an earnings score on this one, what would it be?
Well, we would be slightly negative on Flutter or FanDuel, and we would be slightly positive on DraftKings. I think that DraftKings has the potential to surprise investors with its next report based on the data we're seeing thus far in the football season.
All right, great stuff, great data. As always, Andy, appreciate it. Have a great day.
Thank you, you too.
All right, that's Andy Swan, co-founder at Likefolio, breaking down sentiment data there in Flutter shares. FLUT is a ticker symbol. KG, how do you want to look at this? I mean, the stock dumped on Friday on those reports that taxes in the UK may be going up. That's a majority of their revenue. FanDuel's growing here in the States, but stock's up, 28.2% so far this year. How do you want to look at this from an example trade?
Yeah, so still looking for an upside move here when it comes to Flutter and giving a little bit more time out there for this trade to really kind of mature out here. Now, when you're kind of looking at this, just so we can kind of set the landscape, they only have monthly options so far. So when you're trying to structure a trade, you also have to kind of be understanding that sometimes this is going to take a little bit more duration. So I'm actually looking at a bull call spread here, looking at the 230, 270 strike here for the November 15th expiration, going long the 230, selling the 270, doing this for $9.80 for that debit. Now that's going to be the max loss for the trade, $980. Max profit is going to be the difference between the spread minus what I paid for the spread, so $3,020 of the break even at $239.80. So Tom, this is a trade that you will need to have the stock move to the upside, and it's a little bit close to at the money to get a little bit more delta there, just in case it does take a little bit more time, or just in case it does not hit that upper strike, trying to get as much of that price move within this spread as possible if we had to take the trade off early because of some event that might be coming up, or maybe some negative news here. So you kind of define the risk. You have more than a 3-to-1, almost a 3-to-1 ratio here when it comes to risk reward. And so this is kind of a trade setup to kind of benefit from some of the items that Andy was talking about, especially some of the tailwinds for football season.
Yeah, let's break this one down. Out in the November 15th, so as Kevin mentioned, some duration, right? You got 32 days to expiration. They tentatively report earnings on the 12th of November, so you're going to capture that earnings event if you still have it open by the earnings event in early November. Paying a $9.80 debit, probably about $1 higher now. The stock's moving over, but the bid-ask spreads is, as Kevin mentioned, no weekly options. On these monthlies, the bid-ask spreads between the options pricing is really wide, so maybe some price discovery warranted here. But the debit you pay is going to be a risk. If you pay $9.80. You know, that's your risk on a one lot, just over $3,000 or $980.
Huh.
Debit you pay is your risk on it. Break even, as Kevin mentioned, $239.80 if you pay that $980 debit. But KG, I always look at these type of strategies where it's directionally biased, right? You've got a good risk reward setup on this. You got 32 days till expiration on this trade. But I'll give you this question. Say the stock rallies up to $250, so you're still below, or just above the break even on this, but it starts to expand in price, maybe goes from $9.80 up to $16 or $18. Is that when you start looking at maybe parsing some of your position or all of it, just because you have that flexibility to manage this trade ahead of expiration and earnings?
Yeah, everybody has their own kind of, risk parameter in place or their take profit. So, I mean, if you have a trade like this, then let's say it hits 50% up before the time of expiration, maybe you start pairing it off a little bit, just because you do have a event risk that is coming up in the next couple of weeks there, Tom. So I think that's a really good question.
Interesting.
And you also have to just be mindful, too. It's very concentrated when you're looking at the open interest. There's not a lot on the wings. You have to kind of play right there at the money for these type of contracts here. So yeah, if you get any type of profitability, depending on your level, once again, this is around a 3-to-1 risk reward ratio here, but any type of 50%, 75% move to the upside on that debit spread might be something worth considering trying to remove from the market, or at least paring down if you have several contracts out there working.
Yeah, and this is the heart of where they make a lot of their money with football, NBA starting, NHL starting. So they've got a lot going on both in college and pro football. But this is looking for a rebound from that sell-off that we saw last Friday. Stock's doing pretty well today. But good look at this example trade. If you think this stock's going to rally over the next month or so, this takes advantage of that with a good risk-reward setup. All right, we're going to take a quick break here. When we come back, we're going to take a look at another stock that reports earnings tomorrow morning. That's Citigroup. Bank stocks up about 28% so far in 2024 into their report. Stick around, Fast Markets coming right back.
Market ain't looking too bad. Do I see the SPY topping out at the year? I really ain't gonna know until after the election. But everybody else says it will. Baggats think it will. Look at that run today. Beautiful. Just trying to make its mind
Binge
up.
watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
Welcome back to Fast Market here on the Schwab Network. Before we take a look at Citigroup, let's get a market update because we are near session highs as we speak. We get the benchmark S&P
Yep, we
500
are.
up about 0.75%. The Dow Industrials up 0.4%. The Nasdaq 100 up 0.8%, leading to the upside. On the back of those gains, most likely we're talking about gains in Nvidia, and then the Russell 2000, the small caps making up some ground. Remember, the Dow and small caps were actually negative to kick off the session. So solid, wide-ranging gains here. Now you take a look at some of the other asset classes. Crude oil still down over 2% on no real clarity on the China stimulus on that press briefing this past weekend. They wanted more details, so maybe a demand fall here in crude oil. Gold down on a higher dollar. We got the VIX back below that 20 level as we talked about, and there's the dollar. Dollar at 2-month highs here today, but not providing any headwinds for equity markets. So we'll keep an eye on those asset classes as equities continue to rally. But now, bringing in our next guest, it's going to be George Tillis, Senior Markets Contributor here. George, we're talking Citigroup, and on the back of some decent results out of JPM and Wells Fargo and some gains in those stocks, Citigroup's participating in that also. So the bar's getting higher for this one, right?
It is. There's actually some interesting things going on with Citigroup, but I suggest, looking at the broader mega cap banks, the long-term yields continue to rise. In fact, the 2 to 10 spread is widening out. That's actually very bullish for net interest margins, and particularly you got to consider in the backdrop. You mentioned the Russell 2000, which is chock full of regional banks, has performed quite well. It actually was performing really well on Friday. But with the Fed lowering interest rates, that's actually a primary catalyst with those long-term yields actually rising for spreads, for net interest margin spreads on banks. So keep that in mind in the context of the larger picture for these banks. But Citigroup, if you look at this particular company, there's a little bit of a different story for Citigroup versus, let's say, JP Morgan or Bank of America. Now, looking at JP Morgan, about a third of the revenue really comes from, corporate and investment banking. If you look at Citigroup, this is actually a global wealth management business primarily versus more of a loan-centric bank. So if you think about loan-centric banks or assets on the balance sheet, which are loan contingent, you got to think of Wells Fargo as the most exposed to loans itself, where Citigroup is actually more wealth management globally. But the other component of Citigroup's business, which makes it very unique, is it's actually a treasury clearinghouse, if you will, an international clearinghouse, and that's essentially what it's got going for it from that standpoint. So it's most globally exposed. If you think that the emerging markets, China, Japan, which are all, these emerging markets are trying to press their currencies down, they need a clearinghouse for currency trading as well as treasury trading or treasury clearing, and that's Citigroup. Now, looking at the business itself from the standpoint of earnings and revenues, they're expected to come down to $1.32 by 13% per share. Now that's compared to $1.52 for the same quarter last year, and even sequentially down from last quarter at $1.57. Sales are expected to be modestly lower at $19.82 billion, and that's down from $20.14 billion both last quarter and for the same quarter last year by about 1.5%. So the bar is quite low, I think, for this particular quarter. I think if you think about the other thing that's going on with Citi, what makes it unique is, from a valuation standpoint, if you were to compare its return on total capital equity in the last year, it's very low at around 3.7%. However, last quarter, there was a significant improvement to close to 7%. The guidance the company has provided going forward into 2026 is between 11 and 12%. Now, for comparison's sake, JP Morgan's got a return on total tangible equity at around 22%, Wells around 12%, and Bank of America around 13%. So Citi's got a lot of room to grow. And one of the things that's going on about this particular company is the restructuring. And the restructuring moving from 94 countries in which they operate down to 84, cutting headcount, trimming back their divisions. And that's essentially the goal of Citigroup, is to become more lean in the next couple of years. And that may pose a benefit as a higher beta base name versus some of the traditional ones like JP Morgan and Bank of America.
Yeah, you mentioned that restructure. CEO Jane Fraser came in. She played whack-a-mole with a bunch of different parts of their business, including cutting jobs. So she's been at the forefront of doing it. And we all know in these banks, George, that, the CEO makes up a lot of how their businesses run on a day-to-day. So she's actually done pretty well. But they were at that Barclays Financial Services Conference in September, and they talked about investment banking fees are anticipated to increase about 20%, and that's where they've been lagging some of their competitors within this this space. Is that going to be a bonus for this quarter?
Yeah, I think so. I think also in the international markets, investment banking is really where Citigroup is exposed. I think the capital formation in international markets will probably improve, assuming even if we go through a recession in the next year, just assuming that. You have to think about the benefits of lower interest rates in the United States, a weaker dollar, and how that improves the capital formation overseas. And typically the dollar will fall as the central bank lowers the federal funds rate. And that, again, bodes well for international markets, especially emerging markets, which have to service international debt in U.S. dollars. So a weaker dollar does benefit a company like Citigroup and the international investment banking market. So, if you want to look at a big bank, one that is trading at a discount to book value, it's trading less than 1 times book. If you look at, Bank of America, Wells, as well as JP Morgan, all of those banks are trading above 1.5 times book. Now, Citi may be trading lower from a book's value standpoint because of the fact that its revenues, on a trailing basis are down about 1.5%. Even for the quarter, they're expected to report down. But going forward, it's relatively modest, around 3%. So the growth levels right now, based upon what the estimates are really low. But I think if they come out and they demonstrate improving net interest margins and lower loan loss provisions on the books, that might be a catalyst to push this to 52-week highs.
Yeah, people getting bullish on this name as far as the analysts, just due to the changes that Jane Fraser has made so far and the plans for more. All right, great backdrop for us, George. Appreciate it. That's George Tillis, senior markets contributor here, breaking down Citigroup. Now let's get into an example trade here in Citigroup, because the option market stock trading about $66.40. The option market's only pricing in a plus or minus $2.25 move in the shares either way into that event tomorrow morning ahead of the open. So implied volatility levels have actually fallen going into this report, which is really surprising to me. I looked at the IV percentile rank. It's only 48%. So right in the mid-range of what we've seen implied volatility levels over the last 52 weeks. Now, some of that is because the stock has rallied 28% so far this year, but I think some of it is because investors kind of look at this as, hey, JP Morgan came out, Wells Fargo came out, they were pretty good, stocks rallied. Implied volatility levels and some of the other names maybe have come down a little bit. So I looked at a strategy. The stock pays a 3.4% dividend yield if that continues to get paid out. So it's got a decent dividend yield if they continue on that pace. So with the stock already up so far this much, near multi-year highs, I looked at a strategy that takes advantage of, hey, maybe it has some room for a little bit more upside, or maybe I want to own the shares because I want yield, I want to collect that dividend. So this strategy takes advantage of that. Now, looked at going out for every 100 shares of stock you buy, you sell an out-of-the-money call. In this example, I went out to the November monthly 70 strike call, sold that, and then you're paying basically buying 100 shares, selling 1 call, paying roughly about a 65.20 debit on it. It might be a little bit higher than that right now, maybe 65.30. But the debit you pay is the break even on that one, so 65.20 to the downside if you paid that amount. Now, these things, because you're owning the shares, you've got about $6,500 in risk on this one if for somehow the stock were to go down to zero. I just got to say that. But this is a type of strategy that's neutral to bullish, where you're taking advantage of yield on that call that you're selling that's out of the money, your 32 days to expiration, and then also the yield on the dividend if that continues to get paid out. So this is almost a neutral to bullish strategy where you're buying the shares cheaper, but it's a pay to wait, get paid to wait type of strategy with the covered call because you're selling that upside call against it, you're owning the shares, the dividend. But it does top out about that 70 level, so you got to keep that in mind. As you get closer to expiration, you can have that ability to roll or adjust that short call also. That's going to do it for us today here on Fast Market, but stick around right here on the Schwab Network. Next Gen Investing is coming up next.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Yeah, how do you do that, you crook?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
Yeah, Nike would have been good this morning.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Definitely Nike from yesterday. JP Morgan today would have been a good little knife.
One stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
Dun, dun, dun.
Good afternoon, happy Monday. Welcome to Next Gen Investing. Alex Coffey joined today for the hour by the always wonderful Caroline Woods. Delighted to be joined from the New York Stock Exchange as well. No Jenny Horn today, has the day off, but Caroline, you know, I'm excited that we get a chat because, you know, there's not a whole lot in the overall market going on despite all-time highs, a whole calendar full of things. So I'm excited to hear your thoughts on where things are shaping up to kick off this week.
Well, not a lot in terms of catalysts today, at least, but a lot to look forward to as the week progresses, with a lot of key earnings reports on tap from big banks, regional banks. We also will hear from Netflix and J&J, United, ASML, TSMC. You know, quite a few big names will be released. Of course, we'll get retail sales as well. But today, yeah, kicking off the week in record territory, the Mag 7 minus Amazon driving the market higher. Utilities having a good day. NVIDIA closing in on those highs again, not too far away.
So did you like the banks?
Vistra, the AI power play, the best performer on the S&P 500. So there have been calls for some pre-election volatility as we get closer and closer to election day, but it's certainly not happening today, at least not so far.
Yeah, and it's starting to be priced in, right? You look at that volatility curve, it's expanded on the short end. It's a little bit flatter out into time then. That's indicative of that event risk that's in this 30-day window. It's not just the election, it's the jobs report, it's the next Fed meeting, it's a whole nother round and slew of inflation data. We get retail sales this week. So catch your breath while you can, because it's going to be coming all over the place from every direction in the next few weeks. Earnings season's about to be in full force. You mentioned TSMC, Netflix as well this week. So tons and tons on the calendar. It's just not today. And you know what? I welcome that. Sometimes you need to catch your breath. But you mentioned NVIDIA near highs, S&P's at highs. And it's not just the Mag 7, although they're helping, with their own, moves to the upside today. But almost 80% of the S&P 500 is higher. So that's a pretty nice, start to the week here. Caroline, we got a fun show, though. We'll leave some of the macro talk. To be honest, there's not a lot of macro talk to be had, but there is stock-specific stories always. We'll do upvote, downvote in a moment, where some of those will, of course, be the subject of discussion. But we'll be doing our FOMO discussion on SoFi, sort of the next-gen financial services firm that has a very, very, I would say cult-like, believer crowd on social media from the bulls in SoFi. Getting a nice move, though, today. So some reason to cheer in that world today as the stock's back over 10. We'll close things out with a discussion with George Tillis around Upstart as well, as that stock is getting a move to the upside as well. 15% upgrade in that stock. So tons to get through. Caroline, not endorsements, not recommendations. Let's start with one of the stories of the session, and that is Boeing. So more kind of back and forth with Boeing. It's one step forward, one step back, sometimes two steps back. This, to me, while maybe is ultimately going to help the company in the long term, in the short term, it's hard not to see this as another step back.
Yeah, and we're seeing it play out as a setback in terms of Boeing's share price today. Although I will note, Boeing is well off earlier lows today, but still down about 1% today. There's a lot of news for investors to consider. They, of course, offered a pre-announcement on Friday of a wider than expected loss, plane delays, layoff news, and then in turn some analyst action. So just to kind of break it down, Boeing said that it plans to cut 10% of its workforce. That's about 17,000 people. They also said they are going to postpone the delivery of the still uncertified 777X, the wide-body plane, by 1 year until 2026. So in reality, that's about 6 years behind schedule. Boeing said it will stop making commercial 767 freighters in 2027 after it fulfills remaining orders. And then, as I said, it forecasts a wider than expected loss. For the third quarter, Boeing expects to report a loss of about $9.97 a share. Third quarter revenue is expected to be about $17.8 billion. In the release, CEO Kelly Ortberg said, "Our business is in a difficult position, and it's hard to overstate the challenges we face together. So find some of these steps necessary in order to kind of get through the tumultuous times." We did see several analysts weigh in following these measures. JP Morgan lowered its price target on Boeing to $195 from $235, kept an overweight rating on the shares. Says the forecast from there kind of requires a number of assumptions with few details, and so the range of outcomes is wide, but does point out that they think Boeing will need additional liquidity, doesn't know how Boeing will actually address the need for liquidity, but models a placeholder $15 billion equity raise. TD Cowen also maintained its bullishness with a buy rating, but lowered its price target to $190 from $200. Citi, Goldman also in the buy camp, but scaling back those price targets. Wells Fargo lowered its price target to $109 from $110, but kept an underweight rating on shares. Again, looking for Boeing to actually need an equity raise in Q4, so sticking with its bearish rating. Very much in the minority, though, for Boeing. The majority still in the buy camp. If you take a look, Boeing shares down about 1% today, now down 43% year to date.
Yeah, I mean, outside of some tactical kind of spot picking to increase exposure in this name, if you're more active with your management, if you're a stock picker, this has been, a really, really tough place to have money parked over the last few years. And it's really not just the last few. It really dates back to the early parts of 2019 when some of those initial flights had issues. Then the pandemic rolls in and just sort of decimates really everything, but particularly the airline industry, particularly manufacturing companies as well. And you saw Boeing just absolutely plunge. It's had periods of time where there have been optimistic moments, but they've been short-lived, Caroline, and it's just on another leg lower. So we'll see if it can flip the script. This seems to be a story that if you aren't just sort of a long-term believer and just willing to stick it out, that a lot of kind of, I would say, more fickle investors have maybe just taken Boeing off the watch list. They'll wait till something seriously changes. There's maybe more of a prolonged uptrend or something. No right or wrong reason, but patience definitely being tested in Boeing is, I guess, how I would put it. Any last thoughts on Boeing before we talk some Tesla?
I think it's just, there is some bullishness around Boeing too, because there's not a lot of alternatives. Obviously it's Boeing and it's Airbus. So I think that, investors also need to kind of keep that in mind.
Yeah, Alex, you're missing up, buddy.
Sometimes when they talk about their bullishness in Boeing. And if you take a look at the median price target for Boeing, it has come down quite a bit this year, but it's still at 203.50. So significantly higher than where Boeing's currently trading right now, around 150. So analysts on Wall Street, for the most part, despite scaling back those expectations, or I should say continuing to scale back those expectations, still bullish that Boeing moves higher from here.
Yeah, it's a great point. It's what we talk about every time with Boeing, this sort of Airbus, Boeing duopoly, the fact that Airbus is an international company and Boeing just has such a intertwined relationship with the Department of Defense and all the things that's going on there, that we say there's a floor to Boeing. But are we held where we're at because of that too? You have to wonder, a company in a different circumstance, all the things that have worked against it, will we be talking almost bankruptcies in some cases with some of the things that Boeing's had to overcome? I don't know. But we'll leave it there. We'll probably come back to Boeing. It's the story of the day, I think, and it continues to be one of the stories of the market. Let's talk some Tesla. This event last week, I think depending on who you ask, it was different levels of interesting, different levels of game-changing. That said, it did seem to kind of follow the typical Tesla script, which is sort of front load expectations just so incredibly high, watch the stock price fly ahead of it, and then sort of deliver something a little bit more lukewarm or lackluster, give back some of that, but all in balance, still way higher than when we first started hearing about this robo-taxi event, I don't know how many months ago.
Yeah, a little bit of buy the rumor, sell the news. If you take a look, Tesla shares down about 16% this month, although they are up about 1% right now. But yes, they unveiled a whole bunch of new products last week at that robo-taxi event. It was highly anticipated. They launched the Cybercab and the Robo-Van and the Optimus robot. Following that event, Evercore ISI actually raised its price target on Tesla to $195 from $145, kept an inline rating. So Tesla's currently trading around just below 220. So this implies, about $25 downside from current levels. Evercore believes investors had rightly anticipated and front-run, as you said, the event and promises made therein, but were clearly disappointed on the lack of concrete details. The clear areas of disappointment they point out were the lack of the M2.5 variant reveal and concrete details and data regarding the human robo rideshare launch. So, upping their price target expectations, but still lower than where it's currently trading. Now, the next catalyst for Tesla will be earnings on October 23rd. And I do want to point out that Piper Sandler actually said that they're sticking with an overweight rating ahead of earnings with a $310 price target, which is the street high, tied for the street high. Piper Sandler, the analyst there, said, "We had been hopeful that the robotaxi unveiling would yield an excuse to boost estimates, and optimism is fading in this regard. But on the other hand, there's no need for estimate cuts because we had always assumed that revenue from full self-driving FSD software wouldn't begin ramping until 2027 and 2028. So, I think that's very indicative of Tesla overall. Very different price targets, very different ratings on Tesla. We've seen analysts kind of all over the map on this name. We have seen Tesla, shares kind of cool off. As I said, this month, it's back below the unchanged line for year to date. It's now down about 11.5% year to date after that impressive run higher over the summer. And if you take a look over the past 1 year, shares are down 12.5% as well. So it's a name we talk about a lot. We talk about it gaining quite some time, but if you take a look at the year to date in 1 year, still in the red.
Yeah, this is a stock that's like 100% off its lows of the last few years, but it's also 50% off its all-time highs and then some. It is volatile. It moves around, but the fact that just in your head you have to think about it, the company that figures out this full self-driving, this autonomous AI kind of robotics, who knows what it's going to be worth.
Say what?
The technology is so scalable and so game-changing.
Say what?
It doesn't necessarily mean it's going to be Tesla. That's always going to be the risk
Am I listening to CNBC?
All right, a little bit of rapid fire here, Carolina. Talk some Starbucks.
Say what?
They're going to be cutting back on promotions and discounts.
Oh my gosh.
The new leadership. All right, I'm not much of a boycotter. I'm not much of a protester. I'm getting real close with Starbucks.
Hey,
They've cut back enough of these promotions.
it sounds to me like you're very much of a boycotter there on Tesla there, buddy. Excuse me.
And an early move by new CEO Brian Nickel. And it's interesting because Starbucks had really ramped up the discounts, allegedly. I've never gotten a discount on my unsweetened iced green tea. But, to try to lure customers in because they were under pressure in terms of, just how much everything was costing. And now, according to the Wall Street Journal, Starbucks is pulling back on those promotions and discounts in order to really reposition the coffee chain as a premium brand. So the journal says Starbucks is pivoting away from discounts as Nickel emphasizes.
Did I hear a little bit of bias there?
Of selling handcrafted premium coffee. Apparently, Starbucks isn't planning to run broad offers during the holiday season and instead aims to promote seasonal drinks through advertising. So, it's interesting that they're trying to, they need to boost sales because sales have been waning, but they're going to do that through ads versus offering discounts to people, according to the Wall Street Journal. I will say, Starbucks, really over the past year or two, prices have gotten so crazy that I find myself, it's so easy to order on the app. So I still order my iced teas on the app and go pick them up, but I don't get them as much as I previously did because I can't justify the $5 expense. And I know you like pumpkin spice during fall season, Alex, and I know that's even more expensive. So don't count on any discounts on it, according to this report.
And I haven't even gone and got it this year. To put in perspective, I think to reiterate what you're saying. But you know what Starbucks always they did well is that they get you to prepay buying the kind of credits on there. That's almost like an interest-free loan. But you got to reload so often. What gets me back there is when I have to buy an increment that is like multiple trips. Well, now it's like I reload and that's the one trip. I don't need to go again. But let's talk some Flutter. This is the last one here on our list. Upgraded at Wells Fargo. For those who are unfamiliar, of course, parent company here in the U.S. of FanDuel, but this is also internationally the Betfair world for those who are familiar with sort of what's going on in U.K. as well as Ireland. This is a huge player in the betting space well before FanDuel was even words that we were speaking. What's the latest from Wells Fargo today?
Well, we got actually a few bullish calls on the company following Friday's sell-off amid speculation of increased taxes on online gaming in the UK. Wells Fargo did upgrade Flutter to overweight from equal weight with a price target of $295 up from $224. So that implies almost 30% upside from current levels. Friday's sell-off, they say, reflects a near worst-case UK tax scenario and minimal offset. So they think that also, one could arrive at Flutter's targeted fiscal 2027 revenue targets on fairly conservative assumptions. We also heard B of A basically say that Friday was kind of worst case scenario. So they have a $300 price target and reinstated coverage with a buy rating. Also added it to B of A's Europe 1 top list of ideas, saying that there's 35% upside potential, not including today's gains, more like 30% upside potential. Is premised on FanDuel's unique positioning and vigorous market backdrop, which leads it to put estimates 18% of 2027 consensus. So it cites large value creative opportunities, including in Brazil. So they're bullish as well. And then Benchmark reiterated a buy rating with a $265 price target and said that the decline that we previously saw in Flutter shares, not seeing today, we're seeing that reversed, is an ideal opportunity to capitalize on the pullback given its expectations for a far less severe outcome than feared. So Flutter shares up almost 5% today, still down about 3% this month, but really chipping away at those monthly declines and still up about 30% year to date.
Yeah, really nice year for Flutter. Disappointing last few sessions, but certainly putting a dent into some of that weakness today. So we'll see where the rest of the week shapes up. We're going to take our first short break of the program. We get back, it's time for charting and trading. We're going to look at Boeing and Starbucks, two companies with that corporate news. We'll get the technical take as well. We'll be right back.
Do. Okay. Gonna be one of them kind of days. We got the 200 on its path now on the SPY. 583.40.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close.
583.40.
No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders.
The crowd doesn't believe me.
Questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Oh no, Jimmy mentioned Mara.
Welcome back to Next Gen Investing. It's time for the Chart Master. And let's
Yes,
bring
he
in
did.
Kevin Green for that. We'll also bring back in Alex
But he
Tompey
didn't
to
type
talk
it.
about our upvotes, which are Boeing and Starbucks. Both losers today. Both losers this year, although it's Boeing that really takes the cake in terms of those year-to-date losses, down.
Right now I mentioned 583.40 and
Kevin,
didn't
this
see
is
it.
a tough chart to look at. Walk us through the technicals here and what you see for Boeing.
Yeah, this has been a difficult one to try to buy the dip here, and the trend continues to be to the downside. Now, when you're kind of looking at the chart setup right now, Caroline, there's not a lot to be really optimistic on. Even in the near term, it does seem like the stock still wants to kind of move to the downside. Now, we have a 1-year daily time frame, and one thing, a couple
It's
of
a
things
low
I wanna
blow, man.
highlight here, the stock has been in this
It's a low blow,
or
man.
this, these downward channels, if you will. We can kind of see that at the start of this year, moving to the downside.
Mara did pull back.
We had this consolidation. It was really trying to consolidate and potentially push to the upside. It tested that 200-day moving average and then continued to fail to the downside here.
Did you fail to mention that?
This range sitting at around $149, $150 right now.
That's what I
the first
thought.
test for this stock is going to get above that 20-day moving average, which is sitting at around $153.32. If you kind of notice, it's been really trying to fade that throughout the whole year. So that's going to be your first area to really try to break up,
That's what I thought.
especially on large volume, to really show conviction. And then we just kind of have this gap to the next resistance area, which is going to be at around $183.30.
Right now I'm watching the SPY and I'm looking at the SPX. The 5860 calls at $3. Went to 330 just now.
Aligns with that 200-day moving average. Once again, a very key level.
So I'm gonna see if this gets down here
If we are able to, then
to my
we start looking
200.
at additional levels to the upside. 220.
I said 583.40 and I meant it.
That 230, 235 range. But when you're kind of looking at the RSI, it is trying to coil. It's not the best indicator, especially for a market that is, or for a stock that's actually been trending to the downside. But that is something to note. It does appear that it wants to try to coil up and try to break out to the upside here. And I do also.
I don't know about that,
highlight
Mr. Green.
Scenario that's happening right now, where we are starting to see very large volume over the last couple
You
of
can't really
days.
go on a chart
That might
with
be
something like this,
dangerous,
Mr.
but
Green.
We do see a reversal type of candle or a nice hammer candle at those lows on large volume. That could be
130 coming,
one
Mr. Green.
indicator for the stock to potentially try to recapture some of these losses that it's seen in the past. But you'd never want to try to buy the dip on this name, especially because you don't really have an area of support, and it's just been a
130, buddy.
player within the industrial space as a whole.
How dare you?
Alex, Kevin said, 220, 230 on the radar, but obviously not moving any closer to that today. We talked about the median price target on Wall Street over 12 months, 203.50.
Oh, give me a break.
But you even said this one requires quite a bit of patience. Kevin said it's hard to, buy the dip.
Caroline.
Is there an example trade for a tricky one like Boeing?
Yeah, first off, I think Kevin's points are well taken when it comes to increasing exposure areas to watch, and you're sort of going counter to the trend. I mean, the trend has been very clearly to the downside for definitely the last year, but you could really extend it out further in time for that as well, and it seems to have consolidation periods and then vertical phases lower, and perhaps we're in one of those vertical phases lower now, especially with this new news coming into the marketplace. What I looked at was a bearish strategy. It's a short-dated trade, just looking for hey, we're breaking into new lows. Does this beget more new lows? Now, it's structured in a way that is relatively low probability, but it can pay off in a 3-to-1 fashion.
I've had enough of you already, sir. Why is it going down? I'll tell you why. Because it went woke. Now we're waiting for 583.40, aren't we, folks? We're going to raise it up a penny. Now I'm going to be buying me a call, the SPX, when we do that. And it's the 5860s. Oh gosh. That kid knows how to gamble, I heard. That's what I heard.
A little more than 1% year to date, so a pretty significant improvement from earlier this summer.
I agree.
What do you take a look at when you look at the technical breakdown for Starbucks?
Yeah, so the recent price action to the upside has been all news driven. As you kind of talked about, we have the executive leadership changes that are going to be taking place here, and then also the China stimulus measures, which any company that pretty much had exposure to China was actually catching a bid here. All right, let's start from left to right. Left side, we actually had this descending channel to the downside. Ooh. Obviously, that has been bearish. And then we have this significant gap down lower. Now, I will call this kind of like a little bit of an island of price, if you will. We stood in this level at those lows around the $71 to $75 range for a good quarter, and then we broke back to the upside, especially after that news. Now we're above the 200-day moving average. That's going to be a key area of support that you would like to hold. But we kind of have this odd formation taking place. You could say maybe it was a double top. You can also say maybe it's an inverse head and shoulders. Maybe it's just a back pattern, what have you. That just signifies to me that it either wants to continue to break out to the upside, or we could actually try to revisit that gap. And that gap is something that I'm keeping my eye out on, as well as other technicians that are out there. It's between $80 to $90. And if we do see a fill of that, that would also kind of require us to actually go back and test that 200-day moving average. We have a very thin volume profile at that gap area. It has not been tested for auction theory, which could also create a fair amount of volatility in this name. This is a better setup than Boeing, but definitely a lot better. But there's still a little bit of headwinds here, and this choppy action kind of gives you a little bit of a cause for concern. Now, RSI is actually in a bearish formation, making lower highs and making lower lows. MACD has already crossed that 12 EMA, below that 26 EMA, but still above the zero line. So it's still, for the most part, bullish, but that's something to be mindful of. Over the next couple of trading sessions, we will be testing that zero line. You'd like to see that shorter term EMA, which is going to be the blue line, kind of hinge back higher, which would also then coincide with prices moving to the upside here. I would be cautiously optimistic. It's been a nice little trend as of late, but I think the earnings announcement's really going to be that true catalyst for the stock to either break up or break down and try to fizzle out and try to mute some of these news-driven headlines. That's been the reason for the price action as of late.
All right, and earnings are on October 31st for Starbucks. Kevin Green, thanks so much for breaking down the charts for us. All right, Alex, so given that technical breakdown for Starbucks and given how much it's already run, how could someone approach trading a name like Starbucks? Walk us through the example trade.
Yeah, what I think is fun about this one, Caroline, is that if you don't have a directional opinion, it has a very clearly defined range that it's been in, between about 90 on the downside and about 100 on the upside as it sort of oscillated back and forth. You saw that on Kevin's chart. You saw that on the volume profile study off to the side. There's just been a lot of trading in this 10-point range. And so what I did is I went out to November 8th and I sold an iron condor for this example trade, giving it a little bit of cushion beyond those boundaries, but utilizing those support and resistance levels as sort of the guideposts here for this strategy. Rather than trying to pick a direction, you see a stock right in the middle of its recent range. Perhaps that range continues to hold on at least for another month or so. And so I looked at the 88.85 put vertical on the downside November 8th, and then the 102.105 call vertical November 8th on the upside. Iron condor strategy, four-legged option strategy. $3 wide, collecting $1 is exactly 1/3 the width of the strikes. Creates a 2-to-1 risk reward. So you risk 200 if it does break outside of its range and then some, below 85 or above 105, but then you have a chance to make 100 if it stays between those short strikes. So in this case, that'd be 88 and 102. And then of course the theoretical break evens, you just subtract the credit from the 88 put, you get 87, and then you add it to the 102 call, you get to 103. So pretty wide net cast around the stock. Now you'll have election, you'll have earnings, you'll have other things perhaps that'll move this market around between now and expiration date. So perhaps something that some traders would look to close out if possible before expiration, but that's going to come down to the market, and that's going to come down to the liquidity in the market as well.
Okay, all right. Thanks for the trades for Starbucks and Boeing. We're going to take a quick break, but when we come back, it's our FOMO segment. Talking SoFi today. Shares are surging today, up about 10% right now, a little more than that. We'll tell you why next. Stay with us.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy
old-fashioned analysis.
Portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Next Gen Investing. Alex Coffey joined by Caroline Woods live from the New York Stock Exchange. Time to discuss SoFi, which of course is the subject of our FOMO segment. Caroline, there's some, again, corporate news here. It's not analysts necessarily. This is a $2 billion pact / investment with Fortress Investment regarding its loans. Seems to be driving a lot of optimism today. This is a huge rally. Now, I know it was above $10 when we started the show, but it's right there now. So there's still hope for those who are hoping this is a double-digit stock by the end of the day.
Yeah, it's very close. Only about a nickel, or actually a little less than that, away from the $10 mark. Shares up about 10.5% right now. And actually, this was kind of a surprise winner this month to me. It's not one that's been on my radar in October, but it's up almost 27% this month. But as for what's behind today's gains, you talked about that $2 billion loan platform.
SOFI.
For personal loans, funds will be managed by affiliates of Fortress Investment Group. The agreement, according to SoFi, will expand SoFi's capabilities in its loan platform business, where the company refers pre-qualified borrowers to loan origination partners, as well as originates loans on behalf of third parties. In response to this, or as part of this announcement, SoFi's CEO Anthony Noto said, "SoFi's loan platform business is an important part of our strategy to serve the financial needs of more members and diversify towards less capital-intensive and more fee-based sources of revenue." So SoFi operates through 3 different segments, one being lending, which of course includes student loans, personal and home loans, and then they also have the financial services platform and then the tech platform as well. Lending was really the core, or was really core to SoFi's business for quite some time. But we've seen the other businesses really pick up steam. And when they last reported this summer Q2 results, they actually said that financial services and the tech platform segments make up a record 45% of SoFi's adjusted net revenue, up from 38% a year ago and 32% 2 years ago. And that Q2 revenue was actually driven by 46% combined growth in those 2 segments. So the focus has been more on the other segments away from the loans. Obviously, SoFi took a hit during the student loan moratorium and such. So when that was finally lifted, it gave a boost to SoFi shares. But investors are clearly happy that the loan side of the business is expanding with this new pact, because if you take a look, shares are just absolutely surging on this news. SoFi doesn't report earnings until later this month on the 29th, so we'll potentially hear more about the loans business when they actually report. But you know, when they did offer Q2 results, they did give full year 2024 guidance, and they said financial services net revenue growth was expected to be more than 80%, growth of more than 80% versus 2023. Tech was expected to see growth of mid to high teens versus 2023, and then lending adjusted net revenue of at least 95% of 2023 levels. So pretty close to 2023 levels. So we'll have to see what they say a bit later this month when they report.
Ching,
but a lot
ching.
of optimism now for SoFi, and important to note, shares are now positive year to date. They're just barely above the unchanged line, but they are positive now with this 10% move to the upside.
It doesn't look like all the analysts are totally on board with this one yet, and I guess I get the skepticism, Caroline, because for a long time this was a cash-burning business, one that wasn't positive for earnings. Now, if it delivers just in-line expectations for this next quarter, it would, of course, then have a full year of positive earnings, which I think is really important, but it has slowed dramatically in terms of how fast it's growing in terms of revenue growth. That said, my skepticism, especially when it was not a positive earnings company, was they're not reinventing the wheel here.
Oh,
this is
yeah.
an established business model. Banking's been around basically as long as anybody that's still alive now can remember for sure. They're not bringing anything really new to the table other than the experience maybe you have, so they have to be profitable. It's not like Tesla. If Tesla was just making cars, that's one thing, but the fact that they have that, like, hey, there's this technology side, that's why we talk about Tesla the way we're talking about. The case of SoFi, they're essentially just a run-of-the-mill financial services firm that's targeting millennials and Zoomers, and they got a little bit more maybe friendly tech, but unless they got something I'm missing here, Caroline, I understand the skepticism until they can get consistent earnings and consistent revenue growth that's way above its peers.
Right. I think that that's likely why we do see almost 60% of analysts in the hold camp for this name. You know, we talked about the impressive run higher this month, but if you take a look at the longer term chart, this was a stock that during the COVID highs in 2021 was trading above $20 a share. So it's been cut in half. And if you take a look at the median price target on Wall Street, it's $8 a share, so almost $2 below where it's currently trading. So there's not a lot of optimism on Wall Street, especially given this huge run that we've seen. But with economic conditions remaining pretty solid, with interest rates coming down, the financial services sector and companies like SoFi could potentially benefit, especially when it comes to increased consumer activity and increased loan activity as well. So that could be why we're seeing shares higher over the course of this month. But yeah, we haven't seen analysts really jump on board and become any more bullish on this name, despite the kind of positive overall landscape. And of course, we'll hear from the big banks this week. We'll hear from the regionals, and then we'll hear from SoFi later this month. So let's see if there's a catalyst for shares to continue moving. But hey, there's no ignoring this rally today, up about 11% at this point right now.
No, absolutely not. And kind of on a tactical front, really, kind of getting breakout territory when you kind of compare where it was at the end of last year. So I understand the optimism, no doubt. You combine that with a ton of short interest. It is the recipe for big, violent rally to the upside. So what I looked at for an example trade here, Caroline, on this one was with that in mind, the FOMO feeling being to the upside, and a trade that takes some risk, but doesn't cap the upside at all. This is going to be using a long call, effectively to get stock exposure or comparable theoretical exposure to owning 100 shares of stock. Now, what I looked at was buying a December 20th, which of course is a great day because that's my birthday. December 20th 8 call for $2. A break even would be $10 then on this, but we know it's not the same as owning shares of stock because, well, one, there's an expiration date. You wouldn't have voting rights. You wouldn't have rights to dividends, for example, some of the differences. But with very limited extrinsic value or time value in the option, because you're buying that in-the-money option, you're able to get, some leverage, perhaps, if you wanted to do that, but you get risk definition, too. This is a stock that traded $6 earlier on this year. Well, the max you can lose is effectively $200 on this, because that's the debit spent. That'd be equivalent of the stock going to $8 to the downside. So where stock, of course, if it went to 6, you'd be out $400 if you bought 100 shares. Now, what's nice is it has unlimited upside. So if this stock does go from 10 to 12 to 14 to 20, as you mentioned, this is a stock that traded 20 at one point, you would have uncapped upside. You'd participate fully, basically that in-the-money call would act like stock shares theoretically. So I think that's a way to think about trading, especially if you have an upside bias on something, using the call to get similar exposure as stock shares, but have a different risk profile to the downside, Caroline.
All right, so Alex, I'm marking my calendar for December 20th. I didn't realize that you're a fellow Sagittarius as well. I learn something new about you every single time I join Next Gen Investing. So
yeah, I hear that's the best one to be. It's the fire sign, right? Or it's a fire sign.
Yeah,
the arrow.
It's the traveler sign and the explorer adventurer sign. So yes, I'm a December 11th baby as well. So we celebrate around the same time. All right, we're going to take a quick break, but up next we'll take a look at the retail space after Wells Fargo downgraded a trio of names, and they're all moving lower following those downgrades. We'll be right back.
Yeah. Lulu. Yeah.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is powered by Ameritrade, bringing you futures and forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Year Investing. It's time to talk some apparel. Joined by, of course, Caroline Woods to discuss Wells Fargo's, I believe it was Ike Baruchow. All three of these notes being downgrades kind of across the board here today. Joining within the coverage, another name for a couple of them in the underweight camp, which is Ulta. Let's start with VFC. I think this is the one that basically everyone's familiar with. Parent company, of course, of Vans. Parent company of North Face, or if you remember back when we'd wear backpacks to school, JanSport as well, Caroline. But Wells Fargo, underweight for VFC.
Yeah, Timberland as well. But yes, Wells Fargo turning bearish on these names. And I should note that you mentioned that Wells Fargo downgraded a few, or I think we mentioned Canada Goose, VF Corp, and Amer Sports. And I will say that it doesn't seem like this is a call on the broader consumer as much as it is very much a call on the specific companies, at least from what I could gather from the note from Wells Fargo. So starting with VF Corp, shares are down about 5% right now in response to this this bearish note out of Wells Fargo. Still up about 3% year to date, but Wells downgraded shares to underweight. Lowered their price target to $15 per share. So if you take a look, VF Corp, even despite this 5% move to the downside, is still trading around $19.35, so $4.35 higher than where Wells Fargo ultimately sees it going. The analyst said the stock has run and valuation appears to be baking in much more upside than appears realistic. So basically it has a full valuation right now. I will say, on the other hand, Stifel actually maintained its buy rating on shares of VF Corp and raised its price target to $25 a share. So, kind of conflicting analysts' coverage today. If you take a look at the breakdown, though, 5 buys, 15 holds, and then 3 sells with a median price target of $17. So, below where it's currently trading. This analyst very much in the minority in terms of the sell rating or underweight rating, the majority staying on the sidelines for VF Corp.
Yeah, and I was just looking at it because this is Ike Baruchow over at Wells Fargo, 25 names in his coverage, 11 buys, 10 holds, only 4 of those sell equivalent, which of course in Wells Fargo's terms is underweight. Two of the names we're talking about. Next one was Canada Goose, of course, parent company of the namesake brand. It's almost Canada Goose season in New York, so those will be popping up here soon, Caroline.
Yeah, I have to break mine out, although we've been having some unseasonably warm weather, and I would like that to continue as long as possible. But yeah, Canada Goose share is down about 7% today, almost 7%, now down about the same year to date, so this bringing it into negative territory. And this downgrade from Wells Fargo to underweight from equal weight with a $12 Canadian lowered price target really falls on too many macro concerns around China, saying Goose has made China central to its direct-to-consumer expansion plan, now accounting for 40% of stores and greater than 30% of sales, leaving the brand overexposed to the volatile macro, which has gotten progressively worse through the year. So this very much focused on concerns around China. Just to compare it to the rest of Wall Street, not a ton of coverage for this name, but 2 buys, 7 holds, 2 sells, and a $16 price target, which is basically 32 cents below where it's currently trading right now. So the majority of analysts, again, on the sidelines for this one, but Wells Fargo in the minority, being an all-out bear for Canada Goose, but weighing on shares today, down about 6.5%.
And Caroline, the last one on the list was Amer Sports. Of course, this is just a downgrade to the neutral equivalent equal weight from overweight. Price target was actually raised to 19 from 17 from Ike over at Wells Fargo, so likes this one a little bit more. Not a name I look at a lot, I'll be honest, but 81% of the analysts in the buy camp, and for those a little bit unfamiliar, Arc'teryx, Solomon, Wilson, a little bit more athletic-centric stuff under this brand portfolio. Any thoughts on this name?
Yeah, Arc'teryx is a fan favorite in our household for skiing, but shares under pressure today, down about 3%. And if you take a look, you mentioned that Wells Fargo moved to the equal weight camp for this name with a $19 price target, which is basically 7 cents above where it's currently trading. Once again, the analysts, not even a bear, but still in the minority, the majority of analysts have a buy rating on shares for Amer Sports. Only 12% of analysts are on the sidelines. The rest are still looking at this as a buy with a $19 median price target. So basically in line with where it's currently trading. So it sounds like analysts are either going to have to possibly re-rate or start boosting those price targets if they want to stay in the buy.
Something's going to change.
Yeah, no doubt about it. We're going to take our last break of the program, though, so some downgrades from Wells Fargo in the apparel space, but we're going to look at a totally different firm in Upstart with George Tillis. Stick around. We'll be right back.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab Investing Themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Starting.
on Investing. I'm Caroline Woods alongside Alex Coffey. For our Under 30 segment, we're
Alex
talking
Coffey.
Upstart today. Ticker symbol UPST. It's a huge winner, up 16.5%. And Alex, this seems like it could have to do with Wedbush upgrading the company to neutral from underperform with a price target of $45 up from $10. So below where it's currently trading, but still an upgrade, no longer a bear. And in turn, we're seeing Upstart shares absolutely surge higher today. What are your thoughts?
Yeah, I think that you're exactly right. This was the catalyst to send this stock higher. Now, the magnitude of the move might have to do with the fact that nearly 1/3 of the outstanding shares are actually being shorted. This is one of the more heavily shorted names here when it comes to short interest, Caroline. About 33%. You can see that velocity to the upside as it sort of is breaking out of that cup with handle pattern there on the chart, which of course is a pretty bullish technical pattern for those who like those technical patterns on the chart. Analysts aren't completely bought in though. Wedbush is sort of joining the crowd here. 55% that I'm seeing compiled by Bloomberg, which is 10 of the 18 analysts, are in the hold camp. Still 7 stubbornly in a sell equivalent rating, with just one lone bull, that being Dan DeLev over at Mizuho. Now, what's interesting, Caroline, is if you look at Dan DeLev, who is the outperform on Upstart, he has a $48 price target. This from a note that was September 25th. So it's not like this is some stale note from midsummer. This was just a couple weeks back. It highlights just how dramatic this rally has been in this stock. And I think we'll probably see just a little bit more analyst adjustments playing a little bit of catch up here in this stock, given the dramatic rally that we've seen.
Yeah, I mean, if you take a look, up 37% just this month alone. The number is actually lower than that, up about 34% year to date. So we'll have to actually see if other analysts start to adjust their price targets. I will go back to the Wedbush call. As we said, moving to the sidelines versus being an all-out bear. In terms of reasons why the analyst thinks that improving credit quality metrics, lower interest rates, and improving Upstart macro index could drive a positive inflection in originations and adjusted EBITDA in the second half of 2024. So sort of similar to what we were talking about in terms of being a more positive.
You ain't missed much.
Like SoFi as well. Also says capital markets are the most accessible for credit providers as they've been in 2 years. So not necessarily reasons for bullishness, but reasons to no longer.
We have an ascending triangle, but I don't know.
For this name, but yeah, it's just been an incredible name.
I thought about a call myself.
16.5% today, but really almost 40% this month alone.
Yeah, no doubt. And last two thoughts that I have is we just had that really longer-term chart. I think it was the last 3 or 4 years up on the screen. It doesn't do it justice to look at just the last 52 weeks. It's been a difficult go 5 years as you go back to the 2021 peak. This was one of those names that really benefited from cheap money and the excitement that we saw in 2021, giving back the vast majority of that performance, but trying to make a recovery. And for those unfamiliar, AI lending platform connects borrowers to banks. That's basically what you got to know. Throw AI in there and you get some excitement on top of some short interest. Caroline, we leave the market largely where we began, which is new all-time highs above 5,900 for the first time in S&P futures. Any final thoughts on the overall market as we close out the program?
Well, I was just going to say this isn't the overall market. If you take a look at the fall from grace that Upstart has seen, that peak on that chart that you just showed was around $390 a share. So now it's trading at $54.77. So putting that into perspective, it makes the SoFi getting cut in half actually seem pretty good. So comparison really kind of puts things into perspective. But no, I think in terms of the overall market, it's really going to be about earnings. We're going to start to hear from those, or continue to hear from those big banks. The regional banks, I think there is a chance that it could help push the Russell higher if we start to hear some good news out of the regional banks. So I'm looking forward to it. And of course, Netflix. I mean, how high is the bar for Netflix? It's going to be fun.
No doubt about it. And when Caroline, I put in perspective, there's so many of these names that look like Upstart. The market's at all-time highs. So froth has come out, but that's going to do it for us. We're out of time. Thanks to Caroline Woods for joining me today. Coming up next is the watch list.
This election season, stay out of the muck and the mudslinging with Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did
She
you
has a
find
very
way
bad
to-
attitude.
It attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself,
Her job is to only make money.
it is very attractive.
So how are you exploiting human weaknesses?
Being lucky and trading.
I'd have slapped her in the face, guy.
For success.
You need to be able to find opportunities in the marketplace and sift through.
How do you exploit fake news?
You certainly see patterns. Context is so important.
I think the best traders I've seen have.
How do you impersonate a woman so well?
Otherwise, certain parts of your skills will become outmoded by competition or technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways as if you don't have an emotional reaction.
I'm not very good at
Are you a true redhead?
I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that
Okay, we're at 235.
are almost too big to fail.
Have you set yourself up correctly?
Have you?
The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
We're almost to the 200 right now. Run, dude.
Used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market
Damn,
for
Kevin.
You.
Market Overtime on the Schwab Network. Thanks for tuning in.
Oh! Oh! There it is. Yummy, yummy.
Good afternoon. Welcome to the Washboardjim. I'm Nicole Pedalini's. It's 2 p.m. Eastern Time. We're coming to you live from the New York Stock Exchange. Another record. The bull market enters into its third year. This after Friday, we saw record closes for the S&P and also the Dow. So what's coming up on today's show? We have Wedbush's Dan Ives standing by. He'll talk all about tech. His big takeaways after the big Tesla event.
That was a knife.
Taxi event. What he thinks is an inflection point for the EV.
Uh-oh.
We're also taking a look at the state.
I hope I get the grade here, around here sometime.
Possible public offerings that you want to watch throughout this year. And we're going to talk about the devastating hurricane season we have seen in 2024. Another potential.
There ought to be a clause in here.
Sort of trickles through. We'll take a look at that. In the meantime, here's a look at the markets. As I noted, we're watching for records again. We saw the S&P hit a new record this afternoon, the Dow as well. So, gains will be records.
Read the fine print.
10 of the 11 sectors are higher. You have the 10-year bond at 4.13% today. S&P 58.53. The Nasdaq at 20,425, up 0.75%. The Dow's up 135 points, and the Russell up about 0.5%. The VIX taking a little breather, pulls back almost 3%. Oil and gold also to the downside. Gold's down about $11. 26.65 troy ounce, 74.16 on.
Don't forget about the fine print.
$103. Dollars been gaining 103.04. That's notable. And Bitcoin, 65,910. That's a 4.1%. So a lot to discuss throughout this hour. Let's kick it off and get the big picture. Amish Schneider's with us.
Read the fine print.
At marketgauge.com. Good afternoon to you. Do you think there's a lot of opportunities in this market?
5860s,
A
yay.
little bit more careful now. And listening to you on the recap, it sounds so wonderful, except for the fact that the one area that I'm watching more closely than anything else is the consumer area.
Oh.
And I like to look at XRT Nicole.
It's a good spot to look.
It's a really good ETF with a blend of staples and consumer discretionaries. And A, it's red. And B, what's really thrilling about it is if you go back to the end of January, beginning of February of this year to now, 10 months, it's been in a $10 range between 70
That's a lie.
and it's trading at 75 right now. So what does that tell you? Is that if we really want to see this market continue or the economy reflect what's happening in the growth stocks in the S&P, we have to see the consumers stay in the game. And right now, smack dab in the middle, there's uncertainty, and that would give me a little
It's a
bit
lie.
of caution before piling in at these levels.
I see. We saw a couple of downgrades today.
Where do you get these nuts at?
Via C Corp, for example. There are concerns from some companies about the consumer. We've heard that, no doubt. Do you think we'll see market highs again? I mean, today we're looking at highs once again, and we've had a lot of folks come in and say, buy the dip. Is that your mentality?
Well, it depends on what you're looking at. I think you have to step back a little bit right now and say, okay, what's going to happen? We have an election coming up. So it's really hard to tell how much more volatility,
She's bright.
which, by the way, hasn't come down very much considering we have new all-time highs in the S&P today. So that's telling you that the market is still bracing itself for a level of volatility based on
$2
so
to
many
$2.50.
factors. I mean, besides the election, obviously, we still have other things going on. So this is where I like to go back and say, okay, what's going to happen in 2025, regardless of who wins? So there are certain things that we're seeing reflected today. Both candidates are very, at least positive in their campaigning about Bitcoin. So that has presented a lot of opportunities there. And if we get through the highs that we've had this year, which is 74,000, that could be really interesting, and all the different stocks that go along with that besides the ETFs. They're also both somewhat bullish in cannabis. You want to talk about something that's been totally beat up? That would be MSOS. It's sitting there at around $7. Depending on what could happen in 2025, that could be an opportunity. Obviously, defense is something that both candidates will feel very strongly about, given especially geopolitical situation. So that's that in the U.S. But I have to tell you, yes, we're on new all-time highs, but we have to see the Russell 2000 participate. Both candidates talked about domestic production increases. We haven't seen it in the numbers yet. Again, the retail's so important to me. But the good news is transportation's doing good. The regional banks are doing okay. So we'll see.
Okay.
I think it's patience here.
We got to go through this a little bit. Let's talk about retailers. You do have names like Target and Elf Beauty on your list. Why are those retailers probably maybe a good position to hold in a portfolio?
Two different reasons. Okay, so I know you and I have talked about that vanity trade. I think probably the most exciting thing that I'm watching unfold more and more is the implication of the diet drugs. And so that's why there's all these different stocks that I've had an eye on, Ulta Beauty being one, Elf being another, and then in the drug area, Eli Lilly and AbbVie and Novo Nordisk. And they're all mixed up in terms of where they are. But Elf had a dramatic drop from 220 down to 100. We got our clients in at 105. It's trading at around 116 right now. Do I think it's going to go flying back up to new all-time highs any time now? No. But I do think that it has a lot of benefit because it's a global company that really includes all complexions. I think that's a plus. In terms of Target, that's more staple shopping. We've got seasonals coming up with holidays. I like where it's sitting in a chart. It's not at all-time highs, but it's not beat up either. So if it can just continue in some level of consolidation over, let's say, I think 160 is the price I'm looking at it to get through. It's trading right under 159. That's an opportunity. So you got to really be selective.
You also like gold and silver. I mean, we saw gold, for example, 2,700 troy ounce, and right now 26.65. Tell me how you would go, because gold and silver are on your radar. You do like them, maybe as a safe haven. You tell us, and where do you think gold is headed?
Well, I've liked gold for 3 years now because you can see that gold. What's so interesting about gold, it's like a mirror. If you hold up a mirror and you don't want to see the cracks, they're there. And that's what gold is really reflecting, as you mentioned, flight to safety. But what's interesting to me about gold versus
$3.20. Are you kidding me?
Been stagnating between lowest $28 $32 or $33 an ounce. And when silver starts to outperform gold, which it's done in little pockets, and if it does in any kind of sustained way, and we start to see silver past that $33 mark, I think it's telling you a couple of things.
Randy.
One is that inflation may not necessarily be behaving as much as the Fed would like you to believe. Number one, and number two is that could have an impact to what the Fed will do going forward, not so aggressive in terms of lowering rates, and that should impact the whole market. And again, let's go back to the consumer. So it's all connected. You got to watch gold, silver, and you got to watch the consumer, and that's going to tell you what's up.
Yeah. Yeah. What about Zoom Video? That was an interesting one. And Chewy, Zoom and Chewy.
You were right, magnificent.
Pandemic names too.
Well, we're not exactly in a pandemic anymore, thank goodness, but Chewy is actually an interesting name because it's sort of a recession-proof type of situation. So if you wanted to think safety, if the situation starts to change where we go from yay, soft landing to wait, maybe that SOM rule really does hit, and we start to see more recession, again, going back to the consumer, Chewy could be a stock that can actually outperform. So it's been trading between 28, 31. You know, I love stocks that I'm interested in that consolidate in a range, because once they break out, that could be an interesting. So we're watching that. We're not in it. The same thing with Zoom. I've been seeing more and more.
That was a good one.
First of all, the earnings are supposed to be not too bad, and even though it's down today. Two is there's a lot of companies like Microsoft who are basically giving up on the go back to office thing. Zoom has competition, but they're starting to talk AI as well, and we know what that can do to a company once AI gets introduced. AI being used really more for data collection and keeping track of schedules and things like that for you. So I wouldn't necessarily, again, be buying this dip, but I'd wait.
Yeah, I saw you had Lucid on there, SL Green, you had a slew of names.
There's some noise.
Is that as rates come down, the economy could slow, and you don't necessarily.
There's only 5 people in here today.
Okay, Mish, we'll talk again soon. Mish Schneider, MarketGauge.com. Thank you for being with us. Coming up, Options Corner. Tom White is standing by. He'll join us and highlight unusual options activity that we're seeing from the day and how investors are looking to trade on recent.
You were right.
United Airlines, NVIDIA, Wells Fargo. We'll be right back.
Nice little hammer exercise. A double hammer with a boom boom. Get us a little knife, yes. We want a knife now.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the Watch List. Live at the New York Stock Exchange, I'm Nicole Petalides. Glad you're with us. It's time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. We welcome in Tom White, host of Fast Market here on Schwab Network. And United Airlines has been a good performer. We saw it moving higher, hitting some new highs. We saw Barclays price target raise, but you found a bearish trade. Curious to hear some of your thoughts, especially ahead of the earnings tomorrow as well.
Yeah, I think maybe a little contrarian play as far as unusual option activity. Nicole here with the stock up over 50% so far this year. They report earnings tomorrow after the close. The option market's pricing in about a plus or minus 6% move in the shares. If you look at what happened with Delta Airlines last week on their earnings report, I think it gave United and a bunch of the other carriers a little bit of a reprieve. Now, what's been headwinds for them has been, basically those costs related to operations, right? Employee costs continue to rise. Fuel prices earlier this year were higher, but now we've seen crude oil. For most of this quarter, crude oil is below $70 a barrel. So that's really going to help their margins moving forward. And then we had some other companies within the space, Alaska most recently and Allegiant. They said that their RASMs, their revenue per seat, available seat mile, were actually improving throughout the quarter, so that might be a bonus, but you can see here from the chart, I think a lot of that might be baked in. The RSI on a technical basis, so that relative strength indicator, is 79 right now, so anything above the 70 level is considered overbought on a technical basis, but the bar is high on this one going into those earnings, and I think that's what this trader's setting up for, whether it's a trade to the downside to kind of hedge a long stock position, or it's somebody that's just taking a shot here to the downside that this stock's run too far too fast, because out in the October 18th monthly cycle, so just 4 days to expiration, you're going to capture the earnings event. Saw a trader buy over 5,000 of the 60 strike puts. They paid an average debit of only 90 cents on those, so the break even where this trader starts to profit is below 59.10 over the next 4 days. That's about 6.5% below the current share price in there, about that one standard deviation that the option market's pricing in. And pretty surprising, even with the stock up over 2% today, puts are out trading calls. So typically we don't see that, but this has been a lopsided trade to the upside for a lot of these airlines, especially United, which has outperformed all the other major carriers over the last couple of months. But yeah, somebody taking a bear shot. I don't know if it's speculation. I don't know if it's a hedge, but they're definitely thinking that maybe we'll see a little bit of a break or a pullback here post-earnings.
Right, understood. I'm trying to take a look here at Delta, too, to see the volatility after its quarterly numbers. So we'll get those tomorrow. This trade, as you noted, is somewhat near term. So that's, at least we'll know the answers very soon. Then we can turn our attention over to NVIDIA, which is getting closer to that 140 level, could see record close today, and a price target increase over at Goldman Sachs. You found a bullish options trade. We want to hear more about that.
Yeah, it's been trending higher over the last couple of weeks. Remember, pulled back from those all-time highs, as you mentioned, above $140. Then it was kind of consolidating there for a while, but now we're back on track, trying to get back to those all-time highs. And if you listen to some of the commentary from CEO Jensen Huang over the last several weeks, he's saying demand for the new Blackwell chip's insane. Everybody wants this new chip.
Everybody wants it.
Moving forward. And if
I
you
want
look at
some
how much
too.
money some of these big tech companies continue to spend on CapEx to prepare themselves for this wave of AI, who's taking advantage of that? Well, NVIDIA's taking advantage of that because they control about 95% of the market for chips using AI training and inference chips. So, yeah, they've got this thing cornered, and it seems like Jensen Huang, you see, every time he talks during an interview, he's got more positive things to say about demand and expectations for sales of that chip moving forward. And call volume approaching nearly 2 million on the day. So a lot of people setting up for more gains potentially in NVIDIA over the next several days. One that stuck out to me was in the October 18th, so really short-term positioning on the 140 strike calls, just out of the money to the upside. Traders were buying over 200,000 of those calls throughout the day. The average debit was about $1.90 on these calls for the most part around that level. So the break-even 141.90 over the next 4 days. That's only about 2% above the current share price. It would be a brand new all-time high, but it seems like that's what traders are setting up for because calls are out trading puts by more than 2 to 1 today.
Yeah, and look, I mean, it could overtake iPhone maker Apple, right? With how large it's becoming and looking at these 140 levels. I mean, this stock was around $100 not that long ago. I mean, people were very nervous after the 10-for-1 stock split, moved to a new high shortly thereafter, and then pulled back, and people were buying in at 125, and they thought they were getting a bargain from the 140, only to see it go way down.
Yeah.
So there has been a lot of action, but to your point, saying the demand has been insane, and we've been hearing a lot of good news overall from NVIDIA, despite the landscape for competition that has been tough.
Yeah.
Then we turn our attention over to Wells Fargo because we had earnings on Friday from Wells Fargo and JP Morgan and BlackRock, and mostly pretty much good news. We'll have some more banks coming up. What were your thoughts on the Wells Fargo trade you saw on the heels of earnings?
Yeah, pretty steady kickoff to earnings season when you look at the results from JP Morgan and Wells Fargo. Now, Wells Fargo, I'm kind of going through the report, Nicole, and going, okay, it's a head scratcher. It's not a bad report. It wasn't a great report. Net interest margins actually fell 11% from the same quarter a year ago. That's not a positive at this point. Stock did jump over 5% Friday, up another over 2% today, up 27% on the year. So yeah, everybody seems to like the banking stocks. Consumer spending holding up. Demand for loans remains notably weak, though they did say, but EPS came in above
58.60,
expectations.
boing.
A little bit light on revenue, but basically in line. But fee-based revenue grew 16% for the first 9 months of the year, largely offsetting some of those net interest income headwinds that they saw during the quarter. They repurchased up to $3.5 billion worth of stock during the quarter. That's a positive. 9-month total of $15 billion in buybacks, 60% increase from a year ago. So there were some, good signs for Wells Fargo during the quarter. But if you look at the continued headwinds, maybe for loans moving forward from the consumer, that might be a headwind in the near term. But if you see the widening out of the yield curve, that's actually going to be a bonus for net interest income moving forward for this a lot of these banks. So maybe that was the positive.
Nice
we
little
did see some bullish activity
candle
here.
there.
And this was out in the November monthly cycle, so it expires on the 15th. About 32 days to expiration. Trader bought over 7,000 of the 65 strike calls. Paid an average debit of about $1.10, so that break even of 66.10 over the next month is about 5.5% above the current share price. We'll get some more results tomorrow morning from Citigroup, Goldman Sachs, Morgan Stanley later on in the week. But yeah, a good kickoff to the earnings season, helping move overall markets to record levels at this point. But this trader's setting up for some more gains here in Wells Fargo.
All right, thank you for that. So a bullish trade there for Wells Fargo. Thank you for Options Corner today, Tom, taking a look at those three names, looking at United Airlines, NVIDIA, and Wells Fargo today. Thank you, Tom White. Coming up, Wedbush's Dan Ives is standing by. Why does he have a $300 target on Tesla? Still thinks the outlook is pretty good. He saw something different last week than some of the other people did, all about the cyber cab and the Optimus robot. So let's see what Dan Ives has to say. We'll be right back.
Boom.
Trading at Schwab is powered by Ameritrade, bringing you futures and forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
This election season, stay out of the muck and the mudslinging with Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy.
They could hurt it badly.
Are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Accelerate your market knowledge.
And shift your perspective into full view. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the Watch List. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Look at few movers for you right now. We're watching Upstart. The shares jumping to new 52-week highs. Got an upgrade over at Wedbush to neutral from underperformed. The firm also raising the price target to $45 from $10. The analyst there noting it pointed to improving credit metrics, lower interest rates, and more new leading for the move. And shares of Upstart are up more than 85% over the past year. Hims and Hers shares also moving higher. The FDA said it would reconsider a decision barring drug compounders from selling their own versions of weight loss drugs. The decision allows companies to continue selling their lower price versions of the drugs for right now. Hims and Hers shares have jumped more than 200% over the past year as shortages of blockbuster weight loss drugs have allowed it to produce its own compounded medications. Right now, the FDA is working to determine if shortage of those drugs still exists. All right, we saw the big 1010 event, the robo-taxi event from Tesla. It was certainly a highly anticipated event. It was supposed to be 8/8. It happened on 1010. It was dubbed We Robot. It included the Tesla RoboVan, full self-driving technology, the Optimus robots, the cab, the cyber cab. There was a lot that went on, but were people impressed? Let's find out what Dan Ives has to say, Managing Director, Equity Research at Wedbush Securities. Good afternoon to you, Dan Ives. Were you impressed?
I mean, we were very impressed. I mean, I thought in 25 years of going to events like this was, I think, a jaw-dropper event relative to the technology that's coming out. Now, look, did it lack details? Yeah, and that's the reason the stock's down. I get it. But in terms of cybercab, autonomous, the future, what I believe, and when I look at Optimus, and in terms of where that's going to go, unsupervised FSD, Texas, California. I mean, Nicole, in my opinion, you walk away from there more bullish, not less bullish, but that now it's about execution. But I don't think there's anything that was disappointing coming out of that, what I view as just really a historical event that we'll view as historical 3-4 years from now.
I think some people were disappointed with the 2027 timeline. Were you taken aback by hearing 2027?
Well, I mean, CyberCab said 2026 in terms of production. I think the unsupervised full self-driving Texas, California in terms of 2025. I actually think the reason the stock's down was because there was no Model 2 announcement. In terms of the sub-30K vehicle, the next gen, we think there'll be a Model 2 and a Model 2.5. But they were never going to do it there. That's something we still believe is in 2025. But I think, as we've seen many times, investors in Tesla, they want more. But that's not necessarily their style. They are going to lack details. Then you'll get more, I think, on the earnings call, and then more as we go into the next 3 to 6 months. But it's not a reason to sell the stock. I actually think the future of Tesla is brighter today than it was a year ago.
Good. Good. Look, over 5 days, the stock's down about 9%. 1 year, it's down about 13%. So it hasn't been a great performer, though it certainly had a lot of volatility and did make an incredible comeback at times. You have a $300 target. You are feeling optimistic. It just felt like a lot of folks were finding things wrong. They didn't feel the Optimus robots were fully autonomous.
AI and NVIDIA are focused on AI. They should look how that's played out. My whole point is that it's about where it's going. But again, many of the bears, they don't see that in their spreadsheet.
And you got to wait. I mean, you have to have a lot of patience, right? Because
Internet issues today. Well. Huh. I don't know.